So the next chapter which we will be taking for revision will be analytical procedures. So let us try to revise now the chapter analytical procedures. And the immediately previous chapter which we have actually completed the revision is audit sampling. So we are successfully done with the audit sampling. And as a part of the audit sampling chapter, we have revised the content of SA 530. So now we are going to take up the next chapter for revision, which is going to be analytical procedures. Once again, very small chapter and also important from the examination perspective. And like the way audit sampling has been taken from the standard SA 530, even the concepts, whatever we are going to discuss in the analytical procedures has also been taken from certain standards. And the standard and the particular standard from which this content has been taken is SA 520. From which standard analytical procedures have been actually taken. The concepts, whatever we are going to learn, this chapter has actually been built from the standard SA 520. So when I say we are trying to discuss this analytical procedures, we are actually trying to cover the content from SA 520. So let us try to revise this chapter quickly. What is this analytical procedures? What is the concept of this analytical procedures, and all other terms we will try to understand it. So let us start our revision. So analytical procedures, this term analytical procedures is not something which we are listening to it for the first time. The term analytical procedures we have first come across in the chapter audit evidence. When we discuss the chapter audit evidence, there we have understood something called audit procedures. So there I have divided audit procedures broadly into two categories. Number one, risk assessment procedures, and the other one is further audit procedures. And the further audit procedures are further divided into two categories. It includes compliance procedures and substantive audit procedures. And this substantive audit procedures can be done in two more ways. It can be done either by way of test of details, or it can be done by way of analytical procedures. So this thing we have already discussed. Analytical procedures is actually a type of substantive audit procedure. And also in the same chapter, audit evidence, when we understood what are the various methods to obtain audit evidence, we have seen that there are 7 methods for obtaining audit evidence. It starts with inquiry, inspection, observation, external confirmation, recalculation, reperformance, and analytical procedures. So in fact, analytical procedures is one of the methods for obtaining audit evidence, and analytical procedures is one of the method for substantive audit procedures as well. So broadly, if I have to say, analytical procedure is one of the tool for performing audit procedures. Or if I put it in other way around, analytical procedures is actually one of the methods to obtain audit evidence. So what actually happens in the analytical procedures? Sir, in this method, in this tool, in this technique, what we exactly do in order to obtain audit evidence? Like for example, in the case of inquiry, we ask the questions, get the responses, by that we will get the evidence. In the case of inspection, we verify the documents, or we do the physical examination of the asset and get the audit evidence. Like that, in each method, we follow certain protocols. So what we exactly do in the analytical procedures to obtain the audit evidence? Guys, the name itself says analytical procedures. What is the procedure? What is the name? Analytical. That means in this method, in order to obtain audit evidence, I will not do the routine checking the supporting documents. I will not do the routine checking of inspection of documents or asking the questions. In the case of analytical procedures, as the name itself says, I am going to obtain audit evidence by using some analysis, by doing some analysis. As the name itself says, in the analytical procedures, I try to obtain audit evidence not by checking supporting documents, not by asking the questions. Here I am going to make use of my mind. I am going to make full application of my mind, and I do certain kind of analysis. By doing certain kinds of analysis, by complete application of my mind, I am trying to obtain audit evidence. Sir, what kind of analysis you will do? What exactly you will analyze, sir? So in the analytical procedures, actually, we try to study relationships. We try to analyze the relationships. Sir, what kind of relationships we will analyze? We try to analyze the relationship between either two financial informations, or I will study the relationship between one financial item and a non-financial item, and on the basis of studying that relationship, I will try to evaluate whether the financial information is correct or not. So if I give you the definition, if we go through the definition of the term analytical procedures, it says analytical procedures means evaluation of the financial information. That means we will analyze, we will evaluate whatever information which is there in the financial statements, whether it is correct or not. That we will try to evaluate through analysis of plausible, that is acceptable relationships among both financial and non-financial data. So if I break down this definition further, so what exactly we will try to do in the analytical procedures is, we will try to study the relationship between either two financial items, or we will try to study the relationship between one financial item and one non-financial item, and by analyzing that relationships, I will try to evaluate whether the financial information is correct or not. So that is what something which is different from the routine checking. In the routine checking, we check the supporting documents, but in the analytical procedures, we don't do that routine checking of checking the supporting documents, but instead we try to study the relationships. Let me give you an example. Sir, how I can study the relationship and find out the misstatements? Very simple. Take for example, studying relationship between two financial items. See, in your financial management, you might have done one chapter, ratio analysis. Ratio analysis. In that ratio analysis, you might have calculated different kinds of ratios. Let me give you one example. Gross profit percentage. When you are calculating gross profit, you are actually trying to study a relationship between two financial items. You are trying to study the relationship between gross profit and income of the company, total revenue of the company. When you calculate net profit percentage, you are trying to study the relationship between net profit and revenue of the company, two financial items. When you calculate certain ratio like freight expenses as a percentage of turnover, you are studying relationship between freight expenses, which is a financial item, and turnover, and the financial item. When you are calculating fixed asset turnover ratio, you are actually trying to study the relationship between fixed assets and turnover. So whatever calculations that you would have done in the ratio analysis chapter, that by calculating that ratios, we try to study the relationship. Okay, sir, I have calculated gross profit. I calculated the gross profit for the current year. The current year's gross profit is 30%. I studied the relationship. So gross profit is 30% of my total revenue. So that's all. By studying this relationship, did you find anything? No. The first step in the analytical procedures is we try to study the relationship. We try to find out the relationship. Like this, we try to do the calculation. The next step is, after we have studied the relationship, you have to do comparison. What we should do? We have to do the comparison. Sir, what kind of comparison I will do? When I say comparison, it could be two kinds. One is inter-firm comparison, or it could be intra-firm comparison. Sir, what is inter-firm comparison? I compare my client organization's financial information with another client's financial information, another company's, another entity's financial information. Like for example, I am conducting audit of Tata Motors. I calculated my client's gross profit ratio is 30%. Now what I will do is I will find out who is a competitor of Tata Motors. I came to know Maruti Suzuki. I will calculate gross profit percentage of Maruti Suzuki. Take for example, gross profit percentage of Maruti Suzuki is 45%. So I will do the comparison. This is inter-firm comparison. You are doing comparison outside of the organization. Or I will calculate entire automobile industry's average gross profit. With that I can compare. This is also inter-firm comparison. Or what you can do is, I calculated gross profit percentage of the current year. I will calculate gross profit of the same company of the previous year. When I calculated gross profit of the previous year it was 20%. I will do the comparison of the current year's gross profit with the gross profit of the same company of the previous year. This is intra-firm comparison. Or even I can compare my actual gross profit percentage with my budgeted figures of the same entity. This is also intra-firm comparison. So first step, you study the relationship, then you do the comparison. Either that could be inter-firm comparison or that could be intra-firm comparison. Now, by doing the comparison, third step which you will do is you will find out the deviation. By doing the comparison, what you will get? You will get deviation. Take for example, I am doing this comparison. My client company Tata Motors gross profit is 30%, whereas the competitor's gross profit margin is 45%. So I got a deviation that the gross profit of my client company is 15% less than the Maruti Suzuki. That means, will I automatically come to conclusion? If my client's gross profit is, I got a deviation, will I automatically conclude that my client has understated his gross profit? He is hiding his profits. Can I make the conclusion? No. So when you find the deviation, you should not automatically come to the conclusion that there is a misstatement. What you should do is, after I found the deviation, I will try to investigate. So when I find the deviation, I will try to investigate that further. Is that deviation because of a valid and a genuine reason, or is that deviation is because of some manipulation? That I will try to find out and finally form a conclusion whether the item is correctly stated or wrongly stated. Able to understand? So like this, I can study a relationship between two financial items. First I will study the relationship, then I will do the comparison. Two kinds of comparison I can do, either intra-firm comparison I can do or inter-firm comparison I can do. Then by doing the comparison, I will find out the deviations or fluctuations. That deviations or fluctuations I investigate further to find out, is it really because of a misstatement or is it not because of a misstatement? Is it because of a genuine reason? Clear? Next. Similarly, even I can study the relationship between financial and non-financial item also. I will not just study relationship between two financial items. Even I can study relationship between one financial item and one non-financial item. Take for example, number of employees and salary cost. Number of employees is a non-financial item, whereas salary cost is a financial item. And if you pay close attention, number of employees and salary cost both have a relationship. Both have a direct relationship. If number of employees are increasing, salary cost also should go up. This is the relationship I know. So I have studied the relationship. Now what I will do? Comparison. What kind of comparisons are? Any kind of comparison, inter-firm comparison or intra-firm comparison. Take for example, I am doing intra-firm comparison. Last year, previous year, number of employees are 1 lakh. Salary cost was 1200 crores. In the current year, the number of employees were 1,20,000. Salary cost was 1000 crore. Do you find something fishy here? Yes. Why? Because when the number of employees have increased, salary cost should have gone up. But to my surprise, that relationship is having a fluctuation. Number of employees are increasing, but salary cost has come down. Fluctuation. So I studied a relationship, did the comparison, find out the deviation. Will I automatically conclude that there is a misstatement? Number of employees have increased, salary cost has come down. That's all. Current year employee cost was understated, modified opinion. Is that correct? No. Once you find the deviation, what I told last step, you have to investigate that further. What you have to do? You have to investigate that difference further. Might be in the last year there was some trade union case of the employees. That's why the company might have paid a huge amount as a settlement. That's why last year's cost was very high. In the current year, that extraordinary item is not there. That's why the salary cost might have come down. Valid and genuine reason. So like this, once you find a deviation, don't automatically come to the conclusion that that item is materially misstated. We need to investigate that difference further and find out, is it because of genuine reason or is it because of material misstatement? So this is what basically the meaning of analytical procedures. So in the analytical procedures, we evaluate whether the financial information is correct or not by studying the relationship between financial items, by studying relationship between two financial items, or even by studying relationship between one financial item and one non-financial item. Clear and comfortable? Able to understand everybody? Now, sir, what is the purpose of performing analytical procedure? What is the purpose of performing analytical procedures? Let us try to understand it. So what is the purpose of analytical procedures? See, let us try to understand this purpose. What does SA 520 say? See, any audit procedure, what is the purpose of performing any audit procedure? Ignore audit procedure, ignore analytical procedure. What is the purpose of performing any audit procedure? The purpose of performing any audit procedure is to obtain sufficient and appropriate audit evidence. So like any other procedure, even analytical procedures, one of the main objective is sufficient and appropriate audit evidence. But here there is one more thing which we need to understand. Guys, if you remember, I told that just now in the previous chart, whatever I have drawn, analytical procedures can be used as a technique for performing substantive audit procedures. Similarly, if you remember the discussion whatever we had in the risk assessment and internal control chapter, even for performing risk assessment procedures also we can use 4 techniques. We can perform risk assessment procedures either by way of doing inquiry or by inspection. We can also do observation, or even we can do analytical procedures. So the point which I want to conclude here is analytical procedure is actually a method. This analytical procedure can be either used as a risk assessment procedure, and this same analytical procedure method can be used as a substantive audit procedure. When I am using analytical procedure as a risk assessment procedure, why I perform risk assessment procedure? To obtain an understanding of the entity and identify risk of material misstatement. When I perform substantive audit procedures, what is my objective? Actually, I will perform substantive audit procedures to obtain sufficient and appropriate audit evidence. So the purpose of analytical procedure is, when I use analytical procedure as a risk assessment procedure, the purpose is to identify the risk of material misstatement. And when I perform analytical procedure as a substantive audit procedure, my purpose is to obtain sufficient and appropriate audit evidence. Able to understand what I am trying to say? So when they are telling that, what is the purpose of analytical procedures? Number 1, the purpose of analytical procedure could be to identify risk of material misstatement. When analytical procedure is used as a technique for performing risk assessment procedure. Or the purpose of analytical procedure could be to obtain sufficient and appropriate audit evidence when analytical procedure is used as a technique of substantive audit procedure. Hope you guys are able to understand this point, whatever I'm trying to say. So the purpose of analytical procedure is when used as risk assessment procedure to identify risk of material misstatement. When used as substantive audit procedure, the objective is to obtain sufficient and appropriate audit evidence. And the standards also say one more thing here. So when we go to the material, when we talk about the purpose of analytical procedure, SA 520 says, so number 1, the main purpose is to identify existence of unusual transactions or events or ratios and trends using substantive analytical procedure. That means you can use analytical procedure to obtain sufficient and appropriate audit evidence. Number 2, Even you can perform analytical procedures in identifying risk of material misstatement when you are performing it as a risk assessment procedure. And one more thing also, the standard says one more purpose of analytical procedure is we design and perform analytical procedures near the end of the audit that will assist the auditor in forming an overall conclusion as to whether the financial statements are consistent with auditor's understanding about the entity. So when you use as a risk assessment procedure, the purpose is to identify risk of material misstatement. When you use analytical procedure as a substantive audit procedure, the purpose is to obtain sufficient and appropriate audit evidence. And one more thing, the standard also says the auditor will even perform analytical procedures almost at the end of the audit, after he has done with all the audit procedures. Before he form the conclusion, before he gives the audit report, auditor will perform analytical procedures once again to get an overall understanding, whatever understanding he got about the entity, whether the same thing is reflected in the financial statements or not, to form an overall conclusion. Just before finalizing the audit report also, auditor will perform analytical procedures. So at the beginning you will perform as a risk assessment procedure, at the actual testing phase you will perform as a substantive audit procedure, even at the conclusion phase to form a conclusion. Just before you form a conclusion, just before you form an opinion, whether whatever you got to know about the entity, same thing is reflected in the financial statements or not, to form that conclusion at the close of the audit also, auditor will perform analytical procedures once again. So this is what the three specific purpose of analytical procedures as per SA 220, and this will automatically answer our next question also, timing of analytical procedures. When you will perform analytical procedures, the answer lies in the previous concept itself. So when you are using analytical procedure as a risk assessment procedure, we are using it at the planning phase, at the beginning of the audit. When we are using it as a substantive audit procedure, that means at the actual testing phase you are using it. And even just now we have seen the third objective, we will do it at the close of the audit also. That means even at the conclusion phase also we are performing analytical procedures. So when they say what is the timing of analytical procedures, that is when and all you will perform analytical procedures. At all the stages of the audit I will perform analytical procedures. At the planning stage also I will perform. At the actual testing phase also I will perform. At the conclusion phase also I will perform. At the planning phase I will use it as a risk assessment procedure to identify the risk of material misstatement. At the testing phase I will use it as a substantive audit procedure to obtain sufficient and appropriate audit evidence. Even at the conclusion phase I will try to perform analytical procedures to form an overall conclusion on the financial statements of the company. So these are all the various timing. This is what when analytical procedures will be performed. Next one, there is one more term which we need to understand. See, we know analytical procedure, but what is, there will be, sometimes we will use the term substantive analytical procedure. We know what is an analytical procedure. Just now I have told, at some places you will be able to find a term called substantive analytical procedure. What is the meaning of substantive analytical procedure? Guys, if you remember, substantive audit procedures will be there. Substantive audit procedures, you can either perform it as either perform substantive audit procedures by doing test of details, or you can perform substantive audit procedures as by performing analytical procedures. When analytical procedures are used as substantive audit procedures, that only we call it as substantive analytical procedures. Nothing significant here, nothing so much of rocket science is not there, very simple. The difference between analytical procedures and substantive analytical procedures is, just now as I have told, analytical procedures can be used either as a risk assessment procedure, or it can be used as a substantive audit procedure, or it can be used as at the conclusion phase, final phase also. When you are using analytical procedure as a substantive audit procedure, those analytical procedures, I call it as substantive analytical procedures, nothing else. So very simple, guys. The difference between analytical procedures and substantive analytical procedures is, analytical procedures can be performed in different ways. When you are specifically performing analytical as a substantive audit procedure, then we call that specific analytical procedures as substantive analytical procedures. Able to understand? So that is what substantive analytical procedures is. The next most important concept from this chapter is, what are the various methods for performing, what are the various techniques available for performing analytical procedures. See, I told in the analytical procedures, we study the relationships, do the comparison. And for performing that and for studying that relationships and doing the analysis also, there are different techniques available. So what are that techniques for performing substantive analytical procedures? Basically, there are 4 techniques which are available for performing substantive analytical procedures. Sir, what are that 4 techniques? We have something called trend analysis, then we have something called ratio analysis, then we have something called reasonableness test, and also we have another technique called structural modeling. So what are the 4 methods which are available for performing, what are the 4 techniques which are available for performing substantive analytical procedures? Number 1, trend analysis. Number 2, ratio analysis. Number 3, reasonableness test. Number 4, structural modeling. Very, very important question from the examination perspective. Let us try to understand it. Sir, what will happen in the trend analysis? In the trend analysis, what I will do is, I will study certain item of the financial statements trend over a period of time. Like for example, in the last 5 years, what is the trend of the revenue I have seen? So for example, that company is growing like this, 100, then 120, 140, 160, 180. So I have seen the trend of the revenue of the company over the past few years. There is a clear trend there. What is a clear trend here? Year after year, the company is growing at the rate of 20 crores per year. Now I have a trend. I will check whether in the current year, the account is moving in line with the trend or not. What do you mean by account moving in line with the trend? In the current year, if the turnover is 200 crores, yes, the account is moving in line with the trend. On the other hand, assume that in the current year, the revenue has come down from 180 to 160 again. That means trend has broken. Now the auditor will try to investigate further. Has this trend been broken because of a valid and genuine reason, or management is trying to understate their revenue by way of hiding some income? So this is what we call it as trend analysis. So in the trend analysis, what we basically do is we try to study the trend, we try to study the trend of a particular item of financial statements over a period of time, and we will check whether in the current year the account, that particular item of the financial statement, is moving in line with the trend, or is it violating the trend. If it is violating the trend, I will investigate further. Has that trend been broken because of a valid reason, or has it been broken because of fraud or error? Clear? So this is what happens in the trend analysis. Then what will happen in the ratio analysis, sir? In the ratio analysis, what I basically do is I will try to study relationship between two financial items. When you are specifically studying relationship between two financial items, that I call it as ratio analysis. See, if you try to study individual financial item, there will be no predictability. For example, if I have given you debtors balance, previous year debtors were 100 crores. Current year debtors were 120 crores. If I just gave you debtors balance, will you be able to make any reasonable conclusion? No. Simply you will come to know, okay, debtors have increased, but you will not be able to do any particular analysis. But along with the debtors data, if I have also given you sales data, now you can predict it. Now you can do better analysis. Now you can do the comparison, find out the deviation. So when you are studying the relationship between the items of the financial statements, that we call it as ratio analysis. So why we have to study relationship between two items is, individual item is very difficult to predict, but the relationship of one item with another item, we can predict it easily, and we can make good decisions out of it. So when you are particularly studying the relationship between two financial items, that we call it as ratio analysis. Then we have something called reasonableness test. See, in the reasonableness test, we don't study relationship between two financial items. Why? Because if we study the relationship between two financial items, that becomes ratio analysis. And also, we will not go to previous years also. If we go to the previous years and study the relationship, that will come under trend analysis. So in the reasonableness test, we will not be studying relationship between two financial items. Even we will not be studying, even we will not be comparing with the prior years. Then what we will do in the reasonableness test is, we take a financial item, we take the related non-financial item, and try to study the relationship between the two of the same year. We'll try to study the relationship of between the two of the same year. If I give you one example, take for example, in the balance sheet, they have stated inventory. The value of the inventory stated was 10 lakh rupees. When I found out the logic behind the valuation, they are telling they had 1 lakh quantity of inventory, cost or NRV 10 or 11, whichever is lower. So 1 lakh into 10, that's how they determine the value as 10 lakh rupees. Now I want to know whether this inventory is correct or not. So what I am doing is, I am looking at, I have to obtain evidence whether this 1 lakh quantity which is used in the valuation of inventory is correct or not. If quantity used in the valuation of inventory is correct, then obviously this inventory value will be correct. So I finally want to know whether this inventory of 10 lakh rupees is correct or not. What I am doing is, in order to know whether really they had 1 lakh quantity of stock as on the balance sheet, that I am cross verifying with the storage space they are having. So I went to the management and told, sir, please show me your warehouse. Please show me the place where you will keep the stock. The management has took me to the warehouse and told, sir, this is our warehouse. See, if I know the product's size, if I know the storage space, I can estimate how much quantity can be accommodated in this warehouse. So when I looked at this warehouse, I have in mind the size of the product of the company. I found that this warehouse can accommodate only 30,000 quantity of the stock. So I asked the management once again, sir, as on the balance sheet date, did you have any other warehouse? Why? Because they have 1 lakh quantity. They have used 1 lakh quantity for valuation. But when I asked them what is the storage space they have as on the balance sheet date, they have shown me one small warehouse in which it can accommodate only 30,000. I asked the management, so sir, do you have any other warehouse as on the balance sheet date? They told, yes, sir, we have another warehouse. Now, when I looked at the size of the warehouse, that warehouse could accommodate only 40,000 quantity of the stock. Now I asked the management once again, sir, do you have any other warehouse? The management is telling, no, sir, we didn't had any warehouse as on the balance sheet date. Now, when you have a storage space which can accommodate only 70,000 quantity, how come as on the balance sheet date your inventory value is valued considering 1 lakh units? So if you observe the entire scenario here, what I am doing is I am taking one financial item which is inventory value. I am studying its relationship with the related non-financial item of the same year. I'm studying the relationship of financial item with the non-financial item of the same year. Here storage space is non-financial item. I'm not looking at the past year's non-financial item. I'm looking at the current year's non-financial item only. So that's what will happen in the reasonableness test, where I will not study a relationship between two financial items. I will not do comparison with the prior years. I will take financial item. I will study its relationship with the non-financial item of the same year. That I call it as reasonableness test. Then we have last one, structural modeling. See, these are very rarely used tools in the industry for analytical procedures. What will happen in the structural modeling is these are actually some softwares. These are actually from softwares which are developed using statistical concepts like permutations, computation, probability theory. So some softwares have been developed in the market using statistical concepts. Now what these softwares will do is, if you enter last few years data inside this software, it will automatically apply the statistical concepts and predict the current year's turnover. Like for example, if there is a software, in that software if you enter last 5 years turnover and last 5 years profit, the software itself will apply some statistical concepts and it will predict and tell you, okay, on the basis of past 5 years, current year's revenue should be this much, current year profit should be this much. Then I will compare the actual revenue and actual profits with the projected figures by the software. If there is any huge difference, I will try to investigate that further. So these softwares which I am using, that I call it as structural modeling. The softwares which are developed using statistical concepts. These tools are very rarely used in the industry. Why these tools are very rarely used in the industry is because there are two gray areas here. Number one is technology, which chartered accountants are not so familiar, not so good with using of the technology. And one more gray area is statistics. Statistics is once again a headache. So because of all these complexities, these tools are very rarely used in the industry. But the above three tools will be very frequently used depending upon the item of the financial statement. Clear everyone? Able to understand? So these four are the techniques which are available for performing analytical procedures. Hope you guys are able to understand it. So since we have seen the techniques which are available for performing substantive analytical procedures, the next thing, few more important concepts from this chapter we will try to revise. So the next concept which I will be revising from this chapter, analytical procedures, is, see, when you want to perform analytical procedure as a substantive audit procedure, there are actually 4 steps. When you want to perform analytical procedure as a substantive audit procedure, that means, or they might also say, when you want to perform substantive analytical procedures, it actually involves 4 steps. Sir, what are that 4 steps? So let me try to take you through that 4 steps. See here, what are the steps involved in performing analytical procedure as a substantive audit procedure? Or even they might ask you a question, write about analytical procedure as substantive test. So the 4 steps which are involved in performing analytical procedure as a substantive audit procedure is, number 1, we have to determine the suitability of particular analytical procedure for given item of the financial statements. Number 2, we have to evaluate the reliability of data, whatever data that we are using for performing analytical procedures, whether that data is reliable or not, that we have to determine. Then we have to develop an expectation of recorded amounts or ratios, whether this expectation is helpful to identify the misstatement. Number 4, whatever deviations that you have identified, we have to do the further investigation. So I will talk about each and every of this step in a detailed manner, but let us try to understand this. Let us try to memorize this. There are 4 steps involved in case if you want to perform analytical procedure as a substantive audit procedure. So what are the 4 steps involved? Number 1, determine the suitability of particular analytical procedure to a given item of financial statements. Number 2, we have to evaluate the reliability of data, whatever data that we are using for performing analytical procedures, whether it is reliable or not. Number 3, whatever expectation that you have developed by performing analytical procedure, is it sufficient enough to identify the misstatement? Number 4, whatever deviations that you have got, you have to do further investigation of it. Now let us talk about each and every step in a detailed manner. First step, what is that? See, each and every step is a separate question. Like whatever this first step is there, determining suitability of particular analytical procedure, that is addressed in this question number 8. Whatever second step is there, how to determine reliability of data, that is addressed in next question. So like that, for all the 4 steps, we have separate question. So the first step in performing analytical procedure as a substantive audit procedure is determining the suitability of particular substantive analytical procedure. Like if you take just now, we have seen 4 techniques. No, we can perform trend analysis, we can perform ratio analysis, we can perform reasonableness test, we can perform structural modeling. Out of these techniques, which particular analytical procedure will be suitable for which item of the financial statement? For example, if I want to perform analytical procedures in the area of revenue, which out of these 4 techniques, which technique will be most suitable? If I want to perform purchases in the area of purchase, if I want to perform analytical procedures, out of these techniques, which one will be more suitable? If I want to perform analytical procedures in the area of fixed assets, out of these methods, which technique will be suitable? So that you have to determine first. Suitability of particular analytical procedure to a given assertion. Out of various techniques we have, which analytical procedure will be suitable for which item of the financial statements, that you have to determine. Sir, who will determine this? Auditor only will determine. How he will determine? How he will determine? Simply they say by using the professional judgment. By using what? Professional judgment. The auditor will do the analysis, the auditor will apply his knowledge, experience and training, and he will determine if I follow which particular technique, it will help me to identify the misstatement. He will use his knowledge, experience and training, and whatever he decides on the basis of professional judgment, that he will perform. Like for example, auditor wants to decide in the area of revenue which analytical procedure will be suitable. He did a professional judgment. He applied his experience, training and knowledge, and he determined that okay, if I do trend analysis in the area of revenue, then it will help me to identify more misstatement. Then what auditor will do is he will perform trend analysis in the area of revenue. He wants to verify fixed assets. Now he will apply his knowledge, experience and training, and he decided that okay, in the area of fixed assets, if I could perform ratio analysis, that will help me to identify the better misstatements. Then what auditor will do is he will perform ratio analysis in the area of fixed assets. So the summary is this: the first step in the performance of analytical procedure is the auditor should determine which analytical procedure will be suitable for which item of financial statement. There is no hard and fast rule here. It has to be decided by the auditor, and the auditor will decide is using his professional judgment. He will analyze if he follows which technique that will give him better results, that he will use his knowledge, experience and training, and accordingly whatever he deems fit, that he will perform. That's what even they try to say here in the question number 8. Like if we read it, how the auditor will determine suitability of particular analytical procedure for given assertion. The answer says substantive analytical procedures are generally more applicable to large volume of transactions which tend to be predictable. See, we can perform analytical procedures only on that kind of data where predictability is there. That means on the basis of one item we should be able to predict another item. That means relationship should be there. If there is no predictability, we can't perform analytical procedures. Next one. However, the suitability of particular analytical procedure will depend on auditor's assessment of how effective it will be in detecting a misstatement that may cause the financial statements to be materially misstated. That means what they are trying to say is, now which analytical procedure will be suitable for which item of financial statements, that will be decided by the auditor. Auditor will do the analysis. If he follows which particular technique, he will be able to identify more misstatements, and whatever he deems fit, that one he is going to perform. And in some cases, even an unsophisticated predictive model also may be effective. In some cases, simple analysis also will give you better results. Like for example, when the revenue of the company has gone up, what should have happened to the profit? Profit also should have gone up. In one case, the auditor found that the revenue of the company has gone up from the last year, but profit has actually come down. He investigated further. He found a misstatement. So like this, sometimes even unsophisticated, very simple predictive model, like when revenue is increasing, profit should increase. This is a very simple predictive model. In some cases, even this kind of simple analysis also will give you best results, but in some cases, you might be required to perform advanced methods. So which one will be suitable, which one will not be suitable, that decision will be ultimately decided by the auditor purely on the basis of his professional judgment. Okay, so we have seen the first step. Auditor will determine which will be suitable. The next step is determining reliability of data. Guys, in order to perform analytical procedure, we need lot of data. For example, current year. For example, if you want to do intra-firm comparison, you need current year's data, you need financial information, non-financial information from the previous year. So like this, while performing analytical procedures, we need lot of data. And whatever data that you are performing, whatever data that you are using for performing analytical procedures, if that data is reliable, whatever data that you are using for studying the relationships and doing the comparisons, if that data is reliable, automatically results of the analytical procedures also will be reliable. If whatever data that you are using for performing analytical procedures, if that data itself is not reliable, how can we expect the results of the analytical procedures to be reliable? Able to understand? So whether the results of analytical procedures, will they be reliable or not, that depends on whatever data that we are using for performing analytical procedures, whether that data is reliable or not. If the data which we are using for performing analytical procedures is reliable, automatically the results of the analytical procedures also will be reliable. If the data which you are using for performing analytical procedures is not reliable, obviously the results of that analytical procedures also will not be reliable. Now, how you will determine whatever data that you are using for performing analytical procedures, whether that data is reliable or not, how you will find it out? What are the factors which auditor will consider in determining whatever data that he is using for performing analytical procedures, whether that data is reliable or not? What factors auditor will consider and take that decision? That is a second step. So the second step is determining reliability of the data, and they have given in this answer how the auditor will determine whatever data that he is using for performing analytical procedures, is it reliable or not. So see here, this sentence is very, very important. The reliability of results of analytical procedures depends on reliability of underlying data. Whatever results that you have got from the analytical procedures, whether they are reliable or not, that depends on the data which you are using for performing analytical procedures, whether it is reliable or not. Accordingly, the following are relevant when determining whether data is reliable or not. So now how auditor will determine whatever data that he is using for performing analytical procedures, whether that data is reliable or not, how auditor will determine. Number one, source of the information available. From which source you are getting that data. If you are getting that data from an independent external source, then it will be reliable. And if you are getting it from internal non-reliable sources, then data will not be reliable. So first factor which auditor will consider in determining reliability of data is source from which we are getting the information. Number two, comparability of the information available. Whatever data that you have got, is there any other data to compare? So if we can compare the data which we have obtained with immediately close source, then we can determine reliability. If we don't have any data to compare, then we can't determine reliability. I will give you one simple example for this. The example, whatever they have given in the study material, the same thing I will say. Take for example, you are conducting audit of an e-commerce company. You are conducting audit of an e-commerce company. Take for example, you are conducting audit of Myntra. Now you got all the data for Myntra for performing analytical procedures. Is there any source with which you can compare this data? Can you compare the Myntra data with other entity? Yes, we have various other entities with other entities which are in the same line of business with which we can compare. Like for example, we have Ajio. We can compare, if we got the Myntra data, that data we can compare with the Ajio and determine whether it is reliable or not. If not Ajio, we can compare it with Meesho and determine whether that data is reliable or not. Today we have some e-commerce platforms which are also doing this e-commerce business, but they are selling customized products. Take for example, there is some e-commerce platform which is selling customized stationery. They will sell the pens with your names engraved on it. They will sell some stationery items with your names engraved on it. So this company is also the company which is selling the customized stationery. That is also e-commerce business. I have got the data for this e-commerce company which is selling customized stationery. Can I compare that data with the other e-commerce platforms like Amazon, Flipkart, etc.? No. Why? Because Amazon is a very bigger business. It is not selling customized products. It is a e-commerce, but it is not selling customized products. But the company which I have told, it is selling customized stationery. It is selling customized products. So now for these kind of companies which are dealing in the customized products, we will not have any close source to compare. If you don't have source to compare, how can you determine the reliability of data? Able to understand? So whether data is reliable or not, that will be decided. One more factor which auditor will consider is comparability of the information available. Whatever data that you have captured, is there any other source to compare? If the comparability is there, yes, data will be reliable. If the comparability is not there, then data will not be reliable. And one more factor which auditor will consider in determining whether data is reliable or not is nature and relevance of the information. What is the nature of the information? How relevant that your information is? For example, if you want to compare the actual information with the budgets, budgets will be relevant only when the management is realistic in setting the budgets. Some managements, what they will do is they will not be realistic when determining budgets. For example, last year's company's revenue was 100 crores. In the current year, they want to see somehow at some point of time, they want to reach the turnover of 1000 crores. In the budget, what they have done is last year we made 100 crores of turnover. In the current year, we budget to make 1000 crores of turnover. Here, is the management realistic in preparing budgets? No. Now, if you do that comparison, if you take this budgets for comparison, will it be reliable? No. And using that budgets, if you did the analysis and if you got the deviation and if you got the results of analytical procedures, will they be reliable? No. So that's why whether data is reliable or not, that depends on nature of the information and how relevant that information is, how practical that information is, how close that information is. Able to understand? So third factor which auditor will consider is nature and relevance of the information available. And finally, fourth factor which auditor will consider in determining the reliability of the data is controls over the preparation of the information. what is the status of internal controls which are working over the preparation of data? If the internal controls over the preparation of that data are working effectively, then the data will be reliable. If the internal controls over the preparation of that data is not working effectively, then that information will not be reliable. So the second step in the performance of analytical procedures is the auditor should determine whatever data that auditor is using for performing analytical procedures, is it reliable or not, and how the auditor will determine what factors he will consider in taking that decision. He will consider the source from which information was available, whether that information is comparable or not, nature and relevance of that information available, and controls over the preparation of the data. Everybody able to understand here? So out of the 4 steps, we are done with 2 steps actually. So first step, determining suitability of analytical procedure. Number 2, determining whether the data is reliable or not. Till here, everybody clear? Now let us try to understand the third step which is required to be performed, the third step which you have to take care of in order to perform analytical procedures as a substantive audit procedure. See, first 2 steps are actually a bit easy to understand. So first step, you have to determine which analytical procedure will be suitable for which item of the financial statements. That is easy. Second one, you need to determine whatever data that you are using for performing analytical procedures, whether that data is reliable or not, that you have to determine. That factors also we have considered. Third step is actually a bit complicated step. Understanding what is this third step is a bit important. Answer is very easy. So what is this exactly the third step? That is a bit difficult to understand, but the factors which we will consider here will be very easy. So first let me try to explain here what is a third step. So if you come here, the third step is covered in a detailed manner in this answer. So let us try to understand what exactly this question is. Explain the matters which are relevant to auditor's evaluation of whether the expectation will be developed sufficiently precisely to identify a misstatement that may cause the financial statements to be materially misstated. I know nothing you would have understood. So first step, after you have determined the suitability of analytical procedure and after you have determined reliability of data, the third step is you need to determine whether expectation can be developed sufficiently precisely to identify a misstatement that when aggregated with other misstatements may cause the financial statements to be materially misstated. Sir, what is this they are trying to say here? So they are asking us something like whatever expectation that you have developed using analytical procedure, whether that will help you in identifying a material misstatement or not, that depends on what factors that you have to determine. So this directly will not be able to understand. Let me give you an analogy to make you understand this. Let me give you an example to make you understand this. So what they're exactly trying to say is whatever expectation that you have developed, by performing analytical procedures, whether that expectation will help you to identify material misstatement or that will not help you to identify a material misstatement, that depends on what factors. So what exactly they are trying to say here is they are telling expectation that we have developed using analytical procedure. What do you mean by this? What exactly they are talking about? See, when they say expectation here, they're talking about by performing analytical procedures, by studying the relationship. Take for example, we found some deviation. By performing analytical procedures, we found some deviation. For example, we did comparison. We calculated gross profit of the current year. We calculated gross profit of the previous year. We did the comparison. We got a deviation. The moment we get a deviation, what expectation we will have? If you find a deviation or fluctuation in the relationships, what expectation generally you will have? So what expectation we will have is when we analyze, when we investigate this deviation further, we expect that we might identify a material misstatement. When you find out a deviation or fluctuation by studying the relationship, when you find out any deviation or fluctuation, generally we will have an expectation that if we investigate that deviation further, we will be able to find out material misstatement. This is what the expectation which we will generally have. But sometimes what will happen is, so when you further investigate that deviation, with that expectation, two outcomes could be possible. You have done the investigation of that deviation and you have found a material misstatement. Very good. This is a good option. You have investigated that differences further, whatever difference you have found, whatever deviation you have found, you have investigated that further and you are lucky enough, you have found the material misstatement. And in some cases, what will happen is you will do that investigation of that deviation, whatever you have found out, but you will end up realizing that till now you are doing the wrong analysis. You should not have done this relationship. You should not have done this study of the relationship in that particular matter. So when you find out a deviation or fluctuation by doing the comparison, when you investigate that deviation, two outcomes could be possible. Sometimes you investigate that deviation and you find out material misstatement. Very good. That is a good position. But in some cases, what will happen is we will investigate that deviation, we will investigate that fluctuation further, but we realize at the end, we will realize that till now we are doing the wrong analysis. We should not have did this comparison. So which one is better scenario? See, if you investigate and if you find out the misstatement, that will be a better scenario. If you have done the investigation and later if you realize it that, oh God, I have done till now wrong analysis, I should not have done this analysis. If you realize it after completing the entire analytical procedures, that means all your time has been wasted. So if you investigate that further, whatever expectation that you have developed by performing analytical procedures, whether from that expectation will you be able to find out material misstatement, or will the auditor end up doing wrong analysis, that depends on what factors, or that depends on what matters. If you found any deviation or fluctuation, by investigating that fluctuation or deviation, whether you will be able to find out a material misstatement, or you will end up doing wrong analysis, that depends on what factors. I will tell you in a very simple way. First, if we understand at least one point now, then this question will become clear for you. Take for example, what I am doing is I am conducting audit of Tata Motors. Now for this is my client company. For this Tata Motors, I want to perform some analytical procedures. See, what I have done is I have calculated gross profit percentage of Tata Motors. So gross profit percentage of my client company is 50%. I wanted to do the comparison. I want to do inter-firm comparison. So I want to find out which another entity is there which is in the same line of business. I found that Maruti Suzuki is there, which is almost in the same line of business. See, both Tata Motors and Maruti Suzuki, they are into the business of selling automobiles. And if the car is having certain features in Tata Motors, which is selling at 10 lakh rupees, the car with same features in the Maruti Suzuki also more or less will have the same price. So the point which I want to say here is Tata Motors and Maruti Suzuki both are maintaining constant selling price. And even the raw material cost is also more or less same. Whatever raw material they will use for the manufacturing of these cars, raw material cost is also same. And even there are some common suppliers who supply the raw material to the Tata Motors also, who supply the raw material to Maruti Suzuki also. So they will maintain uniform selling price. They will maintain uniform cost also. That means more or less gross profit percentage should be same for both the entities. More or less gross profit percentage should be same for the both entities. Since they are maintaining same selling price, since they are maintaining the same cost, gross profit margin I can predict it easily. That means in the gross profit margin, I can easily predict on the basis of one entity, I can predict another entity's gross profit margin. Why? Because both are into same line of business, both are maintaining uniform selling price, both are maintaining uniform cost. So if I know one entity's gross profit margin, I can easily predict Maruti Suzuki's gross profit margin also. So why? Because gross profit is more predictable. Why? Because they maintain uniform selling price, they maintain uniform cost. So gross profit is more predictable. So I calculated my client's gross profit is 50% Tata Motors. When I calculated the gross profit of the Maruti Suzuki, I came to know Maruti Suzuki was making only 35% of the gross margin, but my client who is in the same line of business, he is making 50% of the gross margin. So when I did this comparison, I found that there is a misstatement, 15% of difference is there. Now if I investigate this difference, you tell me, is there a more chance of identifying misstatement, or will I end up doing wrong analysis? In this case, there is a more chance of identifying a material misstatement. Why? Because gross profit is more predictable. Since two entities are in the same line of business, their gross profit is having more relationship, their gross profit is more predictable. So if I perform analytical procedures on the gross profit, there if I get a deviation, if I investigate further, the chances of identifying misstatement are more than ending up with the wrong analysis. Let me tell you one more analysis I am doing. What I am doing is, in the case of Tata Motors, I want to perform analytical procedure on one more item. See, what I have done is I have calculated one ratio. I calculated research and development expenditure as a percentage of sales. Tata Motors research and development expenditure I have found out, and that research and development expenditure I have divided it by the sales figure, and I have determined what is the percentage of research and development expenditure on the total sales. Assume that Tata Motors is having total 100 crore rupees of revenue. Out of that, 2 crores they have spent on research and development expenditure. That means 2%. So like this, what I have done is, from the financial statements of Tata Motors, I have calculated research and development expenses as a percentage of total revenue. I came to know that ratio, when calculated for the Tata Motors, the ratio has come to 20%. Not 20%, that will be very high, 8%. So I came to know Tata Motors is spending 8% of the total revenue or research and development expenditure. When I calculated the same ratio for Maruti Suzuki, I came to know that Maruti Suzuki is spending only 2% on the research and development expenditure. Out of the total revenue, they are spending only 2% of the revenue expenditure. Now, when I did this comparison, I found a deviation, huge deviation I have found out. Competitor is spending only 2%, my client company is spending 8%. Huge difference is there. I found deviation. If I investigate this difference further, you tell me, is there more chance for identifying material misstatement, or I will end up doing wrong analysis? What are the chances for which are very higher? In the second case, the chances for identifying material misstatement are very low, whereas the chances of ending up with the wrong analysis is very high. Why? Because you are performing analytical procedures on certain item which is not predictable. Research and development expenditure generally will not be predictable. Why? Because it is a discretionary expenditure. It is up to the choice of the company. For example, here you got this deviation. If you investigate that further, what management will say? If I go to my client's management and say, sir, you are spending 8% of your revenue on research and development. Your competitor is spending only 2% of money on research and development expenditure. Huge difference. Explain me the reasons. What the management will say? My money, my wish. The management will say, my money, sir, I'm more concerned with the future. That's why I'm spending a lot of money on my research and development expenditure. The future is electronic vehicle segment. We Tata Motors have already released the vehicles in the market with EV facility, but Maruti Suzuki, they are not concerned with the future. They have not even invested a single rupee on research and development expenditure, and even they did not scratch the surface of the EV segment. Valid reason. So here, who is wrong? Auditor is doing wrong analysis here. So here, if you perform analytical procedures on these kind of items like research and development expenditure or advertisement expenditure, these are generally discretionary expenditures. They are generally not predictable. When I say not predictable, it means they don't have any relationship with other items. So if you perform analytical procedures on these items, here even if you find a deviation also, the more chances that you will end up doing wrong analysis than you find a material misstatement. Whereas on the other hand, if you perform analytical procedures on gross profit percentage, which is generally more predictable, which is generally more relatable, there if you find deviation, there are more chances for identifying material misstatement. So number one matter which auditor will consider in determining whether the expectation will be helping the auditor to identify a misstatement or not. To take that decision, first factor which auditor will consider is accuracy with which the expected results of substantive analytical procedures can be predicted. The more predictability is there, the more chances you will find out material misstatement. Lesser the predictability, less chances for identifying the material misstatement. Like gross profit is more predictable. In the gross profit, if you find deviation and if you investigate that further, more chances for identifying material misstatement. If you perform analytical procedures on less predictable items like research and development expenditure, advertisement expenses, there are more chances that you will end up doing wrong analysis. That is the first one. Second one more matter which will help us to determine whether our expectation will help us to identify material misstatement or we will end up doing wrong analysis. That also depends on one more factor, which is the degree to which the information can be disaggregated, the degree to which you can separate the information of the organization. So what exactly they are trying to say here, I will tell you. Take for example Reliance Industries Limited. See, we know Reliance Industries Limited is a conglomerate. It is there into petroleum segment also, petroleum business. It is there into retail segment. It is there into telecommunication business. It is also there into fashion segment. So like that, Reliance Industries Limited is having multiple kinds of businesses. But even after these many businesses also, still more than 50% of the revenue Reliance is making from petroleum business only. Reliance is having so many multiple kinds of businesses. They are into retail segment, they are into food segment, they are into telecommunication, they are into fashion segment. But even today also, more than 50% of the revenue Reliance is getting from petroleum products. So major business of Reliance Industries Limited is petroleum products. Now what I am doing is I calculated gross profit percentage of entire Reliance company. I calculated gross profit percentage of entire Reliance Industries Limited. I came to know gross profit of entire Reliance Industries Limited is 40%. I want to do the comparison. What I have done is I have taken Indian Oil Corporation Limited, IOCL company I have taken. See, IOCL is into petroleum business. So what I have done is IOCL company's gross profit I have calculated. IOCL was able to make 60% of the gross profit. So if I did the comparison, here I found a deviation. If I did the comparison, I got a deviation here. Now if I investigate this deviation further, you tell me I will end up doing wrong analysis or I will find out material misstatement. There are chances for identifying misstatement are very low. Here I am actually ending up doing wrong analysis. Why? Because Reliance is a conglomerate, even though petroleum is the main business, but we are calculating the gross profit for the entire company. That means for entire businesses collectively we calculated gross profit. Whereas Indian Oil Corporation is a company which is only into petroleum products. Now if I did this kind of analysis, you tell me I will end up doing wrong analysis or I will identify misstatement. You will end up doing wrong analysis. On the other hand, if I am able to divide the information, if I'm able to divide financial information for each business separately, like for example, I have calculated for petroleum business, I have separated all the information regarding petroleum business. I came to know for petroleum business, gross profit margin is 50%. For retail, it is some other percentage. So like that, what I have done is for each business, I have identified the information, I have separated the information. Now, whatever gross profit which Reliance is making from the petroleum business, that if I compare it with the Indian Oil Corporation's gross profit, and if I investigate that further, the chances for me to identify the material misstatement are very higher than ending up with the wrong analysis. Clear, everybody? So in case if you are performing analytical procedures on a diversified entity, instead of performing analytical procedures on whole data, if you are able to separate the information business wise and then do the comparison, then the chances for identifying material misstatement are very higher. On the other hand, if you perform analytical procedures on company as a whole, in case of diversified entity, then you will end up doing wrong analysis. So one more factor which will decide whether expectation developed by the auditor will help in identifying material misstatement or not is the degree to which information can be segregated. To what extent you can separate the information. If you are able to separate the information and perform analytical procedures, more chances you will identify misstatement. If you don't separate the information, perform analytical procedures on entire diversified company, then less chances you will find out misstatement, more chances you will end up doing wrong analysis. And one more factor which will decide this is the availability of the information of both financial and non-financial data. See, if you are performing analytical procedures on the basis of completely available data, there if you get deviation, the chances for identifying misstatement are very higher. On the other hand, if you perform analytical procedures on non-available data or incomplete data, then the chances for ending up with wrong analysis is much higher. What I'm trying to say here. Let me take an example to make you understand this. Take for example, I'm calculated gross. I want to do the comparison of the gross profit. For example, I'm conducting audit of some client X Limited. For this client, I have complete information available. All the 12 months of information I have available. I calculated gross profit percentage of my client on the basis of 12 months of data. I want to compare this information with my competitors' data. Take for example, some competitor is there who is Y Limited. Now, when it comes to this competitor, I don't have complete information. For the competitor, I have only 6 months of data. So what I have done is I have calculated gross profit of my competitor on the basis of 6 months of data. So when I calculated gross profit of my client on the basis of completely available data, I got to know that my client's gross profit is 50%. On the other hand, I don't have complete information. Whatever information I have, that is on the basis of 6 months of data only, I calculated gross profit percentage. There I came to know that for 6 months, the gross profit margin is 35% only. Now I did the comparison. I found a deviation. If I investigate that deviation further, tell me, you will end up doing wrong analysis or you will find out material misstatement. Here you will not find out material misstatement. You will end up doing wrong analysis. Why wrong analysis? Why? Because you are performing analytical procedures on the basis of incomplete data. On the other hand, if you would have complete data, for example, your client's data also for entire 12 months you have, for competitor also you have complete 12 months of data, and you calculated gross profit, then you did the comparison, then you find the deviation. If you investigate that further, then there are more chances for identifying material misstatement than ending up with the wrong analysis. So that is what the third point here actually. So the one more factor which will decide whether the expectation developed using analytical procedures will help you in finding out material misstatement or not is availability of information. If you have completely available information, then if you find deviation, then there is a more chance for identifying material misstatement. On the other hand, if you perform analytical procedures on incomplete data, there even if you find the deviation, you will not be able to find out material misstatement. There are more chances for ending up with the wrong analysis. So that is the third step which auditor has to do. The auditor has to consider these three factors and evaluate whether expectation developed. Are you doing wrong analysis or you are in the right direction? That you have to determine. That is the third step actually. In summary, that is what I can simply put it. So that is the third step. So we are done with 3 steps. So what I have told, if you want to perform analytical procedure as a substantive audit procedure, it involves 4 steps. First one, we will determine the suitability of analytical procedure. Number 2, we will evaluate the data which we are using for performing analytical procedures. Is it reliable or not? Then third one, we will decide whether expectation that we have using in performing analytical procedures that will help us in identifying material misstatement or we will end up doing wrong analysis. And finally, the last step is whatever deviations that you have found that you have to do further investigation. What is the last step? As I have told, the moment you find a deviation, you should not immediately jump to the conclusion that it is because of material misstatement. You need to do the further investigation and then determine, is that deviation because of a valid and genuine reason or is it because of a material misstatement? Sir, how I will investigate, sir? Very simple. How you will investigate? So whatever differences you have found, you will go and inquire with the management. You will go and ask the management, sir, these are deviations I have found, please tell me what are the reasons for that deviation. If the management gives the responses, well and good, but sometimes management will not give you appropriate responses, or management will not give you response at all. So if the management is not properly responding to your inquiries, then you will perform additional audit procedures or alternative audit procedures. If alternative audit procedures are also not possible, then the auditor will modify. So this is how you are supposed to investigate. So if you find any deviation, first we will go and inquire with the management. If the management gives valid answers, well and good. If the management is not giving valid answers, or if the management is giving inappropriate responses, then we will try to perform alternative or additional audit procedures. And if that is also not helping you to obtain audit evidence, then we will finally express the modified opinion. Clear? So this is what the important content from this chapter, analytical procedures. Hope you guys have understood it. I might not have covered the entire analytical procedures chapter, but conceptual discussion, whatever is very, very important, that conceptual discussion I have covered it. Clear, everybody? So with this, we will wind up the revision of analytical procedures. So the next chapter which we'll be taking up for revision will be Audit of Banks. So previously, just now, we are done with revising the chapter Analytical Procedures. In fact, in the chapter Analytical Procedures, we are done with the revision of SA 520. So after this chapter Analytical Procedures, we are going to now revise the content from Audit of Banks. So once again, important chapter from the examination perspective, compulsory question will be there from the Audit of Banks. For sure, there will be a question from this chapter Audit of Banks. But when I compare with the previous two chapters, see the immediately previous two chapters which we have revised is audit sampling we have revised, and after that analytical procedures we have revised. So when it comes to audit sampling and analytical procedures, the content of this chapter is actually very small, very limited content. So comparatively, if you compare it with other chapters, audit sampling contains limited number of questions, limited number of concepts. We have revised in no time. Similarly, analytical procedures, the immediate chapter which we have completed just now, the analytical procedures is also a very small concept, limited number of questions. We are also done with that revision. So when compared with this previous two chapters, the chapter Audit of Banks is going to be a little bit bigger. Not extremely bigger. So but when I do a comparison between the previous two chapters which we have revised and the chapter which we are going to revise now, Audit of Banks, is comparatively a little bit bigger. So the number of questions will be bigger. So now what we'll be doing is, as a part of this revision, we will try to cover the important content from this chapter Audit of Banks. So whatever content that is very conceptual, that is very important from the examination perspective, that we'll be focusing and we'll be trying to cover as a part of this revision. So having said that, let us directly jump into the concepts relating to Audit of Banks. First of all, what exactly this chapter will teach us? From the name itself, it is very clear. This chapter is going to teach us about how to conduct audit of banks. In case if you are getting appointed as auditor of a bank, so as we all know, the banks play a crucial factor. The banks play a crucial role in the development of any economy. Even in India, in the developing countries, the role of banks is even much higher. So what kind of activities banks will do? When we call an entity as a bank, we call an entity as a banking company or bank if it fulfills two conditions. Number one, it is in the business of accepting the deposits and also giving loans. So when an organization is doing both the activities of accepting deposits and giving loans, then that entity we are going to call it as a bank. Do you think banks also require audit? 100%. Than any other organization, the requirement of audit in banks is very high. Why? Because they are dealing with the public money. And also, if you pay close attention, banks are considered as place of trust. Like for example, if you have some excess money, if I am asking you that money, say, hey, you give me the money, I will keep it safe. Will you give that money to me, or will you go and deposit it with the banker? You will definitely go and deposit with the banker. Why? Because banks carry that trust factor. And also, banks are subject to high reputational risk. If some bad news starts circulating about any bank, it creates a lot of panic among its bank holders, account holders, and it will create a havoc for that customers. So that's why banks involve a lot of reputational risk, because these are the organizations which people commonly place a lot of trust on them. So if something bad news starts coming about some bank, it will have very huge consequences. So that's why, then compared with any other organization, in case of banks, the importance of audit is manifold. The importance of audit is very high in case of banks than when compared with other organizations. So in this chapter, we are going to talk about how to conduct audit of banks. But let me tell you one thing: this chapter talks very limited on audit related matters. This chapter talks more about functions and activities of the bank. In this particular chapter, even though the title is Audit of Banks, very limited number of questions you will be able to find relating to audit. More questions you will be able to find regarding the functions, operating activities of the bank. So without any delay further, let us try to understand. So first thing, as you could see here, you will be able to find something called peculiar features of the bank. What are the key features of the bank? What are the distinguishing features of the bank? How we can, what features differentiate the banks from other entities? Number one, as you could see, it involves huge volumes of transactions, and complexity of transactions is very high today in the banking system, thanks to this UPI systems and all. So today the volume of the transactions which are taking place through the banking channel is beyond our imagination, and even complexity of the transactions and the back end is getting very higher. And also wide geographical spread of banks network. Today banks are spread across every nook and corner of the country, and not just in the country, even our banks are having branches, Indian banks are having branches even in abroad also. And also it is having large range of products and services. Banks offer different kinds of products. In the loans itself, you will be able to find different categories of loans: home loans, personal loans, education loans, vehicle loans. So numerous products will be there. Even in the case of acceptance of deposits, term deposit, saving deposit, fixed deposit, so numerous kinds of products and services will be offered. And they make extensive use of technology. Today the biggest users of technology, the industry which is making extensive use of technology, is banking industry. We can't imagine even a single transaction without the technology in the today's banking environment. And also strict vigilance by the banking regulator. Who is that? Strict vigilance means what? Strict monitoring. Someone is continuously monitoring that banking functions. A regulator is monitoring all the functions of the banks. So who is that regulator in our India? RBI is the regulator of that banks in India. So there is a strict vigilance by the banking regulator. So these are the important features of the bank. Now if we talk about what are the various categories of the bank, what are the different kinds of banks, depending on the operations whatever they are doing, depending on the people whom they are serving, depending upon the facilities they are providing, banks can be divided into 6 different categories. So those 6 different categories are: number 1, commercial banks; number 2, RRBs; number 3, cooperative banks; then we have payments bank; then we have development banks; and also small finance bank. So on what basis they have did this classification? They did this classification on the basis of functions they are performing, on the basis of activities they are doing, on the basis of customers whom they are serving. Like first talking about commercial bank. Sir, what do you mean by commercial bank? See, all the banks whatever we have today are commercial banks, which are those banks which are into the business of accepting deposits and giving loans with the intention of making profit from that differential interest component. Like for example, when they are accepting the deposits from the public, they pay interest of some 4 to 6%, but they when they give the loans to the public, they give the loans at the rate of 8% to 15%. So any bank which is into the business of giving loans and accepting deposits with the intention of making profit from that differential interest, all that will fall under commercial banks. Today all the banks are commercial banks. Then we have one more category of banks, which is regional rural banks. In short, we call them as RRBs also. Sir, what are these RRBs? The name itself says these are the banks which are incorporated to meet the banking needs of the people in the rural areas. Those banks which are incorporated to meet the to fulfill the banking needs of the people in the rural areas, that we call them as regional rural banks. So then what are cooperative banks? Cooperative banks are nothing but cooperative credit societies. See, the difference between a normal bank and a cooperative bank is, in case of a normal bank, they will accept deposit from everybody. They will give loans to everybody. There is no restriction. But what will happen in the cooperative banks is, in the case of cooperative banks, they will also accept deposits. They will also give loans, but not to the common public, but not to everybody, to only their members. There will be certain members of cooperative societies. Only to their members they will give the loans and accept deposits. Like we will have some cooperative banks which will give loans and accept deposits only from the farmers. There will be certain cooperative banks which will serve the finance needs of only members who will be like small scale industries. So that is what the key difference between a normal commercial bank and a cooperative bank. The difference is normal banks will address the banking needs of everybody, but these cooperative banks, they also accept deposits, give the loans, but only to their members. Next one, payments bank. These are the recent kind of banks which are innovated. These are the recent banks which are introduced by RBI. So what are these payments bank? First I will give you example. Today we have some new products like Paytm Payments Bank, Airtel Bank, Airtel Money. These kind of things whatever we are saying, these are actually payments bank. Sir, what are the payments bank? Payments bank are, as you could see here, these are new type of banks which have been recently introduced by RBI. Sir, what activities they will do? They can accept only restricted deposits. Only certain amount of restricted deposits like 2000 rupees, this much restricted deposits only they can accept. But these payments bank cannot issue loans and credit cards. These payments bank, they will only accept deposits, that to restricted deposits, but they are not permitted to give loans and credit cards. Examples are this examples like Airtel Payments Bank, Indian Post Payments Bank, Paytm Payments Bank. So all these are examples of the payments bank. Then we have development banks. Sir, what are these development banks? See, these development banks also are those banks which will accept deposits and give the loans, but they will fulfill the banking needs of only industries which are into infrastructure development and all. Like if you see this terminology here, these banks has been conceptualized to provide funds for infrastructural facilities important for the economic growth of the country. Like for example, you will find somewhere IDBI bank. You'll be able to find at various places IDBI. So if you go to IDBI, if you go to the IDBI bank, IDBI is actually a development bank. If you go to the IDBI bank and say, yeah, I am a salaried employee, I have good returns and all, so please give me housing loan. IDBI will say, we will not give you housing loan. Then why the bank is there, sir? IDBI is not there for the purpose of meeting the banking requirements of persons like you and me. They will give loans, they will provide the credit facilities to these bigger companies who are into infrastructure development, like construction companies, IT companies. So they will provide their banking facilities only to those sectors, only to those industries which are very important for the economic growth of the country. So one example is that IDBI. Then we have small finance banks. These are the banks which have been set up with the objective to meet the banking facilities of unserved or unorganized sectors of the country. So in India, we have so many unorganized sectors, like for example, matchbox industry, handloom industry. So these are the industries which are very much unorganized. When I say unorganized, they will not have proper IT returns. They will not have proper sources of income. They will not have proper recognition. So for these sectors like this matchbox industry, for like this handloom industry, it is very difficult for them to get the loans and accounts with normal commercial banks. So in order to exclusively meet the banking requirements of this unserved or unorganized sectors, another kind of banks were set up, which we call them as small finance banks. So like this, on the basis of the operations which the banks are doing, we can divide the banks into total 6 categories. Number 1, commercial banks. Number 2, RRBs. Number 3, cooperative banks. Number 4, payments bank. Number 5, development bank. And number 6, small finance bank. Next, sir, who will regulate the banking sector in India? In India, as I have told, there is a strict vigilance by some regulator. Who will regulate that banking sector? In India, banking sector is regulated by RBI. There is one regulator who is RBI. So RBI is going to regulate the banking sector. Now, how the RBI will regulate the banking sector, sir? How RBI will control the banking sector? So how RBI will regulate the banking sector is, number 1, it is a issuer of banking license. If someone wants to carry out a banking business in India, or even an existing bank want to open a new branch, they can do it only after getting license from RBI. Only after getting license from RBI. So no one can open a bank, or no existing bank can open a new branch without getting license from RBI. Number 2, RBI is a banker's bank. Sir, why it is banker's bank? For example, if we need loan, we go to bank. What if bank needs loan? They will go to RBI. If we have excess funds, we go to bank for depositing. If banks have excess funds, where they will go and deposit? With the RBI. So that's why we call RBI as banker's bank. And even RBI is having the power to determine CRR ratio, SLR ratio. Like every bank is required to maintain certain percent of their money in specified investments, or as they have to deposit certain percentage of money with the bank, which we generally call it as CRR SLR ratios. Sir, who will determine how much percentage CRR should be there, how much percentage SLR should be there? This will be decided by whom? Once again, RBI. Next one, power to inspect any bank. RBI is having exclusive power to inspect any bank, any branch, even without giving prior intimation. All of a sudden, RBI officials can go and do the inspection of any bank. Then it will supply and control the credit. RBI, through its fiscal policies, by changing this repo rate, reverse repo rate, they will even supply the money or control the money in the economy by through their fiscal policies. And even prudential norms also will be prescribed by RBI, which means in the accounts, you might have learned, in the case of banks, certain in some cases accounts are required to be classified into NPAs. In the NPAs also different categories. You will have substandard, doubtful, loss, and there is certain criteria. So when asset will be classified as substandard, when asset will be classified as doubtful, when asset will be classified as loss, and for each category of NPA, provision percentage is also mentioned. Who do you think has mentioned us all this? If it remains overdue for these many days, classified as substandard, and for substandard, create this much amount of provision. This we call it as prudential norms. Who will decide these prudential norms? Once again, RBI is going to make the decision regarding prudential norms when it comes to classification of assets and creation of provisions. And also, RBI will try to ensure good corporate governance. RBI will try to maintain good management in the banks. How RBI will try to maintain good corporate governance in the banks? They decide efficient proper criteria who can become directors of the bank. Like in any other company, just like anybody cannot become a director of a bank, RBI has given perfect criteria. Only those people who fulfill that criteria, they can only become the directors of the bank. So RBI has given specific criteria. And also, in case if the RBI feels that the transactions of certain banks are suspicious, what RBI can do is they can appoint their representative as a board of director in the board of that respective bank. Like in the S Bank management, in the S Bank board of directors, there are some board of directors who are representatives of RBI, who will be board of directors of S Bank. And also in the case of RBL Bank, not RBI guys, there is a bank called RBL Bank. Even in the board of directors team of RBL, there are some representatives of RBI who has been fulfilling their functions as board of directors. So in case if the RBI finds something is wrong happening in the functions of the bank, in that bank's board of directors, they will appoint their representatives. So this is how RBI is going to regulate the banking sector. In these many ways, they will regulate by issuing banking license, but they act as a banker's bank, they determine CRR, SLR, they have power to inspect any bank, they are a supplier of money and controller of credits, they determine prudential norms, and they ensure the good corporate governance. Clear? Next, sir, what is a regulatory framework? Regulatory framework means nothing but what laws and regulations will become applicable for the banks. In case if you want to run a bank in the country, it is not going to be an easy task. There are numerous laws and regulations which you are required to comply with. The list of laws and regulations are given here. There is no concept. So just list is there. Like banks have to comply with Banking Regulation Act. They have to comply with RBI Act. If it is a company, they have to comply with the Companies Act. For SBI, there is altogether a separate act. SBI Act we have. Then we have Banking Companies Acquisition and Transfer of Undertakings Act. And then we have SARFAESI Act. Then we have something called RRBs. For RRBs, separate act is there. Regional Rural Banks Act is there. And also information technology. Since today banks are making extensive use of technology, even they are required to comply with Information Technology Act. And even prevention of money laundering. Nothing but banks should be prevented from doing Hawala transactions and all. To punish the banks in these cases, even PMLA Act is also there. Credit Information Companies Regulation Act. Today banks are offering credit scores and all. To regulate that credit score mechanism, we have this Credit Information Companies Regulation Act, and even Payment and Settlement System Act. So like this, banks are required to work under strict regulatory environment. These many laws and regulations the banks have to comply as a part of their day-to-day operation. So if they ask you the question, what is regulatory framework? In the case of banks, you have to reproduce all this laws. Next, on the basis of level of computerization, banks are divided into three categories. On the basis of usage of information technology, on the basis of computerization which has taken place in the case of banks are divided into three categories. Non-computerized, partially computerized, fully computerized. The name itself says non-computerized. Those banks which are still doing their transactions in a manual way without usage of systems, that we call it as non-computerized banks. Today we don't have any such banks in our country. Then we have fully computerized. What is fully computerized? Those banks which are completely relying on the technology, and they make use of softwares like core banking solutions. CBS means core banking solutions. Those banks which are completely doing their operations with the help of a robust software mechanism like core banking solution softwares, those banks we are going to call them as fully computerized banks. Today most of the modern day banks are fully computerized. Like you take Axis Bank, ICICI Bank, HDFC, these are all fully computerized banks. Then we have in between one category partially computerized banks, which means what? Only a few transactions are computerized while major transactions are happening in a non-computerized manner. That means half-half. So only some transactions are computerized, some other transactions are happening in a manual way. We have some banks in India under this category, some cooperative banks are there which are still falling under that partially computerized banks. But in India, we don't have now this non-computerized banks in India. Clear, everybody? Able to understand? So we are done with 4 concepts from this Audit of Banks till now. Let us now proceed further with the remaining concepts from this chapter, Audit of Banks. So question number 5 is going to be very important. This is the question in which most of the times the question has been tested in the examination. So this is a major question from which majority of the cases you will be able to find the question from this particular chapter. So what is this question number 5 about? Question number 5 actually talks about special NPA norms in case of some special cases. So generally we have basic NPA norms. If the account remains overdue for more than 90 days, classified as substandard. So all that things classified as NPA and all. So those are actually regular NPA norms. But here they have mentioned some 8 special cases where NPA norms are going to be a bit different. Regular NPA norms we don't follow. We follow different NPA norms in 8 special cases. So what are that 8 special cases they have listed down here? So let us try to understand what are that 8 special cases and what will be the NPA norms in case of that 8 special cases. We'll try to understand that. So very important question, guys. At least one point they will pick, at least one case they will pick and they will pose it as a question. So let us try to proceed ahead.
First case, accounts regularized near about the balance sheet date. So what is this accounts regularized near the balance sheet date? So regularized means made good. What do you mean by regularized? Made good. So accounts which are made good close to the balance sheet date. See, generally we know that if an account remains overdue for more than 90 days, that account has to be classified as NPA as per the regular rules. But bank managers, especially branch managers, don't want to classify their accounts as NPA, don't want to classify the accounts in their branch as NPA. Why the branch managers don't want to do this is, in case if there are more accounts in their particular branch which are classified under NPA, that means that branch performance is not good. If the branch performance is not good, then that concerned branch managers and the bank staff will not get the increments as expected. So what some managers will try to do is they will try to play some cheap tricks. What exactly they will try to do is, an account will remain overdue for more than 90 days, but in order to avoid classification of that into NPA, an account will remain overdue, but in order to avoid that account from being classified as NPA, what they will do is, close to the balance sheet date, they will try to record fake credit entries. They will record as if the payment has been received close to the balance sheet date. In the last 5 days of the balance, in the last 5 days of the financial year, they will record a payment entry, but actually customer will not pay, the bank staff will do it. Why, sir? If you record an entry, then an account will not remain overdue for more than 90 days, then NPA will not be that account will not be classified as NPA. Then what they do is, immediately after the closure of the financial year, in the next year, they will reverse that entry. So some managers will try to play these cheap tricks in order to avoid the accounts from being classifying it as NPA, so that branch performance will be good, so that they will get increments as expected. So those kind of accounts, I call them as accounts regularized near about the balance sheet date. You have to be very careful while verifying these accounts. In case if you find that there is one entry close to the balance sheet date, if you have any suspicion, you have to inquire that into detailed manner. In case if you found that that entry was fake credit entry, you should ask the concerned manager, no sir, I will not accept this as a valid entry. You have to classify it as NPA. In case if the branch manager is not accepting to classify it as NPA, you have to give a modified opinion. Able to understand? So that's all even they try to say here. So what do you mean by accounts regularized near about the balance sheet date? These accounts with a few credits received just before the balance sheet date. Immediately close to the balance sheet date, you are receiving the few credit entries. These accounts should be handled with care. If the account indicates inherent weakness, you should insist that the account should be deemed to be a NPA. You should insist the management, no, I will not accept this classification. You have to classify it as NPA. Sir, what if the branch manager doesn't agree? Give a modified opinion. Next one, government guaranteed advances. Now, sometimes what will happen is customers will come to the bank, they will ask for the loan, they will give the loan. For example, SBI has given a loan to some company X Limited, but it is a central government guaranteed advances. What do you mean by central government guaranteed advances? The bank has given the loan to X Limited, and the central government is giving a guarantee that in case if X Limited fails to repay the loan, we central government will repay the loan to you. So that is what the meaning of central government guaranteed advances. Some customer has taken the loan, but central government stood as a guarantor for that loan. So generally, when the account remains overdue for more than 90 days, it will be classified as NPA. But that rule doesn't apply here in the case of central government guaranteed advances. So Banking Regulation Act told that in case if there is a central government, in case if the advance is guaranteed by central government, even though the account remains overdue for more than 90 days, it will not be classified under NPA. It will still remain in the standard category only. Why? Because central government guarantee is there, no? So that's why Banking Regulation Act told the banks, in case if there is a central government guaranteed advances, even though if it remains overdue for more than 90 days, you need not classify it as NPA for asset classification. That means for asset classification, it will remain in the standard category only, but income recognition will happen treating it as NPA. That means even though if the central government guaranteed advances is kept under standard category, we will recognize the interest income only on cash basis. Generally, in case of standard asset, you can recognize the income on accrual basis, but this is a special case. In the case of central government guaranteed advances, that advance for asset classification, it will remain in the standard category only, but for income recognition, it will be treated as NPA. That means even though this particular advance will remain in the standard category, income will be recognized only on cash basis, not on accrual basis. Sir, what if the state government has given guarantee? In case state government, if the advance is guaranteed by state government, then there is no special treatment. It will be treated and it will be classified under normal NPA norms only. So if the state government has given guarantee, no special privilege. Only the special privilege is there when the guarantee has been given by central government. Next one. Third point is about advances under consortium. First of all, we have to understand what do you mean by advances under consortium. Sometimes we also call it as consortium advances. So what exactly is the meaning of consortium advances? Take for example, Reliance Industries Limited. It has approached SBI. Sir, dear SBI, we need 1000 crore rupees of loan. We need 1000 crore rupees of loan. SBI knows that Reliance Industries Limited is a reliable customer. They have a repaying capability. They want to have the business relationship, but they don't want to take this much exposure. They want to take entire 1000 crores of risk. So SBI is ready to give 600 crores of loan, but Reliance Industries Limited is asking for 1000 crores of loan. So now what SBI has done is it has approached the other banks. For example, it has approached ICICI Bank, and they have convinced the ICICI Bank to give 200 crores of to give some 100 crores of loan. Okay, let us take 200 crores of loan to Reliance. Then they have approached some Axis Bank, and they have convinced Axis Bank to give 100 crores of loan. They thought PNB is suffering losses, let us help the PNB also. They went to the PNB and make them accept to give 100 crores of loan. Now SBI, along with all the 4 banks together, they have formed a group. That group we call it as consortium, and as a group they have handed over the loan of 1000 crore rupees to the Reliance Industries Limited. So now this we call it as consortium advances. This kind of advance we generally call it as what? Consortium advances, where a group of banks collectively give a loan to the customer. And in case of consortium advances, there will be generally one bank which will take the leadership, which we call it as a lead bank. Generally lead bank will be that bank which is having a highest share. In our given case, since SBI is having a highest share, SBI will be lead bank, remaining banks will be member banks. See, generally how the repayment will happen. In the case of consortium advances is there will be 2 options. Number 1, the customer, Reliance Industries Limited itself, will determine what is the amount of installment for each and every bank separately. For example, 100 crores of installment they have to pay. So now they will determine what is the amount of installment for each bank separately. They have decided 60 crores should go to SBI, 20 crores should go to ICICI, 10 crores should go to Axis, and the 10 crores should go to PNB. Generally what will happen is Reliance Industries Limited itself will make deposit of the amount with the respective banks on the due dates. In that cases, in case if one branch did not receive the payment, that bank will classify that particular account as NPA. In this case, there is no problem. When the customer is making the payment separately to each and every bank, there is no problem. But when the problem arises is, in some consortium advances, the agreement will be like the customer will pay entire installment amount to lead bank. In our case, lead bank is SBI. So customer is paying entire 100 crore rupees of loan to SBI. Now what lead bank should do is they have to keep their share. How much? 60 crores they have to keep their share, and balance amount they have to transfer it to members bank. For example, after keeping 60 crores, 20 crore rupees they have to transfer it to ICICI, 10 crore rupees they have to transfer it to Axis Bank, 10 crores they have to transfer it to PNB. But some cases what will happen is customer will make the payment of entire amount to lead bank, but lead bank will not transfer the share to member banks. Lead bank will not transfer the share to member banks. In case if the member bank has not received the payment on the due date and it remains overdue for more than 90 days, now what ICICI Bank will do is it will classify Reliance Industries Limited account as NPA. Why? Because they did not receive the payment. No. But do you think here Reliance mistake is there? No. Without their fault, they have made the payment of 100 crores to SBI. It is whose default? Lead bank's default. But even because of the lead bank's default also, unnecessarily customer account is getting classified as NPA. So in these cases, what they have given the permission is, in case if the members bank did not get the payment, at least if they get a confirmation from the lead bank that they have got the payment on behalf of the customer. That means customer has made the payment to the lead bank, but they are yet to transfer the money to the members bank. In that case, even though they did not receive the money, still they need not classify them as NPA. Why? Because here customer is honest, he has made the payment to lead bank. In case if you get confirmation, as a member bank, you did not get the money. But in case if you are able to get the confirmation from the lead bank that they have received the money on their behalf, then NPA classification could be avoided. So this is what the NPA norms in case of consortium advances. Very simple, guys. But these kind of repayments, very rarely it will be followed. In 90% of the cases, consortium advances will have this kind of repayment structure where the customer himself will deposit the proportionate amount to each and every members bank, each and every bank in the consortium. In that case, no issue at all. When the problem arises is customer is transferring the money to the lead bank, but lead bank is not transferring the share to the members bank. In that cases, there should be proper communication happening between lead bank and member bank. In case if the member bank got the confirmation that the lead bank has received the money on their behalf, they can avoid the NPA classification. Clear? Next one. So this is the third case. So 3 cases we have seen. Number 1, accounts regularized near about the balance sheet date. Then we have also seen about government guaranteed advances. Then we have seen advances under consortium. Now let us talk about accounts where there is a erosion in the value of security. Sir, what do you mean by erosion? Reduction in the value of the security. As we know, generally when a customer, when he goes to the bank for the purpose of loan, banker will give the loan only after asking for security. No banker will give you the loan looking at your face. For example, assume that I am a person, I need a loan from the bank. I have a property worth 1 crore rupees. So if I keep my 1 crore worth of property as a security, the banker will give loan. And you always know that the banker will not give the loan not even equal to the amount of security. They will always give the loan amount less than the value of the security. Assume that you have deposited the property worth, you have given 1 crore worth of property as a security, and the bank is giving you only 80 lakh rupees. So the value of the security should always be higher than the amount of loan given. That difference we call it as margin. The excess of that value of the security over the loan amount, that we call it as margin. So in the given case, value of the security is 1 crore, whereas the amount of loan given is 0.8 crore. So excess of the value of the security over the loan amount is 20 lakh rupees. This 20 lakh rupees, we call it as margin. Banks always keep that margin. So you are a customer, you have given your property as a security, and the banker has given you loan of 80 lakh rupees. But sometimes what will happen is, after you have given this particular asset as a security, there might be erosion in the value of the security. There might be what? Erosion. Sir, what do you mean by erosion? There might be reduction in the value of the security. Take, for example, whatever building that you have given as a security, in that locality there was a accident, there was some earthquake, because of that building got demolished. The value of the security will be reduced. So in that cases, what NPA norms will be applicable? In case the asset, whatever you have offered as a security for the purpose of loan to the banker, if there is a reduction, if there is a erosion in the value of the security, if there is a permanent reduction in the value of the security, then it will have a hit on NPA norms. How NPA norms will change? Let us see. So as a doubtful asset, so erosion means gradual reduction or diminution of something. And in case if there is an erosion in the value of the security, in some cases we have to classify it as a doubtful asset. In some cases we have to classify it as a loss asset. Sir, when we will classify it as a doubtful, when we will classify it as loss? Let us see it. If the realizable value of the security is less than 50% of the value assessed by the bank or accepted by the RBI at the time of last inspection, such assets may be straight away classified under doubtful category. So what they are telling, if the realizable value of the security is less than 50% of the previous value of that asset, less than 50% of the previously assessed value. Like if you take here, the value of the security was 1 crore. Previously, the value of the security was 1 crore. Now 50% of that value of the security means it will be 50 lakh rupees. Now, if the realizable value of the security is less than 50% of the previously assessed value, the previously assessed value was 1 crore. Because of diminution, because of erosion, the value of the security has come to less than 50 lakh rupees. For example, assume that if the realizable value of security is only 30 lakh rupees now. After that earthquake and all, that value of the property has become only 30 lakh rupees. So now the realizable value of the security is less than 50% of the previously assessed value. Then this entire 80 lakh rupees will be classified under doubtful category. Sir, when we will classify it as a loss asset, sir? If the realizable value of the security as assessed by the bank or approved valuer or RBI is less than 10% of the outstanding in the borrower's account. In case if the realizable value of the security is less than, 10% of outstanding amount, here you have to pay very close attention. Very, very important point, highly important for MCQs and true or false statements. So here, if you see here, for the purpose of doubtful asset, we have to compare the realizable value with previously assessed value. For the purpose of loss asset, we have to compare the value of the realizable value of the asset with outstanding amount in the customer's account. So outstanding amount, take for example, 80 lakh rupees is the outstanding amount. 10% means how much? 8 lakh rupees. So 10% of 80 lakh rupees of outstanding amount, which will come to 8 lakh. If the realizable value of the security is even less than 8 lakh rupees, for example, after that earthquake and all, now the value of the property is only 5 lakh. So since the realizable value of the security is less than 10% of the outstanding amount in the customer's account, then this entire 80 lakhs will be classified as loss asset and 100% of provision has to be created. Able to understand? Clear and comfortable, everybody? So this is what NPA norms in case if there is a erosion in the value of the security. Erosion means reduction in the value of the security. So if there is a reduction in the value of the security, we have to either classify it as doubtful or loss. When doubtful, if the realizable value of security is less than 50% of the previously assessed value. On the other hand, if the realizable value of the security is less than 10% of the outstanding amount, then as a loss asset. Next one, advances against term deposits, NSAs, KVPs or IVPs. So sometimes what will happen is customers will come and take the loan, and for that loan they will offer security as NSP, National Savings Certificates, Kisan Vikas Patras, Indira Vikas Patras, or fixed deposits. So these kind of assets, they will give it as a security and they get the loan from the banker. For example, a customer came, he's having fixed deposit worth 1 crore rupees with the bank. He offered that fixed deposit as a security and he got 80 lakh rupees of loan. Generally, if this account remains overdue for more than 90 days, it has to be classified as NPA. But what they say is, in respect of these assets, in case if the customer has taken loan giving security as fixed deposits, NSCs, KVPs or IVPs, even though they remain overdue for more than 90 days, no need to classify them as NPA. No need to classify them as NPA, provided the condition is adequate margin should be available. What should be available? Adequate margin in that account should be available. What is margin? Just in the previous case I have told, the excess of that value of the security over that loan amount, that we call it as margin. Till the time adequate margin is there, that account need not be classified as NPA. Sir, why this provision has been introduced? Why? Because fixed deposits, NSCs, KVPs and IVPs, these are risk-free investments and can be readily converted into cash. Here banks carry very lower risk. So take for example 80 lakhs of loan he has taken, 1 crore of fixed deposit he has given. He did not pay the installment. He did not pay. So interest accrued is 8 lakh rupees. So total amount outstanding is 88 lakh rupees. He did not pay the amount for more than 90 days. Is it required to be classified as NPA? No, not required. Why? Because there is still margin available. 1 crore is the security amount. 88 lakh rupees is outstanding amount. 12 lakh rupees of margin is there. No need to classify it as NPA. Now, next year also interest accrued. For example, next year also 10 lakh rupees of interest accrued. Now it became 98 lakh rupees of outstanding amount. Value of the security is 1 crore. Is it required to be classified as NPA? No. Why? Because still margin is available. Still 2 lakh rupees of margin is available. Next year on this 98 lakh rupees, some 12 lakh rupees of interest accrued. It become 110 lakh rupees. Value of the security is 1 crore only. Now margin has evaporated. Now there is no margin. Now this has to be classified as NPA. So till the time adequate margin is available, you need not classify that particular account as NPA. Understood? Next one. Now we will talk about agricultural advances. See, as we know, in the case of agricultural advances, NPA norms are going to be a bit different. Here we don't follow more than 90 days or all that conditions. In case of agricultural advances, NPA norms will be different. So for the purpose of NPA norms, we will classify agricultural advances into two categories. Agricultural advances given for long duration crops, agricultural advances given for short duration crops. Sir, what are agricultural advances given? First of all, what are long duration crops? Those crops which take a crop season of more than 1 year, that we call it as long duration crops. On the other hand, those crops which take a crop season of less than 1 year, we call it as short duration crops. What is crop season? Crop season means simply from the date of sowing the seeds till the date of harvesting. If the time period is whatever time period is there, that we call it as crop season. So if certain crop is taking a crop season of more than 1 year, that we call it as long duration crop. Other crops we call it as short duration crops. Bank might have given loan for long duration crops, or bank might have given loans for short duration crops. In case if the advance is given for long duration crops, that has to be classified as NPA only if it remains overdue for more than one crop season. More than one crop season. For example, if a crop is taking 13 months of duration, so and the bank has given loan for this crop, this loan has to be classified as NPA only if it remains overdue for more than one crop season. From the due date, if it remains overdue for more than 13 months, then only it will be classified as NPA. On the other hand, if the banker has given loan for short duration crops, that will be classified as NPA only when it remains overdue for more than 2 crop seasons. For example, if certain crop is taking 4 months of duration, then that loan will be classified as NPA if it remains overdue for 2 times of the crop season. That is, if it remains overdue for more than 8 months, then only it will be classified as NPA. So the NPA norms are going to be a bit different in the case of agricultural advances. Clear, everybody? So say short duration crops, a loan will be treated as NPA if the installment remains overdue for more than 2 crop seasons, whereas long duration crops, it will be treated as NPA if it remains overdue for more than 1 crop season. Understood, everybody? Now, most important thing is who will decide the crop season. Sir, what will be the crop season for each crop? Will it take 4 months, 5 months, 9 months, 10 months? Who will decide that crop season? Banker or farmer? Neither the banker nor the farmer. So that crop season has to be decided by state level bankers committee. In each state, there will be someone called state level bankers committee. In that committee, bankers also will be there. Farmers representatives also will be there. They will decide the crop season. That decision will be final. State level bankers committee will decide. Then we have agricultural advances affected by natural calamities. Sometimes banks will give loan to the farmers, but the crop will be affected by natural calamity because of floods and all. Crop will get affected. So if the crop is affected by natural calamity, will the farmer be able to give the loan? No. If the crop is affected by natural calamity, farmer will not be able to give the loan. He will not be able to repay the loan. Then what will happen? In that case, RBI has given power to banks to take relief measures. In case if the bank has given the loan to the farmer and the crop was affected by natural calamity, then the banks can take some relief measures. What kind of relief measures they will do? For example, they will extend the due date. They will convert the short-term loan into long-term loan, or they will give a new loan and collect the old loan and new loan after the new crop comes to hand. So whenever crops are affected by natural calamity, banks can take these kind of relief measures. Either they can extend the due date, or they can convert the short-term loan into long-term loan, or they will give a fresh loan and collect both the loans together. So when the relief measures are taken by this bank, in those cases, NPA norms will be decided on the basis of revised norms, not as per original norms. For example, earlier at the first time when the loan was given, due date is 31st of January. But the crop is affected by natural calamity. Because of that, banker has taken a relief measure. They have extended the due date to 31st of March. Now, if the amount is not paid as on 31st of January, which is previous due date, it will not be treated as NPA. Old norms will be ignored. What is the new due date? 31st of March. If the amount remains overdue after 31st of March, then only it will be classified as NPA. So simple thing is, in case if any relief measures are taken, NPA classification would be governed by rescheduled terms, not the original terms. Then we have one more point, advances to staff. See, sometimes what the banks will do is, banks will give loans to their employees also. For example, SBI bank manager is there, he need a housing loan. So what he has done is, this employee of SBI, he approached his employer only, SBI, and he asked the SBI to give the housing loan to him. So in these cases, the bank has given loan to its employee. That in case if the bank has given loan to its employee, will there be any special NPA norms available? No. The answer is no. Even if the bank has given a loan to its employees also, still no special NPA norms will become applicable. Whatever norms that are applicable in regular cases, same NPA norms will be applicable even if the loan has been given to employee. In case of normal housing loan, account will be classified as NPA if it remains overdue for more than 90 days. Same NPA norms will be followed even in the case of employees also. Understood? That is what the summary of this G point. Clear? So these are the 8 special cases where we have to be a little bit careful about NPA norms. Hope you guys have understood this. So let us now proceed further with the next concept from this chapter. So the next concept which we will be revising is, what are the different nature of securities which will be accepted by the bank, and what are the various modes of creation of the securities. See, just in the previous concept, as I was telling, whenever you approach the banker for the purpose of the loan, the first thing which the banker will expect from you is what security you are accepting. So now this particular question is revolving around the concept of the securities. One question is, this part actually involves 2 concepts. Number 1, what are the nature of the securities, and what are the various modes of creation of the security. So talking about the nature of the securities, we can divide the securities accepted by the bank into 2 broad categories. Number 1 is either a primary security or collateral security. So what is this primary security? What is this collateral security? Very simple. Primary security means the main asset which you are offering as a security for the purpose of the loan. So that only they call it as the principal asset, the principal security which is given for the loan, that we call it as primary security. Take for example, I went to the banker, I told I needed a loan of 10 crore rupees, and the banker asked me for the security. I told I have a factory building, that factory building I will give it as a security. Against that you give me the loan. So here factory building is a primary asset which has been given as a security. It is a principal security, so that we call it as primary security. So then what is collateral security? Collateral security is, in addition to principal security, in addition to main security, sometimes bankers will ask you to keep some additional security. Take for example, banker is telling, okay, I will take factory building as a security, but I want something extra. Then I told, okay sir, keep this factory as a primary security, I will give my stock as a collateral security. So something which you are additionally offering in addition to the main security or principal security, that we call it as collateral security. And what kind of assets can be accepted as securities? Are different kinds of assets can be accepted as security. So that could be in the form of immobile property, that could be your current assets like goods, stock, or debtors, trade receivables, or it could be gold ornaments or bullions. It could be plantations. For agricultural advances, what will be the security? The crop which the farmer is going to get, that is going to be the security. Third party guarantees, or even LIC policies, personal security of guarantor, and even stock exchange securities like shares and debentures also can be accepted as securities. So these are the different categories of assets which can be accepted as securities by the bank. So one part of the question we have answered, what are the nature of securities. Now let us address the next part, which is talking about what are the various modes of creation of security. So when it comes to various modes of creation of security, so in the material, in the ICS study material, they have given that there are 6 modes of creation of security. How many modes of creation of security are there? 6 modes of creation of security are there. But I do personally feel that out of that, 4 are only actually modes of creation of security, 2 are actually modes of settlement. but don't write all these things in the examination. When they ask you the question, what are the various modes of creation of security? As per the ICA material, we have 6 models actually, 6 modes of creation of security, but actually practically speaking, out of that 4 are only the modes of creation of security. The last 2 are actually modes of settlement. But anyhow, let us try to understand what are the various modes of creation of security. So the things which they say it in the things which they have mentioned is, number 1 is mortgage, number 2 is pledge, number 3 hypothecation, number 4 assignment, number 5 we have set off, number 6 we have lien. So these are the 6 modes of creation of security. So repeat everybody, what are the 6 modes of creation of security? Number 1 mortgage, number 2 pledge, number 3 hypothecation, number 4 assignment, number 5 set off, and number 6 is lien. So let us try to understand each and everything in a detailed manner. Sir, what exactly is this mortgage? So what happens in the mortgage? See, the term mortgage will be used when immovable properties are given as security. When what is given as security? When immovable property is given as security, so that we are going to call it as mortgage. For example, land and buildings, when these assets are offered as security, we call it as mortgage. And that mortgage also will be of 2 types. Number 1 is registered mortgage and the other one is equitable mortgage. Sir, what is registered mortgage, sir? For example, I need a loan from the banker. I have a immovable property, so I want to give it as a security. Here what I will do is, with the banker, I will enter into one deed. I will create one mortgage deed. So in that deed I will mention I am the owner of this building, but for the purpose of loan I am giving this as a security, and in case if I don't repay the loan, bank will have the right to take my property. So I will take one stamp paper, write it on that these terms, so that we call it as a mortgage deed. So that is registered mortgage. There will be other kind of mortgage where all this deed and all will not happen. So what I will do is, if I am the owner of the immovable property, so that original documents of the immovable property will be there. No, that original documents I will keep it with the banker, and the banker will give me back my original properties when I repay the loan. So these are the 2 popular modes of creation of mortgage. Number 1, registered mortgage, where I will enter into a mortgage deed, whereas we also have equitable mortgage. In that case, we don't have any deed or anything. The original documents which I am supposed to have, that I will go and keep it with the banker, and the banker will give back that original documents to me once I repay the loan. This I call it as mortgage. Now, the 2 other popular modes of creation of security are, one is a pledge and the other one is hypothecation. See, both the terms pledge and hypothecation are used when movable assets are given as security. When what is given as security? When the movable assets are given as security, we use the term pledge and hypothecation. In both the cases, the asset being offered as security will be a movable asset. Sir, if in both the cases a movable assets are given as security, then what is the difference between the 2? Pledge is the case where the possession of the movable assets will be transferred to the lender, that is in our case banker. Whereas in the case of hypothecation, neither possession nor ownership, nothing will get transferred to the banker. Both will remain with the owner of that asset only. So pledge, best example, if I have to give jewelry loans, if you want to go to the bank and get the jewelry loan, so if you want to give the jewelry as a security, what the banker will say? He will ask you to deposit that jewelry with the banker. That means possession of that jewelry will be there with the banker. You will not be allowed to keep that jewelry. So you have to deposit that jewelry with the banker until the time you repay the loan. That jewelry will be in the possession of the banker. Once you repay, you can get back that possession. For hypothecation, if I have to give an example, vehicle loans. For example, if you take a vehicle loan, the vehicle will be there with you only. Possession will be there with you only. In case if you don't repay the loan, then that financier will come and take that vehicle. Yes or no? And one more thing, even when you give stock as a security, when you offer stock as a security, if you are hypothecating the stock, so for example, if you have taken working capital loan giving your stock as a security, does that mean you will take all your stock and keep it with the banker? No. If you keep it with the banker, how you will do the business? Stock will be there in the possession of the borrower only. In case if I don't repay the loan, then the banker can come and collect my stock. So that we call it as hypothecation. That is the main difference. In pledge, possession will get transferred to the banker. In hypothecation, neither possession nor ownership, nothing will get transferred to the banker. So this is the major difference between pledge and hypothecation. Then we have the 4th method of creation of security, which is assignment. Assignment. The term assignment will be used when mainly actionable claims are given as security. When what is given as security? When actionable claims are offered as a security, then we use the term assignment. Like if you are giving your trade receivables as a security, if you are giving your debtors as a security, if you give your LIC policies as security. So these are the cases of assignment where actionable claims will be offered as a security. That mode of creation of security, we call it as assignment. And as I have told in the middle, they say total 6 models. The last 2 models are, number 1 is set off and the other one is lien. Sir, what is this set off? What is this lien? Very simple. For example, there is a bank, there is a SBI. Okay, so one person is there. He has taken a loan from SBI. He has taken 10 lakhs worth of loan from SBI. And with the same SBI, he is having FD also. He has deposited certain amount of money with the SBI. And whatever loan he has taken from the SBI, if he did not repay, if he is not repaying that loan, do you think the banker will have right to adjust the liability of the loan again as a fixed deposit? See, this customer has kept fixed deposit with the SBI. No. Do you think the bank will have right to adjust this loan again as a fixed deposit? Yes, they can do it. This right available to the bank, we call it as set off, where the liability of a person can be adjusted against the asset of the person, provided both the accounts, both the asset and liability are in the name of the same person and in the same capacity. If both are there, then it can be adjusted. That only we call it as set off. So you tell me, is it mode of creation of security? No. See, set off will happen after the loan has been given. When the payment did not receive, then the banker will exercise set off. That means it is actually a mode of settlement. It is not a mode of creation of security. But in the ICI study material, as I have told, even this also they have added it under mode of creation of security only. Then we have lien. Lien we already know. Lien means what? Retaining the possession of the goods. In case if the borrower did not repay the loan and if the banker is having the possession of some of the customer's goods, he can sell them and realize the money. So that we call it as lien. Lien is also something which is a mode of settlement only. Understood, everybody? So these are the 6 different modes of creation of security, very important from the examination perspective, and there are high chances the question might be tested as case scenario based MCQ from these particular concepts. Understood? Clear, everybody? So let us now try to proceed further. So we are done with the security related question also. So now we will talk about the next most important question, how to conduct audit of drawing power of advances. Sir, what is this drawing power? So drawing power is the term which is mainly associated with working capital borrowings, especially with cash credit facilities and overdraft facilities. This drawing power is associated. Sir, what exactly is this drawing power? See, generally, when you go to the banker and ask for working capital loan like cash credit or overdraft facility, for this also the banker will ask you security. So for that, what we generally offer it as security for working capital loans, what we give as security, current assets, we give it as security. When I say current assets, our inventory, our debtors, these are the assets which we mainly give it as a security. So take for example, on one particular day, there is company X Limited. It approached the banker for the purpose of working capital loan. They needed some cash credit facility. Now what the banker will ask you is, okay sir, we will give you loan. You please bring your stock statement and debtor statement. So what the company has done is they have prepared one stock statement. So as on so and so date, for example, they are approaching the banker for the purpose of loan on 1st of January 2024. So when they are approaching the banker for the purpose of loan, they have taken the stock statement. They have determined the value of stock as some 10 crore rupees is the value of stock. So this stock statement they have submitted, and the banker thought, okay, you have very good stock position. We will accept this stock as a security, and here stock will be hypothecated. Hypothecated means what? The stock will remain in the borrower's possession only. So just they will submit this stock statement, and the bank told, okay, sir, since you have 10 crores worth of stock, we will sanction cash credit or OD of 8 crore rupees. They will sanction you 8 crore rupees. But once they have sanctioned the OD facility, they will not let you use the entire amount. They will put one more limit. They will put what? One more limit, generally equal to the sanction limit or lower than the sanction limit. They will put one more limit called drawing power. For example, banker is telling, on the basis of your stock statement, we will sanction you 8 crore rupees of OD facility, but we will let you withdraw only 7 crore rupees. So this we call it as drawing power. Drawing power means the maximum amount which can be withdrawn from the working capital loans. That we call it as drawing power. So that is what the meaning of drawing power. If you see that in the material, drawing power generally addressed as DP is an important concept for cash credit facility availed from the banks and financial institutions. Drawing power is a limit up to which a firm or company can withdraw from the working capital limit sanction. They will sanction you the limit, and below that limit, generally most of the banks today, they are keeping the drawing power equal to the sanction limit, but some banks will even keep it below the sanctioned limit, certain another amount, which we call it as drawing power, which is the limit up to which maximum you can withdraw the money. So that we call it as a drawing power. And drawing power is different from sanction limit. Sanction limit is different, drawing power is different. Sir, now how this drawing power will be calculated, sir? See, this drawing power will be calculated on the basis of the stock statement. Okay, initially the borrower submitted the stock statement. On this basis, they have sanctioned the drawing power of 7 crore rupees. But as we all know, stock is something which will not remain constant. Stock will keep on changing depending upon the business done. The stock will keep on changing. So now how the banker will come to know the status of the stock? How the banker will come to know the status of the stock is the borrower has to periodically submit the stock statement with the banker. After taking the loan, the borrower has to submit periodical stock statement. Generally, RBI told the banks should get stock statement at least once in a quarter. You should get the stock statement at least once in a quarter. So quarterly, he will submit the stock statement. For example, on 31st of March 2024, the borrower will submit the stock statement. On that date, he determined the stock value and he came to know that the stock value was 9 crore rupees only. Now this stock statement will be received by the banker. Now what the banker will do is, on the basis of the recent stock statement, he will revise the drawing power. Earlier, at the time of loan, since the amount of stock value was 10 crore rupees, he gave a drawing power of 7 crore. Now what he will do is, since the stock amount has fallen, he will reduce the drawing power. Now he will give a drawing power of 6 crore rupees only. He will reduce the drawing power. Like this, once again, after next quarter, he will submit once again the stock statement. Now on the basis of the stock statement received by the banker will once again revise the drawing power. Either he will increase or reduce it on the basis of the stock position. On the basis of what? Stock position. And how this drawing power will be calculated? Generally, every bank's board of directors will have certain rules. Some banks will say that they will give 60% of the stock as drawing power. That means, for example, if someone submits a stock statement of 100 crore rupees, out of that 60% only they will give the drawing power. That is 60 crores they will give the drawing power. Some board of directors of the banks will have decided that they will give only 50% of the stock as drawing power. Some banks may go to some another level. They might take extra risk. They will say they will give 80% of the stock value as drawing power. So like this, every bank's board of directors will have certain rules. According to that rules, drawing power has to be calculated. And there is one format for calculation of the drawing power. Let me show you that format for calculation of drawing power. So one of the past examination question. So the format for drawing power is something like this. So I will write it here. The format for how the drawing power will be calculated. So generally, you have to take stock. From that, you have to reduce creditors. So the balance thing, which you will get it as paid stock, that we call it as paid stock, we call it. So here also you'll be able to find that in the material. You can use it, or else this format also you can see paid stock. Generally, as I told, every company will have certain margin. For example, if the bank's policy is 20% margin for stock, that means they will give 80% only as loan. Margin means that much portion they will not give. Some banks will have 30% margin. 30% margin means they will give only 70% of the stock as drawing power. So in the question they will mention what is the margin for stock. Example, in the question they have told that margin for stock is 20%. So that value I have to reduce minus margin. That means banker doesn't want to take that 20% risk. So now I have to reduce margin at the rate of 20%. On this figure, I will multiply 20%. I will get the value. The balance amount will be drawing power for stock. Say A. Now, similarly, for debtors also you will get the drawing power. So you have to take debtors. From the debtors, you have to reduce those debtors which are overdue. See here, those debtors which are overdue for more than 90 days. So you have to take out debtors overdue for more than 90 days. So that debtors you have to take it out. So you will get some figure. Eligible debtors you will get. You will get what? Eligible debtors. So from this eligible debtors, they will say in the question margin. Margin for debtors is 30%. So now what you should do is, whatever margin they have given in the question, that margin percentage you have to apply. Margin at the rate of 30% you have to apply. So if you take out that margin, balance whatever you get, that we call it as drawing power for debtors. That we call it as what? Drawing power for debtors. Say B. Now what will be total drawing power? Total drawing power is going to be A plus B. So if you add drawing power for stock, drawing power for debtors, you will get the total drawing power. One of the past examination question. They have tested this in the examination. So I have even given the question here. So even I have given it here. You can solve it. You can use it for the purpose of your calculation. Understood everybody? To get the feel of it, you can use this. Clear? So this is what the format for calculation of drawing power, and once again I'm telling it is one of the past examination question, so this has been tested. So this is what the format. You can even take the help of that illustration whatever has been given in the study material. So what is the bank's duty with regard to drawing power? They have to get quarterly stock statement. They have to check that calculation has been done as per bank's rules and regulations and all, and the bank's management should make sure that all the accounts are within the drawing power. No account should go beyond the drawing power. If any account goes beyond the drawing power, that is something going wrong in the organization, that should be brought to the notice of the head office. So no account should go beyond, the usage in any account should not go beyond the drawing power or sanction limit. So these are the few banks duties which banks have to fulfill regarding drawing power. Next, what auditors should do? what auditor should do is the auditor should verify all the stock statements, quarterly returns, and other statements on the basis of which loan has been, on the basis of that working capital has been given. He has to verify all the supporting documents against which loan has been given. And also he should verify client's annual report, and he should check that whatever quarterly stock statements which are submitted by the client, they are matching with the annual report or not, that you need to check. So these are the auditor's considerations. Apart from that, the RBI has told that Banking Regulation Act says that, see, generally you can get the stock statement on the generally what banks will do is they will get the stock statement, on the basis of that drawing power can be determined. But in the recent times, what happened is some big persons who have taken the loans from the banks, they used to submit fake stock statements. They're submitting fake stock statements and claiming excess drawing power. So that's why RBI has brought one policy. What they have told is, in case if the funded exposure is more than 5 crore rupees, what? In case if the funded exposure is more than 5 crore rupees, that means if the actual liability of a person is more than 5 crore rupees regarding working capital loan, then getting the stock statement alone will not be enough. The banker should do even the stock audit also. That means the banks will send some persons on their behalf, or the bank staff will go and verify whether really that much amount of stock is there or not. Able to understand? So when this stock audit will be applicable, not in all cases, only when funded exposure of more than 5 crores. Funded exposure means when actual amount utilized in the overdraft or cash credit facility is more than 5 crore rupees, they're receiving the stock statement alone will not be enough. The banker should even conduct stock audit as well. So that's what they're telling. The stock audit should be carried out by the bank for all accounts having a funded exposure of more than 5 crore rupees, and auditor can advise stock audit even in other cases also. Generally mandatory requirement when it is more than 5 crore rupees. But if the auditor finds anything suspicious regarding any account, he can ask the banker, sir, even though here the funded exposure is less than 5 crore rupees, still go into the stock audit. He can even ask the management to do in other cases as well. And even as a statutory auditor, even verify that stock audit reports and find whether there are any discrepancies. Understood, everybody? So these are all the reporting. This is what regarding audit of drawing power of advances. So I told you what is the meaning, how it is different from sanction limit, how it is, what are the bank's duties, and what is auditor's consideration, and what is stock audit. Clear, everyone? Able to understand till here? So coming to the next questions. So now, till now, if you could have observed till now, whatever questions we have seen, those are mainly talking about banks operations. You could have observed it. So we did not talk much about the audit of the banks till now, even though the chapter title is audit of the banks. As I've told you in the beginning itself, this chapter is going to talk very little about audit related matters. Mainly it is going to talk about operations of the bank. So now actually from question number 8, some audit related questions will be there. So first, as you could see, provisions relating to appointment of auditors of bank. Who will make an appointment of auditors of the bank? First of all, sir, who is eligible, what qualifications, what disqualifications, everything like same like company auditor. So whatever qualification, whoever is eligible to act as a company auditor, same person will be eligible to act as an auditor for the banks also. Whatever qualifications, disqualifications which are applicable for a company auditor under section 141 of the Companies Act, the same qualifications and disqualifications will be even applicable for auditor of the banks as well. So now who will make an appointment of auditor? In case of SBI, the auditor will be appointed by C and AG of India after consultation with the central government. So if it is SBI, C and AG in consultation with central government. Whereas for subsidiaries of SBI, auditor will be appointed by SBI. For SBI, C and AG will appoint. For subsidiaries of SBI, SBI will appoint. In case of other than SBI, whatever other nationalized banks are there, in those cases, board of directors will make an appointment, but after getting approvals from RBI. Similarly, in case of RRBs also, board of directors will make an appointment after getting approval of central government. Apart from this, whatever other banking companies are there, like ICICI Bank, Axis Bank, in all those cases, the shareholders will appoint the auditors at the AGM. Nothing but normal Companies Act provisions will become applicable. So these are the people who are having the power to make an appointment of auditors of bank. So now who will decide remuneration? In case of nationalized banks, SBIs and RRBs, the remuneration of the auditors will be decided by Reserve Bank of India after consultation with central government. So in all these nationalized banks, SBI and RRBs, who will decide the remuneration? RBI is only going to decide. That decision will be final, but RBI will decide the remuneration after discussing with central government. Whereas in case of all other banking companies, the remuneration will be decided by the shareholders as per sections 142 of the Companies Act, which means shareholders will decide the remuneration of the auditors. Sir, what will be the powers of the auditor? Whatever powers of the company auditors are there, the same powers will be there even for the bank auditor as well. Understood? And here we have one more concept. Sir, what are the matters which the engagement team members discuss while conducting the bank audit? See, not just a bank audit, while conducting any audit, engagement team members generally at the planning stage, they will have a discussion. not just in the bank audit, in every kind of audit. Initially, at the beginning of the audit, mainly during the planning phase of the audit, all the engagement team members will generally have some discussion. Sir, what kind of matters they will discuss? They will discuss matters like errors that are more likely to occur. What are the chances of which kind of errors are more likely to occur, and what are the errors which have been identified in the previous year? In previous years, what errors were identified? They have a chance of getting repeated in the current year. And also, what are the different ways in which fraud can be committed in the bank? That also they will discuss. And need to maintain professional skepticism. They will discuss the importance of maintaining the professional skepticism in the bank audit, and how to respond to the risk. If you find any risk, how to respond to that. And they will also discuss the importance of remaining alert to circumstances that indicate a material misstatement could have occurred. So generally, at the planning stage of the audit, all the engagement team members will have a discussion regarding these matters, which are errors that are more likely to occur or errors that have already taken place in the past, methods by which fraud can be perpetrated, need for maintaining professional skepticism, how to respond to the engagement risk, and need to remain alert to the risk of material misstatement. All these matters will be discussed in the meeting. And what are the advantages of having this discussion? Why do they have these discussions? Because it will provide an opportunity for more experienced team members to share their knowledge to the less experienced team members, and even it will promote better understanding among the engagement team members. And also, specifically during the discussion, main attention they will put to banks financial statement susceptibility to fraud. Mainly they will focus on fraud, how to respond to the fraud. These will be the key matters which will be discussed during engagement team discussions. Clear? So this is what regarding engagement team discussion. Then we have one more question: overview of conducting overall bank audit. What will happen in the bank audit? Just a overview they will give. They will not talk in a detailed manner. Overview they are going to give regarding how to conduct a bank audit. So as you could see, first you have one of the preliminary engagement activity. In any other audit, before we accept the audit, we communicate with the predecessor auditor, right? Even we have seen in the preliminary engagement activities also, one of the preliminary engagement activity, first if you are accepting an audit for the current year which has been previously held by another auditor, first you have to communicate with him in writing. Here also, the bank auditor, before he accepts the current year's audit, he will try to communicate with his predecessor auditor, and he will perform procedures relating to acceptance and continuation of client relationship. 4 factors he will consider: integrity of the principal owners, evaluation of the competence of the engagement team, and also compliance with the ethical requirements, and significant matters that have arisen during previous audit engagements. That acceptance and continuation of client relationship also he will do here. And declaration of indebtedness. Specifically in the case of banks, before you get appointed as an auditor, you have to declare a indebtedness. That means how much you are indebted to the bank. In case, are you indebted to the bank? If yes, for how much amount? Is your account classified as NPA? That written declaration you have to give. And terms of audit engagement, nothing but draft your engagement letter. Then internal assignments, you should not do any kind of internal assignment in case if you are getting appointed as a statutory auditor. And finally, establish your engagement team, determine who and all will form part of your engagement team. So these are all some basic initial considerations. Then after you are done with all these initial considerations, the first procedure which we will perform will be what? Risk assessment procedure. In risk assessment procedures, what we will do, we will get to understand the entity, its environment, including internal controls. That we do it here even in the case of bank. Then we will discuss, then we will have engagement team discussion. What discussions you will have? Just now we have seen it in the previous question that engagement team discussions also will take place. Then you will work on designing the audit plan, audit strategy, and also you will determine materiality, what is material, what is not material. As per SA 320, determine the materiality levels. Consider whether going concern is appropriate for the bank, and also particularly determine what is the risk of fraud, including money laundering. So you have to particularly see this in the case of bank. RBI has given framework like know your customers to avoid the money laundering. So as an auditor, we need to verify, is there any risk of happening of money laundering in the case of the bank? And we have to maintain professional skepticism. We have to maintain a questioning mind. We should not believe anything, whatever comes to our mind, whatever comes to our notice, we have to question that. And specifically, we need to do 2 extra things. See, till now, whatever we have discussed, that we do in every audit. But point number 9 and point number 10, this we do only in the case of bank audits. What is that special things which you do in the audit of banks? Number 1 is checking the stress testing framework, checking the Basel III framework. Sir, what is the stress testing framework? Framework means what? Nothing but, as I have told, rules and regulations. See, RBI has given a set of rules and regulations and gave it a name, stress testing. Sir, what is this stress testing framework? Nothing but the RBI has given certain rules and regulations which every bank has to follow. If they follow that, they will be able to withstand the recessions. If at all any economic collapse happens, banks should be able to withstand it. Banks also should not collapse. So in order to make the banks strengthen, RBI has given certain rules and regulations and gave it a name called stress testing framework. So as an auditor, our responsibility is to check whether bank has really complied with that requirements of the stress testing framework or not. That we need to check and give a comment on that as well. So that you need to do stress testing framework. You have to check compliance with the stress testing framework. Then you then even you need to check the compliance with Basel III framework. Sir, what is this Basel III framework? Basel III framework is also nothing but certain rules and regulations. But the difference between stress testing framework and Basel III framework is stress testing framework is a national level framework given by RBI. Whereas Basel III framework is a global framework which will be followed all over the world, not just in one country. Basel III framework contains rules and regulations which will be followed all over the world. It is given by a committee called BCBS. BCBS means Basel Committee on Banking Supervision. So like that, a global committee has given that framework. Whether the requirements of that Basel III framework are also complied or not, that also I need to check. And finally, you have to verify other auditors' reports. If any other reports are there in the bank, you have to go through that reports as well. That could be previous year's audit reports, that could be inspection reports by the higher bank officials like head office officials. If RBI has done inspection, check that inspection report. If internal audit department is there, verify that internal audit report, internal auditors report, and report on verification of security or any other internal report which is available. Please read that internal report to find out whether there are any adverse comments relating to functioning of the banks. So this is what we basically do in the overall audit of the bank. So as we have seen, they are not talking about in a detailed manner, just they have given an overall view what exactly will happen in the audit of banks from beginning till the ending. Clear, everybody? So the next set of questions will be dealing about how to conduct audit of each and every item of the financial statements. So as we have seen, question number 10 actually talks about what is the overview of the entire bank audit from the beginning till the ending, what and all we are going to do. They have given an overview, they have given a brief. Now we will see a set of questions which will be talking about how do you particularly verify the advances of banking company. Then we will have one question talking about how do you conduct audit of incomes of the bank. Then we will have one question, how do you conduct audit of the expenses of the bank. So now they are going to go into detail. They are going to take up each and every major item of the financial statements and how specifically we are going to verify that major item, what things we are going to keep in mind, that they are going to talk about it. So first let us start with question number 11, which is talking about as an auditor, how do we verify the audit of income, audit of advances of a banking company. As we know, if you open the balance sheet of a banking company, the major asset will be what? Loans and advances which are given by the bank. So as an auditor, if you are conducting audit of any banking company, the significant portion of item of the financial statements, the significant portion of balance sheet will contain advances. How are you going to verify the advances? What things you will try to keep in mind regarding that advances? So first of all, we need to see that the advancing facility which is done by the bank can be divided into two categories. Number one is funded advances. Number two is non-funded advances. Funded loans are those loans which involve actual outflow of the funds. For example, if you go and take a housing loan from the bank, will the banker give you funds? Yes, the banker will give you the funds. If you take a personal loan, will the banker give you funds? Yes. So not all facilities are funded facilities. Some facilities could be even non-funded facilities also. Sometimes bank will give advancing facility in the form of giving a bank guarantee. So when the bank is giving a bank guarantee, there will not be any outflow of funds from the banker. Just a bank will stand as a guarantor. So whatever advancing facilities which the bank has given, they will be broadly divided into two categories: funded advances and non-funded advances. Funded advances are those advances which involve actual outflow of the funds, whereas non-funded advances are those advances which does not involve any actual outflow of the funds. And the Banking Regulation Act says that as an auditor, if you are conducting audit of the bank, whatever large advances are there, that you verify 100%. You have to verify all large advances, and whatever other than large advances are there, that you have to verify on sampling basis. So the rules and regulations say as an auditor, you need to verify all large advances. Whatever other advances are there apart from large advances, that you can verify on a sampling basis. Sir, how to determine which advance is a large advance? What is the criteria for large advance? So we have to remember one thing. There is no hard and fast rule. So it is purely upon the professional judgment of the auditor. Whether an advance will be large advance or not, that is purely depending on the professional judgment. So the auditor, keeping in mind the size of the operations of the bank, the volume of the operations of the bank, they have to decide which advance will be large advance. They will decide the criteria. However, one example they have given in the study material, they said that an advance may be considered to be a large advance if the year-end balance is in excess of 10 crore rupees or 10% of the aggregate year-end advances, whichever is less. So make this small correction in the material. So initially you might find 2 crores or 5%. Just make a small change. So it will be either 10 crores or 10% of the aggregate year-end advances of the branch, whichever is less. This could be criteria. However, I am telling this is only example. This is only example. So if it is an example, even we can keep the same thing also, 2 crores or 5%, or you can say 10 crores or 10%. So whatever we want, we can put the limit. So, but ultimately, which advance is a large advance, which advance is not a large advance, that is purely depending on auditor's professional judgment. Clear, everybody? So just here it is an example. Maybe some auditor might set a criteria that any advance which is exceeding 10 crores or 10% of the aggregate year-end balances, whichever is less, that I will consider it as a large advance. An auditor can put that criteria, but it is not a hard and fast rule. It all depends on the auditor's professional judgment. So all large advances, whatever criteria, on the basis of criteria, whatever you have decided, all large advances you verify on 100% basis. Other than large advances, whatever are there, that you try to verify it on sampling basis. So whatever it is, either on 100% or sampling basis, what specific things we need to verify regarding advances? First, we will do some preliminary examination, basic examination we will do. Sir, what will get covered in the basic examination? Number one, see, before a banker is giving a loan to any customer, did they check the credit worthiness of the borrower? Credit worthiness means what? Repaying capability. Has the banker checked the repaying capability of the borrower? Then only loan has been sanctioned or not. And also obtain sanction. Is there a proper approval from the concerned authorities? So generally branch manager should give the approval. So check that whether loans and advances have been given only after getting approval from concerned authority and all necessary documents have been executed. So whenever you go to the bank and take a loan, they will make you sign a bulky documentation. They will make you sign 30-40 pages. So that is nothing but loan agreement. So that is very important. Why? Because in that agreement, clear terms and conditions will be there. What rights banker will have in case if the borrower repays the loan, all the terms and conditions will be there in the agreements. So we need to check as an auditor whether all that documents are properly executed or not. So this basic examination we have to do. Number one, checking the credit worthiness of the borrower. Number two, checking whether the loan has been given under proper sanction. Number three, all necessary documents have been executed or not. So this basic examination I have to do. Then I have to verify some aspects with regard to security. What things I need to check regarding security? Number one, whether all the securities are registered in the name of the bank. Whatever securities banker has accepted, that assets should be registered in the name of the bank. In case if the shares and debentures are given as security, the ownership will get transferred to the banker. Once the customer repays the loan, the shares and debentures will be transferred again to the borrower. And always sufficient margin has to be maintained. I already told you what is sufficient margin. The excess of that security value over the borrowing amount, that we call it as margin. There should always be margin, not just at the beginning. Throughout the tenure of the loan, there should always be sufficient margin in every loan and advance. And in case if the goods are in the possession of the bank, for example, this will happen in the case of pledge. In case of pledge, banker will get the possession of the security. No, in case the banker is having the possession of that goods, they have to check the contents of the package and the go downs should be frequently inspected. Why? Because if tomorrow borrower comes and repays the loan, you have to give back his assets. So you can't say we have lost it, assets are damaged. You can't say that. So whatever goods the borrower has given to you as a security, they should be kept under safe custody, and wherever these goods are getting kept, they should be frequently inspected. Now, then certain things you need to verify regarding drawing power. So nothing but in case of short-term loans and advances, you need to even verify some aspects relating to drawing power. What things you will check regarding drawing power? So drawing power register should be updated every month. Every month the drawing power register should be updated. And also all the accounts should be kept within both the drawing power and also sanction limit. No account should exceed the drawing power or sanction limit. And in case if you find any account which is exceeding the drawing power or sanction limit, that should be immediately brought to the notice of the controlling authority like head office or RBI. You have to immediately bring it to their attention. So these are the few basic things which we need to verify regarding loans and advances. Similarly, we will have one question which is talking about how do we conduct audit of incomes of the bank. Now they talk about different incomes here. So one of the major income is interest income. One of the major income is interest income. So they say that how the interest income should be recognized. How interest income should be recognized? Generally, interest income should be recognized on accrual basis. However, if an account is classified as NPA, then interest income should be recognized only when it is received. That is on cash basis you have to recognize when an asset turns out to be NPA. The same thing they try to say here, policy for income recognition in respect of NPS. Generally, in respect of NPS, the interest should be recognized on the basis of record of recovery. That is, income will be recognized only when received, not when it is accrued. Exception. However, if the loan has been taken against the deposits of term deposits, NSCs, KVPs or IVPs, even though they remain overdue for more than 90 days, they will not be classified as NPA. They will remain under standard category only, and even income also will be recognized on accrual basis only. Here one important point I want you to revisit, which is very important for examination. See, we have seen two cases. In case if the central government guaranteed advances are there. In case if the central government guaranteed advances are there, even though they remain overdue for more than 90 days, still they will be treated as standard only. For asset classification, they will be treated as standard assets. That means they will not be treated as NPA. So for asset classification, they will remain under standard category only. But for income recognition, they will be treated as NPA. Which means what? Income will be recognized on cash basis. Income will be recognized only when received on cash basis. This is in which case? In case central government guaranteed advances are there, even though they remain overdue for more than 90 days, they will remain under standard category only for asset classification, but income will be recognized only when received. That is on cash basis. However, in case if the loans are taken against FDs, term deposits, or fixed deposit, both convey same meaning. So in case if the loan has been taken against term deposits, NSCs, KVPs or IVPs. In case if the loans have been taken against term deposits, NSCs, KVPs or IVPs, even though they remain overdue for more than 90 days, still they will not be classified as NPA. They will remain under standard category only. Standard category. For asset classification, they will remain under standard category only, provided sufficient margin is available. If sufficient margin is available, even though it remains overdue for more than 90 days, no need to classify it as NPA. But here, for income recognition also, we will treat it as standard only. That means income we can continue to recognize on accrual basis. No need to recognize on cash basis. Clear, everybody? So very important, this point they can test you in the examination by way of MCQs, etc. So we have to be a little bit cautious here. Once again, I'm summarizing. In case of central government guaranteed advances, for asset classification, it will remain in standard category, but income recognition, we treat it as NPA. That means on cash basis, we recognize. But however, in respect of loans taken against term deposits, NSCs, KVPs or IVPs, for asset classification also, it will remain under standard category, and even for income recognition also, we'll treat it as standard. That means we will recognize the interest income on accrual basis only, need not be on cash basis. But however, the condition for this both is there should be sufficient margin available. Always sufficient margin should be available. That means there should be some excess amount in the value of the security than the borrowing amount. Clear? Next one. So the same thing they say there. Reversal of income. And one more thing they say, in case if the account turns out to be NPA, not just we will stop accruing the income which has already been recognized, but not yet realized. See, if an account turns out to be NPA, going forward we'll stop accruing income. But what about the income which is already recognized? The income which is already recognized, if it is realized, okay, you recognized it and also you have received it, well and good. But in case if the income has been recognized but not yet realized, account already turned NPA, going forward you will stop accruing the income, but you have already recognized some income but not yet received it, then the government is telling, then the Banking Regulation Act says reverse that unrealized income as well. So if any advance becomes NPA, the entire interest accrued and credited to income account in the past periods should be reversed if it is not realized. If it is realized, well and good, no need to reverse, ignore it. But if you have recognized it but not yet realized it, then compulsorily you have to reverse it back. Then, so even though you will reverse all that income, but for control purposes, you will keep it in a separate memorandum account. Some control account you will open. In that, you will try to maintain that record of income reversed and income stopped being accrued. So that we will try to keep it in a memorandum account for control purposes. From the main books, we will take it off, but we will maintain one memorandum account. There we will maintain the details. And sir, what if there is a partial recovery in NPS? What if there is a partial recovery in NPA? I will try to explain what is this partial recovery. Take for example, there is one account. The bank has given one loan. In that, principal outstanding is 10 crore rupees. Interest outstanding is 2 crore rupees. But this particular borrower, whoever has taken this loan, he has gone bankrupt. As a full and final settlement, 6 crores has been received. As a full and final settlement, only 6 crores has been received by the bank as a full settlement for the entire 12 crore rupees. Now the thing is, whether this 6 crore should be treated as recovery of principal, or it should be treated as recovery of interest, or it should be treated in some ratio. Whether this 6 crore rupees as full and final settlement should be treated as principal repayment, or should we treat first as interest payment and balance for principal repayment, or we have to apportion it between the two. What should be done? How we have to treat it? See, generally, how to treat this partial recovery, it will depend on the loan agreement. Generally, in the loan agreement, the terms and conditions regarding this will be clearly written. So in the loan agreement, if they are telling whatever partial recovery you are receiving it, in case if you have received partial recovery, first treat it as interest, balance you treat it as principal. That only they will follow. In case if in the loan agreement it was written, if you are making partial recovery, first treat it as principal, and if anything is left out, then you treat it as interest recovery. Or if in the loan agreement it was told you have to apportion it in some ratio, you have to consider that. So generally in the loan agreement there will be a clause talking about what is the settlement, what is the treatment in case of partial recovery. In the loan agreement there will be one particular clause. We have to follow the requirements of the clause. Sir, what if in this particular case, what if in this particular case in the loan agreement this clause is missing? Generally it will not happen. Generally it will not happen. Today all the loan agreements are standardized. In every loan agreement there will be compulsorily a clause. See, generally today loan agreements are all pre-printed information. So they will not sit and discuss with you all the terms and conditions. There will be pre-printed format will be there, just you are required to sign. So generally clauses will not miss. But a hypothetical scenario they are telling. In this particular case only for this customer, this in the loan agreement this clause is missing. Then what needs to be done? See, if it is missing in this loan agreement, in other loan agreements it will be there. No, generally every bank will have uniform policy. So whatever you are following in the other loan agreements, same thing you regularly imply it here also. Understood? So in case if in the loan agreement clearly this recovery clause has been given, follow that. In case if it is not given in that particular loan agreement, follow whatever you are doing in the case of other agreements. But generally, as I have told, this thing will not happen. Why? Because today all the loan agreements are standardized. There is no chance of missing off any of this clauses. Clear? Sir, why it is important if you have made a partial recovery? Why it is important to know whether it is recovery of principal or interest? Why it is important is, if you treat it as recovery of interest now, previously you would have reversed it or you would have stopped accruing it, but since now you have received it, now in the statement of P&L you have to recognize this interest income. That's why. So if you treat it as recovery of interest now, earlier you would have reversed it. Earlier you would have stopped accruing it. But now you have realized it. No, now you have to recognize that interest income. So that's why it is very important to know whether in the case of partial recovery, is it recovery of principal or is it recovery of interest? Clear, everybody? Next one. Then they talk about bill discounting income. See, in the bill discounting income, they specifically say only one thing. So what is that bill discounting income is? Generally, for example, assume that there is one bill which is discounted on 1st of April 2020, 1st of March 2024. There is a bill amounting to 1 lakh rupees and the banker has collected 9,000 rupees of discounting income. Total discounting income they have collected is 9,000. But actual maturity date of the bill is 31st of May. Generally, the bill's due date is 31st of May, but one customer came to the bank and he discounted the bill. For discounting that bill, banker has collected the income of 9,000 rupees of discounting income they have collected. Now, how to recognize this 9,000 rupees of bill discounting income? Should I recognize all at once or should I recognize it over the tenure of the bill? The bill discounting is nothing like a financing activity only. So the Banking Regulation Act says, in case if you have a bill discounting income, that bill discounting income should be recognized over the tenure of the bill, not all at once. So now what will happen is, this bill tenure is 3 months. So 1 month will fall in the financial year 23-24. Till 31st of March 23-24, it will be financial year 23-24. 1 month of the bill tenure is in 23-24. 2 months of the bill tenure is in 24-25 financial year. So out of this 9,000 rupees of income which the banker has collected, only 1 month's income, that is 9,000 rupees into 1 by 3. 3,000 rupees of bill discounting income only will be recognized in 23-24. What about that balance 6,000? How we should show that as on the balance sheet date? How the management should show this item in the balance sheet date? As on in the balance sheet, how they have to show this? 9,000 income they have received, but 3,000 only they have recognized. What about the 6,000? How they have to show it? Income received in advance will become what? Liability. They have to show it as a liability as on the balance sheet date, and that balance 6,000 they can recognize in the financial year 24-25. Understood? Next, they also talk about bills for collection income. They also talk about bills for collection income. See, bills for collection is not a discounting facility. Bills for collection is not a financing activity. It is an outsourcing activity. So in case of bills for collection, you need not recognize that bills for collection commission or the tenure of the bill. Whenever you receive that commission, then you can recognize that entire income in the statement of P&L. What is bills for collection, bill discounting? I hope you know the difference. Bill discounting is financing activity. Bills for collection is an outsourcing activity. So in case of bill discounting, generally what will happen is the banker will give the funds well in advance, later he will collect. But in the case of bills for collection, first banker will collect the payment from the third party, he will deduct his commission, the balance amount will be transferred to the customer. For example, one company has sent 1 lakh rupees of bills for collection, the banker will collect it, take for example 2% of commission, 2,000 they will keep, 98,000 they will give it to their customer. So this commission, bills for collection commission, when they will recognize? As and when they receive, then they will recognize. Is there any requirement to apportion it over the tenure of the bill? No need to apportion it. Entire income you can recognize it as and when received. Why? Because it is not a financing activity, it is just a outsourcing activity. Then income, then few more things they say, income from rescheduling or renegotiation of the loans. Sir, what is this? What is this income from rescheduling or renegotiation of the loans? See, take for example, there is one customer who has taken the loan. The actual due date is 31st of March 2024. He has to repay the loan on 31st of March 2024. But on this day, before this date, the customer approached the banker and told, sir, I am not in a position to repay the loan on 31st of March 2024. I have a request. Please extend my loan till 31st of March 2026. I want you to extend the due date on my loan for 2 more years. Sir, will the banker do it? In some circumstances, they might do it. It might be in the interest of the banker. Sometimes bankers will agree to it. Now, for increasing this due date, what they will do is, for this extra 2 years, they will get interest income. For extra 2 years, banker will get interest income. But in addition to that, the banker will charge some other income also. In the name of processing charges, in the name of some other fees, what they will do is, they will say, sir, we will extend the due date by 2 more years. For this 2 years, you have to pay interest. Along with that, since we are extending the due date, for that, there will be a processing charges of 1 lakh rupees. What the bankers will collect? They will collect some one-time income for renegotiation of the loan, rescheduling of the loan in the name of processing charges or whatever you call it. See, this rescheduling income will be in addition to the interest income for that extended period. So here the banker has collected 1 lakh rupees saying that it is a income for, it is a charges for extending the due date. Now this we call it as rescheduling income or renegotiation income. How to recognize this? Can I recognize all at once? No. The Banking Regulation Act says you have to recognize this rescheduling income over the period of that rescheduled term. For how many years the loan has been rescheduled? For 2 years. This entire 1 lakh rupees of income should be recognized over the period of these 2 years, not all at once. Clear? So this is what they say there. And income from investments, and if the bank is having any excess funds, they will also go and make the investments. So we have to check that all the investments from that government securities, bonds and investments by way of interest and dividend, everything has been properly recognized or not. That also we need to check. And the bankers will also make the sale of these investments. We have to check whether that sale on the profit or loss arising on the sale of investments has also been taken to the statement of P&L properly. And sometimes they do revaluation of the investments also. We need to check whether that revaluation income has also been taken to the statement of P&L as per the directions of RBI. So even from investments also you need to verify this. Clear everyone? So now we have one more thing, reversal of income. Very short question. In what circumstances you will reverse the income? I have already told you. So in case if the account turns out to be NPA, whatever income, whatever interest income which you have already recognized but not yet realized, you have to reverse it. So as I've already told you, when an account turns out to be NPA, going forward, we will stop accruing the income. But whatever income that we have already recognized, if it is not yet realized, that also we have to reverse it back. And they say here one more thing, not just interest income, even you have to recognize any other income. Not just interest income, any other income in the name of processing charges, etc., which has been already recognized by the bank. But if it is not yet realized, even that all other kinds of incomes are also required to be reversed. So the same thing they say here. First, if any advance turns out to be NPA, not just we will stop accruing the income, whatever income that is already interest income, whatever it is recognized, that also should be reversed if it is not realized. Not just interest income, any other income in the name of fees, commission or any other similar income in respect of accounts which have turned out to be NPA, that income is also required to be reversed if not yet realized. And what is one more case where we will reverse the income? Generally, when any income has been recognized by mistake, when any income has been recognized by mistake, then also bankers should reverse that. So for example, you have wrongly recognized income in this year, in the same financial year, if you find out that mistake, you can reverse it. But sometimes what will happen is you have wrongly recognized income in 1 year, in the next year you have recognized that mistake. Then what you should do? You have to create a provision for that. You have to charge it as expenses. So in case if you have recognized income in the same year wrongly and in the same year you have identified, then we can reverse it. But if you recognize it in the future years, we can't go back to the prior years and reverse it. We have to create a provision for the same. So this is what regarding reversal of income. Able to understand everybody? So similarly, they talk something about how do you verify audit of expenses. What briefly we try to verify. They are giving us a brief. How do we verify expenses of a bank? As we all know, what is a major expense? The major expense in the case of bank will be interest expense. Sir, how do you verify interest expense? First, they say they will ask you to perform some analytical procedures. Sir, what analytical procedures they are asking us to do? So what they will ask you to do is calculate some weighted average interest. That means they will ask you to do two kinds of comparison. Compare within the same year, compare even with the previous year. So what comparisons you will do? In the case of same year, you will calculate weighted average rate of interest. for a category of loan. Take for example, if you are calculating term deposits, the banker has to pay interest on term deposits. The banker will calculate weighted average rate of interest on entire term deposits. They will get certain percentage. For example, they got some 6%. Now this weighted average rate of interest should be compared with interest rate on each and every deposit. For example, on one particular deposit, the interest rate was 5.8%. Okay, close range. For another deposit, the interest rate was 5.9%. Okay, close range. But they are able to find that for one particular fixed deposit, the interest rate is 4%. Huge deviation. Weighted average is 6%, but you have got only 4% on one particular deposit. Since you find a huge deviation, you will try to investigate that further. So this kind of comparison you will do. So you will calculate weighted average rate of interest and then compare this rate with actual average rate of interest paid on each deposit. And if you find any deviation, you will try to inquire it. Similarly, you can do the comparison with the previous year also. In the previous years, what you can compare is, for example, for the term deposits, I will calculate what is the average rate of interest in the current year. And also I will calculate in the previous year what is the average rate of interest in the for the term deposits in the previous year. I will compare both the averages. If I find any huge deviation, I will try to investigate that further. So like this, the first thing to check whether interest expense is reasonable or not, they will ask you to perform some analytical procedures. So you have to calculate this weighted average rate of interest and do some comparisons within the same year and do some comparisons with the past year. Apart from that, we need to check that interest has been provided on all deposits up to the date of the balance sheet. And for interest, there will be some rules given by the RBI. RBI will give some rules. We need to check that interest has been paid as per the rules given by RBI. In case of fixed deposit, the banker will give you fixed deposit certificate. On that fixed deposit certificate, rate of interest also will be mentioned. You have to take a sample of fixed deposits and calculate that interest has been paid as per the rate prescribed in the fixed deposit certificate. And also in case of inter-branch balances, sometimes between the balances funds transfer will happen. SBI branch of Hyderabad may give funds to the SBI branch of Mumbai. This we call it as inter-branch balances. Even on the inter-branch balances also interest will be charged as decided by the head office. Clear? So these are the few basic things which we need to check regarding interest income. Then we have interest expense. Then apart from that, we have various other expenses also. Interest will not be the only expense. There will be various other expenses, like they have to pay staff salaries, they have to pay office rent, they have to pay maintenance, they have to pay housekeeping services, they have to pay for security. So many other expenses also will be there. They have collectively given a name operating expenses, and they have given some common points which we check for all other operating expenses. Number one, we need to check whether there is a proper internal control mechanism for all other operating expenses, for salaries, for office expenses, for maintenance. For all this, proper internal control system is there or not. And wherever we have supporting documents, you have to check the supporting documents. Number three, wherever possible, wherever you find that there is a relationship, you need to even perform analytical procedures. So they have referred to all other expenses as operating expenses. They have told three common things which we are supposed to do. We have to check whether there is proper internal control mechanism. Wherever supporting documents are there, check the supporting documents and even try to perform analytical procedures in case if any relationship exists. Apart from that, next major expense in the case of banks will be provisions. And in that provision also, main provision will be provision in respect of NPAs. Banks are required to make the provisions in respect of NPAs. So we need to check first whether asset classification has been done correctly. And for each asset classification, the rate of provision is also given under Banking Regulation Act. So we need to check that first, asset classification is proper or not. And also whether whether for each category of asset, the rate of provision has been as prescribed by the RBI rules and regulations or not. These two things we have to check. Then apart from provision in respect of NPAs, the next bigger provision will be provision for tax. How do we verify provision for tax? See, being a chartered accountant, we also know the tax provisions. So what you can do is you can calculate the tax liability on your own, compare it with the management's calculation, check whether both are matching or not. And apart from that, whatever other provisions are there, like provision for warranties, etc., we need to check for what circumstances these provisions are created and whether those provisions are adequate, whether that provisions are enough, whether they are not overstated, they are not understated, that we need to verify it. So these are the few things which we need to verify regarding provisions. So we have covered what things we need to check regarding interest expense, what things we need to check regarding operating expenses, and even we have seen what things we need to check regarding other provisions also. Till here, everybody comfortable? So now we will try to talk about reporting requirements. Since we have seen how to conduct audit of advances, how to conduct audit of incomes, how to conduct audit of expenses. So now we will have a look at what will be the reporting requirements of auditors of bank. In case if you are conducting audit of a bank, what and all reporting requirements will be applicable, to whom you are required to report, how many reports you are required to submit, all that we will see. See, practically speaking, in the case of a bank, reporting requirements are very high. In the case of normal audits, if we give one audit report, that will be enough. But in the case of the banks, numerous reports are required to be given. Let us see what are they. So in case if you are conducting audit of a nationalized bank or SBI, you are required to submit a report to the central government. When? Only when you are conducting audit of a nationalized bank or when you are conducting audit of SBI, then you are required to make a report to central government. In that, what you have to mention, let us see. In case of nationalized bank and SBI, the auditor is required to make a report to the central government in which he must state the following. So in that report which you are sending to central government, you must state these things. What are they? Number one, whether balance sheet and P&L and all the necessary particulars and is properly drawn up and exhibited true and fair view. Nothing but simply whether the financial statements are giving true and fair view or not, that you have to give a comment. Next, whatever explanation information is required for him, whether he get all the information and explanation, that you have to comment. And whatever transactions which the bank has done, whether they are within the powers of the bank, that the bank did not do any transaction going beyond its powers, and whether you have received all the returns from the offices and branches and you have found them adequate for the purposes of your audit. Did you receive all the returns and reports from the branches, and are they adequate for expressing the opinion on the entire company? So in case if you are conducting audit of a nationalized bank and SBI, you have to submit a report to central government. In that report, you have to state on 4 things: whether financial statements give a true and fair view, did you get all the information and explanation, whether the transactions of the bank are within the powers of the bank, and did you receive the returns and reports from the branches, and are they adequate for the purposes of your audit. And in addition to that normal audit report, you have to prepare what should be the format of the report. You have to prepare the report as per standards, nothing but 700 series of standards you have to follow. Even in the case of audit of banks also, audit reports of banks also, you have to prepare that audit report as per standards on audit. And in your audit report, you are required to give one more disclosure. In the if you are a central statutory auditor, in the audit report which you are giving for the bank, you have to add one more disclosure. So what is that disclosure is? Take for example, if you are the principal auditor of SBI. So if you are auditor of a SBI, you are giving audit report on entire SBI. What you should state in your SBI, what you should state, extra state in your audit report is, you have to find out of entire branches of SBI, are there any unaudited branches? Are there any unaudited branches? You have to find it out. So for example, as an auditor, I came to know that out of this entire SBI's audit, there were some 10 branches which were unaudited. There were some 10 branches which are unaudited. I have to mention in my audit report, there were a total of 10 branches which were unaudited. Not just mentioning the total number of branches, even you are required to report for these 10 branches put together, what are the total advances, what are the total deposits, what is the total interest income, what is the total interest expense for these 10 unaudited branches. That amounts also you are required to mention in your audit report. That amount also you are required to mention in your auditor's report. So let me read this very important point. The auditor should ensure that not only information relating to number of unaudited branches is given, but quantification, that is amount of advances, deposits, interest income and interest expense for such unaudited branches is also required to be included in his audit report. So this is what is required to state. If you are a principal auditor giving the audit report on the entire bank, you have to identify how many number of branches of the entire SBI were unaudited, and what is the amount of total advances, deposits, interest income and expense in respect of that unaudited branches you are required to mention in your audit report. But I have a doubt, in which paragraph you will report? Okay, the rules are telling you are required to report regarding this information, but in which paragraph you will tell this report? You will tell this information. Generally other matter paragraph. Why? Because we use other matter paragraph for responsibility related matters. No, so this is a disclosure regarding responsibility related matter, so we can happily discuss that in the other matter paragraph. So whatever it is, this extra disclosure is required to be given. In addition to that, even you are required to report on the matters specified under 143 of the Companies Act. Like under 143 subsection 1, we have 6 matters which are required to be reported. Under 143 subsection 3, we have a total of 9 plus 6, 15 matters which are required to be reported. And under 143 subsection 11, we have CARO, the total of 21 matters. Are you required to report this in the case of bank? No, CARO will not be applicable in the case of banks. in the banking company, CARO will not be applicable. So only reporting requirements under 143 subsection 1 and reporting requirements under 143 subsection 3 will be applicable. The reporting requirements under 143 subsection 11, that is CARO, will not become applicable in the case of bank. So CARO will not be applicable. In addition to all this, the auditors of banks are required to submit one more report, which we call it as LFAR, long form audit report. Also you are required to submit. So this is required to be given in the case of all bank audits. And which matters, sir? Those matters are already prescribed by RBI. What things are required to be included in LFAR, that is already prescribed by RBI. So on that matters you have to report, and even there is a timeline for submitting that LFAR. The LFAR is required to be submitted before 30th of June every year. You have to submit that. There is a timeline also. So main report you have to give. In case if you are conducting audit of a nationalized bank or SBI, you have to report to central government. In addition to that, LFAR is also there. In extra to that, even you are required to report on fraud also. In case if you find any fraudulent activity in the functions of the bank, you will fulfill the reporting requirements under 143 subsection 12. Reporting to central government will become applicable. In addition to that, in case if you found any fraud, even you are required to report to the RBI as well. The same thing they say there. So the RBI has issued a circular which says if an accounting professional, you only, you and me, so if an accounting professional, whether in the course of internal audit or external audit, if he finds anything susceptible to be fraud, or if he finds any fraudulent activity or an act of excess power, or if he smells any foul play in any transaction, then that accounting professional should refer the matter to the regulator. Who is that regulator? RBI. Any deliberate failure, in case if you make any failure intentionally, if you fail to report that matter to the RBI, you will be held liable, you will be punished. Even SA 240 also says that, and whatever reporting requirements as per SA 240 is there, that also you have to fulfill. SA 240 is actually the standard talking about fraud and related matters. This we will learn at the CA final level. This I will teach you at the CA final level. So even that reporting requirements under SA 250 also you have to comply. In addition to that, even you have to check the compliances with the laws and regulations as per SA 250. These two standards we will discuss at the CA final level. And in addition to that reporting of fraud to the RBI, even you are required to report the fraud to the central government under 143 subsection 12. Even that 143 subsection 12 reporting requirements also will be applicable. Clear? So these are all the reporting requirements. So these are all the major concepts, guys. So with this, I have covered the most important concepts from this Audit of Banks chapter. Hope you guys have understood this chapter, Audit of Banks.
Now we will start revising the next chapter, which is going to be Audit of Cooperative Societies. Very small, we can complete in no time. So let us try to revise now the chapter called Audit of Cooperative Societies. So let me open the material here. Yeah. So first, let us try to revise the what is basic difference between the company kind of legal form and cooperative society kind of legal form. See, as we all know, cooperative society is just a kind of legal form. Like if you want to do the business, you can give different kinds of legal constitution. You can incorporate your business as a sole trader. You can incorporate your business as a partnership firm. You can incorporate your business as a company. So like that, one such legal form is cooperative society. And the basic differences between a company and a cooperative society is a company, few differences if I have to say, a company's membership is not restricted. Company's membership is not restricted. Like if you want to become a shareholders of Reliance Industries Limited, you can become it. Just by buying the shares in the stock exchange, you can become a shareholder of Reliance Industries Limited. See, Reliance did not say that to become a member of Reliance Industries Limited, you must own a petrol bunker. Did they say it? No. Similarly, you and I can just like that go and become the members of Infosys by buying shares in the open market. But in the case of cooperative societies, the membership is restricted. The membership is what? Restricted. Only people belonging to one particular profession, occupation, business can only become members of cooperative society. Whereas in the case of company, no restriction. Anybody can become a member. So if I have to give you some examples, some cooperative societies will be there, which will accept membership only from those people who are in the business of dairy business people only they will accept. Some cooperative societies will accept membership only from those people who are farmers. So some cooperative societies will accept membership only if those people are belonging to some small scale industry. So like that, in the case of cooperative society, the membership is restricted. You should belong to one particular occupation, business or community to become a member of cooperative society. There is no such restriction when it comes to company. And one more point of difference here, the main objective of creation of companies will be profit intention, to make the profits. But cooperative society's main intention is not making profits. The main intention of creation of cooperative society is to provide service to all its members. What is the main objective of cooperative society? To provide service to its members. That is the main objective of cooperative society. And even there is a principle, the basic principle on which cooperative societies will be created is one for each and each for all. If I have to give you one best example, Amul is actually a brand name of a cooperative society in which the people who are there in the dairy business will become members of this cooperative society. They are created, this Amul cooperative society was created to provide benefits to all its members, to increase the standard of living of all those people who are engaged in that dairy business. So the main objective for the creation of cooperative society will be service to its members. Understood? And there will be different kinds of cooperative societies will be there depending on the business which they are doing, depending upon the functions which they are performing. There could be producers cooperative society, there could be consumers cooperative society, there could be cooperative credit society, or even we can call them as cooperative banks, or even there could be housing cooperative societies also. So depending on the functions they are performing, depending upon the members whom they are accepting, there will be different kinds of cooperative societies like producer cooperative society, consumer cooperative society, credit cooperative society, and housing cooperative societies. And when we talk about governing laws, sir, what are the governing laws for this cooperative society? The governing laws for the cooperative society will be two. One is Cooperative Societies Act 1912. And in case if the cooperative society is a multi-state cooperative society, then they have another act, Multi-State Cooperative Societies Act 2002. So what are governing laws for the cooperative societies? There are actually two. In case of a normal cooperative society, Cooperative Societies Act 1912 will become applicable. In case if the cooperative society is a multi-state cooperative society, then Multi-State Cooperative Societies Act 2002 will become applicable. Now what is multi-state cooperative society? The name itself says if the cooperative society is having its presence in more than one state, then it will become a multi-state cooperative society. And in case if the society is a multi-state cooperative society, then MSCS Act, Multi-State Cooperative Societies Act 2002 will become applicable. So now in this chapter, we will revise how to conduct audit of cooperative societies as per the rules and regulations given under Cooperative Societies Act 1912 and Multi-State Cooperative Societies Act 2002. Clear? So now let us start revising concepts relating to this audit. First of all, what books of accounts are required to be maintained by cooperative society? What are the books of accounts which are required to be maintained? So under the Cooperative Societies Act 1912, the power has been given to state government to prescribe books of accounts for the society which are operating in their respective state. Like if AP state is there, AP state government will decide what books of accounts are required to be maintained by the people, maintained by the societies who are there in the AP state. If the Maharashtra state government is there, Maharashtra state government will prescribe what books of accounts are required to be maintained by cooperative societies in Maharashtra. So like that, under the Central Act, the state government has been given the power to prescribe the books of accounts. But every state government should prescribe some minimum books. Every state government should prescribe minimum books. What are the minimum books to be prescribed? All sums of money received and expended by the society, nothing but cash book. Every state government must prescribe for the societies in their state. They have to maintain a record which contains the details of money received and expended, cash book, and records relating to sales and purchases of the goods by the society, records relating to assets and liabilities of the society, and in case if the society is engaged in manufacturing of the goods, then records relating to utilization of material and labor, nothing but cost records. So these minimum records must be prescribed by every state government. And these records are only minimum requirements. The society is always at the liberty, at their choice to maintain additional records. Even state government also can prescribe additional records. The above four are what? Just minimum requirements. If the society wants, they can maintain extra records, or if the state government want, they can also prescribe for extra records.
So what could be that example of additional records? It could be a daily cash sales summary register, or it could be a register of collection from debtors, or it could be a register for recording recovery of loans, or even it could be a loan disbursement register. Like this, additional records also can be maintained, and even these additional records also just illustrative examples. These are also not conclusive list. So the conclusion which I want to make here is the society, after maintaining minimum books, they are at their choice, or even state government may prescribe additional books also. Whatever additional book they want, they can prescribe, or whatever additional books the society want to maintain, they can maintain at their own freedom. Clear? Next, what services can a chartered accountant provide to a cooperative society apart from audit? We will provide audit. We will do audit of cooperative societies. But in addition to that, what other services we can provide apart from that? So nothing but you can write here section 144 services. That entire list you can write here. We can help them in guiding in the accounts writing. We can help them in installation of accounting systems. We can help them in internal audit. We can provide management consultancy services. We can provide taxation services. So not just audit, we chartered accountants can help the cooperative societies in these various manners. Understood? Now, let us try to understand some restrictions about the cooperative societies. See, cooperative society cannot function in whatever manner they want. Like as I have told, they cannot make anybody a shareholder. Similarly, on their financial matters also, there are so many restrictions imposed. Here the restrictions are very higher than when compared with the company. In the cooperative society, restrictions are very higher. Like there is a restriction on maximum shareholding which one person can hold. There is a restriction on loans. There is a restriction where the society can go and invest their funds. So like that, in the case of cooperative society, there are a lot of restrictions. Here I have given a few scenarios. Let us see that restrictions. Number one, restriction on shareholding. One person cannot hold how many number of shares he wants. There is a maximum limit which one person is permitted to have the shareholding. So that limit is the maximum amount of shareholder that a single member can hold is either 20% of the total number of shares or having a face value of 1000 rupees, whichever is lower. A single member can hold only maximum of either 20% of the total number of shares, or if they are having a value of 1000 rupees, whichever is lower, only that many maximum shares a individual person can hold. Similarly, the society cannot give loans to anybody. But what in fact Cooperative Societies Act says is, society shall not make loan to any person other than member. Which means a cooperative society can give loans to its members. Other than members, the cooperative society shall not give the loan. However, with a special approval from the registrar of cooperative societies, a registered society can make a loan to another registered society. Generally, every society has been given the power to give the loans to its members. But apart from that, a society can give loan to another registered society, provided they can do it only after getting approval of the registrar of cooperative societies. Then borrowings. There is a restriction on borrowings being accepted. The society shall not accept loans and deposits from persons who are not members. They can accept deposits only from members. From other than members, they can't even accept the loans and borrowings also. And whatever funds the society is having, they can't invest that money wherever they want. The society can't go and invest all their money in the stock markets. There are specific instruments specified in which the society shall invest their money. Apart from these sources, apart from these assets, the society shall not invest its money anywhere else. So where exactly they can invest the money? Like they can invest in central or a state cooperative bank. They can invest in any other bank other than a state or central bank. Like for example, a normal nationalized banks, etc. In that banks they can invest. Or in any of the securities which are specified in section 20 of the Indian Trust Act, like treasury bills, government bonds, etc. Like that, some instruments are specified under Indian Trust Act section 20. In that instruments also society can invest. Or even they can invest in shares, securities, bonds, debentures of another society. That too with a limited liability, not in the share market, guys. A society can buy the shares, securities or debentures of another society with limited liability, not in the shares of the companies or in any other monies permitted by central or state government. So even there is a restriction on the society to invest their money. They can't go and invest it wherever they want. Only in these instruments they have to invest your money. Next one, appropriation of profits to reserve fund. That means every society shall transfer 25% of their profits to reserve fund. They need to maintain one separate fund with the name reserve fund. Every year, out of their profits, 25% of the 25% of the profits should go to reserve fund before distributing the dividends. That means a society can distribute dividends only out of those profits which are left after transferring the required 25% to reserve fund. So now every year they will make this, they will transfer this money to the reserve fund. No, what they will do with that money? So for what purpose they will use that reserve fund? So here if we read the 9th point, investment of reserve fund outside the business or utilization as working capital. Generally, this reserve fund will be once again used for the cooperative society's business only, for their working capital only. But in some cases, some special purposes also you can use it apart from business and working capital requirements. So whatever 25% of the money we are transferring to reserve fund, that will be generally used for business. But as per the act, for some other purposes outside of the business also the society can use. What are that other purposes outside of the business? So some of the state acts, and once again this permission is not given by all state governments, only some state governments they are giving permission. You can invest this reserve fund in some sources outside the business. So what are that some state acts providing? So some state acts provide that a society may use the reserve fund in the business of the society as a working capital. This everybody can do. Or they may invest it as per the provisions of the act. Nothing but just now we have read where a society can go and invest their money. No, this 4th point. So whatever money which is there in the reserve fund, that money in the reserve fund can be invested in these also, in these instruments also. Or it may be used for some public purposes like which promote the objective of the society. If you feel that if you incur the money in the reserve fund, it will promote the objectives of the society. So even you can use it for some public purposes which will promote the objective of the society. And even the auditor should ensure that strict compliance with the rules and regulations in this matter. Utilization of reserve fund should be seen very, very carefully. So whatever money that they are transferring to reserve fund, that can be used for business, working capital, they can go and invest in the specified instruments, or they can use it for even any other public purposes if they believe that that is going to promote the objective of the society. So this is what regarding reserve fund. Apart from that, if at all, if any society wants to contribute some money for charitable purposes, they can't use whatever amount they want for charitable purposes. Even on that also there is a limit. A society may, with the sanction of the register, with the approval of the register, they can contribute an amount not exceeding 10% of the net profits, which is remaining after compulsory transfer to the reserve fund. Which means assume that if the society has made 100 crores of profits, in this 25% will go to reserve funds. 25% will go to reserve fund. So if you take that 25 crores, remaining profit will be how much? 75 crores. In that 75 crores, 10%, maximum 10%, a society can contribute for charitable purposes. Don't be of a wrong notion that out of this 100 crores, 10%. No. After taking the amount of the reserve fund, whatever rest of the profit is left out, in that 10% can be invested in, can be used for charitable purposes. Maximum only 10%. That too, for contributing that 10%, you need approval of Registrar of Cooperative Societies. And if you want to contribute some amount to education fund, that also you can do it, provided at prescribed rates. So different states have given different rates. Some state 2%, some state 3%. So according to the rates prescribed by the state government, they can even transfer it to education fund. And if they want to make any other appropriations, they can do any other appropriations subject to the compliance with the rules given by government. Understood? See, these many restrictions will be there in the functioning of the cooperative society. These many restrictions will not be there in the case of company, but cooperative societies will contain these many number of restrictions. Restriction on the shareholding, restriction on the loans, restriction on borrowings, restriction on spending on charitable purposes. For everything we have a restriction. So whatever points I have told you, all these are important for MCQs, true or false statements, etc. Clear? Now let us come to the audit related matters. For a normal cooperative society, who is eligible for getting appointed as an auditor? For company, we have seen. For company, who is eligible for getting appointed as an auditor? A chartered accountant having certificate of practice. For a cooperative society, who is eligible for getting appointed as an auditor? Let us see. So eligibility to get appointed as an auditor, generally a chartered accountant having a valid certificate of practice is only permitted to act as auditor of cooperative society. A chartered accountant having COP. But in addition to that, any other person
having qualification as required by respective states. That means all over India, chartered accountant having certificate of practice can be appointed as auditor. But what some state governments have done is, we will not only consider chartered accountant, we will even consider other qualifications also. Like what qualifications? So a person who is holding a government diploma in the cooperative accounts, or a person who has served as an auditor in the cooperative department of a government. These other qualifications also will be considered, not by all the states guys. Only some state governments have told that we will accept chartered accountancy having certificate of practice, but we will accept even other qualifications also, like what, a person who is holding diploma in cooperative accounts, or a person who has served as auditor in cooperative department. These other qualifications also will be considered, but once again I am saying not all over India, only some states. All over India, which qualification is accepted? Chartered accountant having certificate of practice. Clear? Now, who will make appointment of auditor of a cooperative society? They have very straight away told that registrar of cooperative societies will be there. They will make the appointment of auditor of the cooperative society. Neither members nor the board. The registrar of cooperative society will make the appointment of auditor of a cooperative society. And the auditor so appointed, after he has completed the audit, he will submit the report to registrar only. And fees will be decided by the registrar, but it has to be paid by the society. Appointment done by registrar. Report will be sent to registrar. Fees will be decided by registrar, but fees will be paid by society. Clear? Next one. Now there are some special points which will be there while you are doing audit of a cooperative society. So what are that special points? Some 10 special points they will try to say here. Let us try to understand. First one is regarding overdue debts. First of all, what is the meaning of overdue debts? Overdue debt means what? An amount which is outstanding beyond the due date. So regarding overdue debts of a cooperative society, auditor will have 3 responsibilities. Number 1 is classification. Into 3 categories he need to classify, which are overdue for 0 to 6 months, 6 months to 5 years, and more than 5 years. 3 classifications he is supposed to do. After doing classification, he need to assess out of these overdue debts, how many are recoverable, how many are not recoverable. After doing that assessment, the auditor should make sure that there is enough of provision has been created for those debts which are considered to be irrecoverable. So 3 responsibilities on the auditor regarding overdue debts. What are they? Classification, assessment of recovery, and then whether enough of provision has been created for doubtful debts. So this is what the first special point. Second one, overdue interest. Now first, what is the meaning of overdue interest? Overdue interest means interest which is accrued or accruing in the accounts in respect of which principal is overdue. Those accounts in which principal is overdue, in that accounts whatever interest that is accrued or accruing. For example, I have given loan to one person. 1 lakh rupees of loan I have given. That is a principal amount. Due date is 31st of March. Due date is over, but I did not receive this principal. Now during the tenure of the loan, some interest would have been accrued. No, some 10,000 rupees of interest is accrued. So the interest accrued in respect of those accounts where principal is overdue, that we call it as overdue interest. And accounting treatment we need to verify here. Accounting treatment is this overdue interest will be excluded from interest income. That means it will not be considered while calculating interest income. It should not be taken to statement of P&L. But instead what needs to be done is it has to be taken to one reserve, overdue interest reserve. And from that reserve, it will be transferred to P&L when it is actually realized. Overdue interest will not be taken to statement of P&L directly. But instead what we will do, overdue interest, we will take it to the reserve account, overdue interest reserve. From that reserve, we will take it to P&L when it is actually realized. Which means simply what they are trying to say here is overdue interest should be recognized on cash basis, not on accrual basis. That is what they are trying to communicate here. Very simple point. Third one, bad debt, certification of bad debts. See, some state governments say that if any bad debt has to be written off, that compulsory needs authorization by auditor. Some state governments say this. If a society has to write off some debt as bad, it needs approval, authorization from the auditor. If the state government is putting such requirement, now there is additional responsibility on the auditor. He should check the debtors balance and certify whether they are really bad or not. When there is no such requirement from the state government regarding auditor certification, then auditor need not authorize, but auditor need to check whether managing committee authorized or not. Simple. If there is a authorization requirement on auditor, auditor will authorize. If there is no such requirement, auditor will check managing committee authorized or not. Understood? Now, fourth point, valuation of assets and liabilities. This is not anything a special point. This is what routinely we do in every audit. So when it comes to assets, we need to check existence, ownership, valuation of the assets. We need to check that fixed assets are valued at cost less accumulated depreciation. We do it everywhere. And whatever incidental expenses are there, like installation expenses, etc., that also should be capitalized. And whatever current assets are there, they should be valued at cost or market price, whichever is lower. Simple. And when it comes to liabilities, all known liabilities should be brought into account. That means all known liabilities should be shown on the balance sheet. Whatever contingent liabilities are there, they should be shown by way of notes to accounts. That's it. Fifth one, adherence to cooperative principles. See, in the case of cooperative society, just checking financial statements alone will not be enough. Even I need to check for whatever objectives the society has been set, whether that society is able to achieve its objectives or not. So especially in the case of cooperative societies, it is not just enough for me to check the financial statements. I need to even check for whatever objective the society has been set up, whether those objectives are met or not. Sir, on what basis I will assess whether they have achieved the objectives or not? On the basis of profits? No. Whether society has achieved the objectives or not, that I should not assess it on the basis of profits, but I should find it out on the basis of services provided to the members. If the society is providing more services to the members, yes, it is achieving the objective. And even we need to consider principle of propriety. That means in the cooperative societies audit, it is not just enough to check the supporting documents. We should even check whether any expenditure is wastefully getting incurred. We need to find out, even when we are verifying expenses, even we need to check that no expense has been wasted. No expense should be incurred without any value addition. So checking that wastage in the expenditure, I call it as what? Proprietary audit. That I have to do it in the case of cooperative societies. Clear? Next one. And apart from that, I need to check all the laws and regulations which are applicable to the society have been complied with or not. Next one, I need to verify the members' passbook, especially in the case of rural cooperative credit societies. So in the rural cooperative societies, people will be illiterate. So their society's management might try to cheat the members by passing wrong entries in the members' passbook. So in the case, if I am conducting audit of a society, that too in a rural area, I need to check the members' passbooks also. And regarding certain matters, the auditor should submit a special report to the register. Regarding 4 matters, auditor should submit a special report. In addition to the main report, you need to submit one extra report. Regarding which matters? 4 matters. What are they? Personal profiteering. If you find that the management of the society, instead of providing benefits to the members, they are getting personally profited out of the transactions of the society, you need to report this matter specially to the register. So personal profiteering by the members of the managing committee. Or if you find out any fraud, regarding that fraud also you have to send a special report. If you find any mismanagement, that means management is taking decisions against cooperative principles, send a special report. And in the case of urban cooperative banks, if you find any disproportionate advances, that means society is giving advances without checking any security, credit worthiness, they are not collecting money. So if you find any of this reckless advancing, this also should be reported to register. So these are the 4 matters regarding which auditor should send a special report. In addition to that, you need to award a class to the society. After you have done the audit, you would form some understanding about functioning of the society. On the basis of understanding of functioning of the society, auditor should award a class. Award a class means giving a grading, like A++. So like that, some grading will be there. Some criteria will be given by the register. According to that criteria, auditor should even award a class to the society, give a grading or ranking to the society. And finally, you should never finalize the audit report without first communicating with the managing committee. So you finalize audit report only after having a discussion with draft audit report with managing committee. But once again here, you are not supposed to take the permission. Just you have to let them know how you are going to give the audit report. That's all. They're not asking you to take the permission. Just have a discussion and do whatever you want to do. So these are all the special points in the audit of a cooperative society. Now coming to the next few questions, what are rights and duties of auditors of cooperative society? When it comes to powers, very simple. The auditor will have access to all the books and documents. The auditor can get extra information and explanation also by inquiring every officer of the society, similar to rights of company auditor only. Now, what will be the duties of cooperative auditors? So the auditor should mention in his audit report whether he has obtained all the necessary information and explanation, whether in his opinion financial statements give true and fair view, whether proper books of accounts are maintained by the society, and whether financial statements are in agreement with the books of accounts or not. So on these are 4 mandatory responsibilities on the auditor which he should mention in his audit report. Now, there are certain matters regarding which auditor need to attach schedules. Previously, we have seen special report. Special report means altogether separate report will be given to the registrar. But here I am saying schedule. Schedule means not altogether a separate report. Schedule means just an attachment to the main audit report. So regarding certain matters, auditors should need to attach a schedule, an extra attachment to the main audit report. So for which matters schedules will be attached? So once again 4 matters. What are they? If you find any transactions which are against to the provisions of the act. If you find society has done any transaction which are against to the applicable laws and regulations, you have to attach a schedule for that. All sums which ought to have been brought but not brought into the accounts by the society, like omissions. If you find any entries which are supposed to be included in the books but the society did not include it, attach a schedule for that. Or if you find any asset belonging to the society which is bad or doubtful of recovery, add it as a schedule. And similarly, if you find any irregularity or impropriety in expenditure, regarding that also you have to give a schedule. Understood? So these are the 4 matters regarding which schedules are to be attached to the audit report. So till now, whatever questions we have seen, those are all related to audit of a normal cooperative society. Now we have a few set of questions which are related to audit of a multi-state cooperative society. See, normal cooperative society audit will be governed by Cooperative Societies Act 1912. Multi-state cooperative society related matters will be governed by Multi-State Cooperative Societies Act 2002. Now let us see what does Multi-State Cooperative Societies Act say about audit of a multi-state cooperative society. First of all, qualification. Who is eligible for conducting audit? Here strictly only chartered accountant having a certificate of practice. For a normal cooperative society, some state governments will consider other qualifications also. But for a multi-state cooperative society, no other qualifications are considered. Only chartered accountant having certificate of practice can only be appointed as auditor of a multi-state cooperative society. And disqualifications, even auditors will suffer from some disqualifications. Who are ineligible for getting appointed as auditor of a cooperative society? Who are they? A body corporate can't be appointed. An officer or employee of the society can't be appointed. A person who is a member or who is in employment of an officer or employee of the society. 141 subsection 3. I think you are able to make some sense. 141 subsection 3 clause A, same thing they say, body corporate, officer or employee, somewhat similar to that. Similarly, a person who is indebted to the multi-state cooperative society or who has given any guarantee or provided any security for an amount exceeding 1000 rupees, those people also will become disqualified. And after appointment, if you attract any disqualification, like under Companies Act, we should here also immediately vacate the office if we attract any subsequent disqualification. Now, authority to appoint. Who will appoint the auditors? In case of first auditor, the auditor will be appointed by board of directors within 1 month. In case of Companies Act, they say 30 days. Here they say 1 month. Don't use these terms interchangeably. 1 month is different, 30 days is different. So please use appropriate terminology. So in the case of multi-state cooperative society, first auditor will be appointed by board within what duration? 1 month. And in case if the board fails to do it, the power will go to members of the society. They will do it in the general meeting. And what is the tenure of the first auditor, sir? Till the conclusion of first AGM. What will be the tenure of subsequent auditor? Now, who will appoint subsequent auditor? Members will do it. And what will be the tenure of subsequent auditor? Till the conclusion of next AGM, they are supposed to hold the office. Clear? So these are the related matters. These are the auditors related provisions as stated in Multi-State Cooperative Societies Act. Now, powers. Powers are same two powers. He shall have access to all the books and documents. He can inquire officers and get the extra information. Now, coming to the duties. Duties, they have given it under 3 sections. 73 subsection 2. Auditor is required to report on some matters. This will be very much similar to whatever we have revised in audit reporting. 143 subsection 1. Under 143 subsection 1, there are 6 points which are required to be reported. Out of that, 4 they will give it here. Next one, 73 subsection 3, nothing but right of the auditor to report to the members. This we have seen in the chapter company audit. In the company audit, rights of the auditor, we would have seen one point, right of auditor to report. The same paragraph will be reproduced here. And they have given some duties under 73 subsection 4. This will be very much similar to 143 subsection 3. There we have seen 15 matters. Out of that, first to 4 points will be given as it is here. Understood? So this is what the duties are. Almost exact provisions, and even limited number of provisions which have been copy pasted only from Companies Act. Clear? So this I am not wasting the time here to explain it in a detailed manner. Then we have last 3 questions left in this chapter. These are a bit important and conceptual. There we will try to spend the time. Now, first we will talk about, in the case of multi-state cooperative society, the central government has been given the power to order for special audit. Who has been given the power to order for special audit? Central government has been given the power to order for special audit of a multi-state cooperative society. When I say special audit, this is in addition to the statutory audit which will happen every year. So section 77 of the Multi-State Cooperative Societies Act, it has given power to the central government to order for special audit. When I say special audit, what do I mean here? It is an additional requirement in addition to the requirements of statutory audit. Now, but central government will not do it for time pass. So central government will do it only when they come across some circumstances. So in what circumstances central government will order for special audit? They give 3 circumstances. If the central government came to know that the affairs of the society are not being managed in accordance with cooperative principles. That means if the central government came to know that multi-state cooperative society is not working for the benefits of the members, instead the management is trying to get benefit out of it, then the central government may order for special audit. Or if the central government came to know that that society is being managed in such a manner that it is likely to cause a serious damage to the entire industry or trade, or central government came to know that multi-state cooperative society, one society is there, it is working in such a manner that not just that society is getting affected, entire industry is in danger, then also they can order for special audit. Or the financial position of the multi-state cooperative society is very bad that its solvency position is in danger. It is about to go bankrupt. Such a bad financial position they are having. So if the central government comes across any of these 3 circumstances, which 3 circumstances? If the affairs are not being managed in accordance with cooperative principles, or the operation of the society is in such a manner that it is likely to cause a serious damage to the entire industry, or the financial position of the society is very bad that its solvency position is in danger. So if the central government comes across any of these 3 circumstances, then they will order for special audit. But one condition here, having these 3 circumstances alone will not be enough. Even one more condition should be fulfilled for the central government to order for special audit. What is that one more condition? That condition is the central government or state government shall hold 51% or more of the paid up share capital in such society. Here is what the condition. Just having the above circumstances alone will not be enough. If the central government wants to order for special audit, the central government or state government or their combination should hold minimum 51% of the paid up share capital in that society, then only they can order for special audit. If that shareholding is not there, even the above circumstances are present, they can't order for special audit. So if they ask you write about applicability of special audit, you need to write that 3 circumstances along with this condition. Now, what is the procedure for conducting special audit? First, who will appoint the special auditor? Central government only will appoint. Who will be appointed to do the special audit? Either they can appoint a chartered accountant, or they can appoint the society's auditor, statutory auditor himself as a special auditor. It's up to central government's decision. Appointment will be made by central government, and whom they will appoint? They can appoint any other chartered accountant, or they can appoint the society's statutory auditor himself to do special audit. That's up to the choice of central government. Who will decide the remuneration? So, remuneration will be decided by central government, paid by the society. Central government will decide it, this much remuneration. Who will pay it? Society has to pay it. Sir, what will be the powers, sir? Same like the powers of normal statutory auditors.
To whom the special auditor will report, sir? To the central government special auditor will report. What matters he will report, sir? That central government will say. On what matters you are supposed to report? Central government will say. Now, who will take action on that report, sir? Central government only will take action. What action they will take, sir? Whatever they feel appropriate as per relevant laws and regulations, they will take that action. Sir, report is submitted, 4 months is over, but still central government did not take any action. Then what should happen? Then what should happen is the central government shall submit that report of special audit along with the central government's comments to the multi-state cooperative society. If they take action within 4 months, well and good. If the central government is not taking any action within 4 months from the date of receipt of the report, then what central government should do is the special auditor's report along with that central government's comments must be sent to multi-state cooperative society. And the central government shall ask multi-state cooperative society to circulate that copy or extracts of that special auditor's report to each and every member of the society, and also to read it out before the next society's meeting, general meeting. Understood? So if they take steps within 4 months, well and good. If they are not taking it, the central government will send it to society and it will ask the society to circulate this report to every member and also read out this report before next general meeting. Understood? Now, we are left with 2 more questions from this chapter. Power of central registrar to order for inquiry under section 78. Power of central register to order for inspection under section 79. See, special audit power has been given for central government. In addition to that, central registrar has been given the power either to order for inspection under section 78, or even they can order for inquiry under section 78, or they have been given power to order for inspection under 79. First, we need to understand difference between inquiry and inspection. Inquiry means calling somebody to your office and asking the question. Inspection means what? Registrar themselves will go to the society's premises and start verification. That is what we call it as inspection. Which powers are given? Both the powers are given. Which thing registrar will do depending on facts and circumstances of each and every case. But there are some formalities which central registrar has to follow before doing this inquiry or inspection. Both the answers will be same. We will try to complete both the answers in one go. So before central registrar can make either inquiry or inspection, someone should make an application to the registrar. Who can make that application? So any creditor, or not less than 1/3 of the members of the board. If there are total 9 board of directors, not less than 1/3, minimum 3 directors should make an application, or not less than 1/5 of the total number of members. If there are total 100 members, 1/5, minimum 20 members of the society. So these are the people who are eligible to make an application to the central registrar asking to conduct inquiry. Not just inquiry, guys, even for inspection also, the same people are required to make an application to the registrar. Clear? Next. To whom application will be sent? Obviously, central registrar. If you are expecting central registrar to conduct inquiry or inspection, to them only you have to send your application also. Now, who will do the inquiry, sir? Both inquiry and inspection, it will be done either by registrar himself will do it, or he can authorize some other person to do the inquiry or inspection. Same point even for inspection also. For cross reference, you can see inspection by whom? Either by registrar himself or any other person authorized by him. And one more thing, before doing that inquiry or inspection, minimum 15 days of notice must be given to the society. Both for inquiry and inspection, before any inquiry or inspection can be ordered, minimum 15 days of notice must be given to society. Then only you can do inquiry or inspection. Now, what will be the powers of the person making inquiry? So, whoever is conducting that inquiry, either registrar or any other person authorized by him, that person will have power to access all the books and documents. He can call any officer of the company to bring any officer of the society to bring the books to his place and ask questions to them. So he will have right of access to the books. And even the person conducting inquiry will be given the power to call for general meeting also. First he will go and request, sir, please call for general meeting. If officers are not listening, the person conducting inquiry himself will have the power to call for general meeting by himself. And even the person conducting inquiry will have the power to issue summons also. Summons means legal notices. He will have the power to issue legal notices like a court order. Summons means what? Giving something similar to court order.
Anybody who is in receipt of summons, they must appear before the regulatory authority on so and so date, otherwise it will be a punishable offense. So like this, the person whoever is conducting inquiry, he will have three powers: right of access to the books, right to call for general meeting, and even he will have the power to issue summons also. Similarly, the person whoever is making inspection, he will also have some powers, like he will also have access to the books and documents, and if he finds any serious irregularities, he can take that books into his custody also, and with the prior approval of the register, he is even having right to call for a meeting. Even when it comes to powers also, two powers are common. Both for person conducting inquiry and inspection, two powers are common: right to access to books, right to call for general meeting. Person conducting inquiry will have a power to issue summons. Person conducting inspection will have a power to take the books and documents into his custody. Only one power will differ, two powers will remain common. Now, once that inquiry and inspection is completed, what will happen? What will happen is the central register, within a period of 3 months from the date of completion of inspection or inquiry. Within what duration? Within 3 months from the completion of inquiry or inspection, that report of inquiry or inspection should be sent to multi-state cooperative society and also to the person or authority at whose instance that inquiry or inspection is needed. So within 3 months from the completion of inquiry or inspection, the central register shall submit that copy of inquiry report or inspection report to the society. Along with that, at whose instance, whoever has made the application asking for inquiry or inspection, to that person also you have to send one copy of that inquiry or inspection report. That's all. These are the provisions of Cooperative Societies Act dealing with audit of normal cooperative society and multi-state cooperative society. So successfully we are done with revision of Cooperative Societies Audit chapter. Clear everyone? Good now. Now we will try to revise one small topic called government audit. So as the name itself says, this chapter is going to give us a brief about how do we do the audit of government oriented entities. So as we all know, the governments in our country are operating at three levels, that is at the central government and also at the state government and local body level. And if you observe, each and every level of government will be having incomes. They make incomes. So does the central government have income? Yes. In what form they will have income? Collection of taxes. Like if you take central government, all the income taxes and CGST component of the GST, these things will go to central government. Similarly, state government also will have their share of income from SGST component of this GST. And apart from that, the local bodies like municipal corporations, etc., they will also have their share of income from local taxation like municipal taxes, water taxes, etc. So like this, at all levels of government, if you observe, they are going to have incomes. At the same time, they will even spend the money. They are going to even spend the money also, whatever income they are having. They will have expenses. They will have their assets. They will have their liabilities. And the governments at all these levels will maintain books of accounts. They will also prepare financial statements. Do you think audit of these books of accounts and financial statements of the government is required? Yes, very much required. Why? Because the levels of government, whatever income they are having and whatever they are spending, that is not the money which they are spending from their own pockets. That is the money which they are spending is public money. The common public like you and me who have contributed this income in the form of taxation, that is what the income which is going to the government, and that is what the government is spending the money. And as we all are aware, the government money, the whatever money the government is spending, that is supposed to be for the benefit of common public like you and me, which generally will not happen. So but objective is what? To make sure that whatever income that has accrued to the government, that should be spent for the public welfare. So like any other entity, the audit of governments is also of utmost importance. And if you ask me, then any other entity, the audit of the government entities are very important. Why? Because that is where the public money is involved. That is where the public money is getting used. That is where the public money is getting collected. So this chapter is going to throw a brief on, we are going to throw some light on briefly relating to the concepts of government audit. We are not going to have an in-depth or a detailed understanding of how to do the government audit. It is just a brief or overview of what actually happens in the government audit related matters. So let us try to understand. Here they will try to say in this chapter how to conduct audit of government expenditure, how to conduct audit of government revenue, how to conduct audit of stores and inventories. And also whenever we say government related accounts and audit related matters, whenever we speak about government related and government related audit and accounts matters, a authority will come into picture who will be referred as C and AG, Comptroller and Auditor General of India. Like that, an authority will be there. This C&AG is going to be the authority who is going to look after accounts and audit related matters of all the governments and government related entities. So in this chapter, even we are going to revise about the provisions regarding that C&AG. What are the duties of C&AG? What are the powers of the C&AG? What is his tenure? What role he will play in the government audit? And what role he will play in the company audit? So all that things we are going to have a quick revision. Clear? So without any delay further, let us proceed with the concepts. First of all, how the term government auditing has been defined. So if you have a look at the definition, government auditing is an objective, it is an unbiased and systematic, professional and independent examination of financial, administrative and other operations of a public entity. So in the government audit, we are not just verifying financial information, we are verifying financial, administrative and even other operations of the entity which are made subsequent to their execution. That means once the government executes all these activities, then we will verify, not before execution. After government has executed their functions, then we will go and verify. And also, just a minute, let me zoom out a bit further. And for the purpose of evaluating and verifying them, we are going to analyze and verify their activities with the objective of presenting a report in which we will tell our comments, we will tell our findings, even we will give recommendations for further improvement of that government entities, and even we will express a professional opinion on that financial information of the government. So what in short we are going to do in the government audit? We are going to examine. Here also in an objective, systematic, independent manner, we will examine financial, administrative and other operations of a public entity which are made subsequent to their execution, and we will evaluate, we will prepare a report, tell our findings, give our recommendations for improvement. Along with that, even we will express our opinion on that financial information of that government entity. And why we do government audit? Why? Because we have some specific objectives here. We want to make sure that whatever public funds are there, whatever funds the government is collecting from the public, whether each and every rupee is properly getting accounted or not, that we want to find out. Second objective, appraisal of government policies. Whatever policies the government is implementing, we will review whether those government policies are really for the benefit of the people or some middleman is getting benefited out of it. That review of the government policies also we will do. Along with that, even our audit will form basis for corrective actions taken by higher officials. So by doing audit, we will find out weaknesses where the ground level government employees are doing wrong. So by that audit observations, what higher level government authorities will do is they will take appropriate actions. So our audit report is going to form the basis for actions to be taken by the higher officials in the government, and even it will ensure accountability. The employees and staff will become more responsible, more accountable. Why? Because they will have a fear that auditor will come and verify the transactions. So that will make them do their work with more responsibility. So these are the four objectives of why government audit will be conducted. Why it will be conducted, guys? For ensuring proper accounting of public funds, for appraisal of government policies, for taking corrective actions, and also for ensuring accountability among the government employees. And this is what government audit is all about. Now we will try to have a revision of how to verify government expenditure, or what points we will try to verify in the government expenditure, what points we will try to verify regarding government revenues, what points we will try to verify regarding government stores and inventories. So all that things we will try to focus. First one, the most important aspect of government audit is verifying of expenditure made by the government. So whatever expenditure which the government has made, that we need to verify. And that expenditure need to be verified from 5 perspectives. Whatever expenditure that government has made, that expenditure need to be verified, and that expenditure we have to verify from 5 perspectives. So you could see the 5 perspectives here: audit against rules and orders, audit of sanctions,
Similarly, audit against provision of funds, proprietary audit, and performance audit. So like this, whatever expenditure government has incurred, that expenditure an auditor should verify, and that when we are verifying that government expenditure, 5 principles we need to verify. Number one, audit against rules and orders. The name itself says whatever expenditure which the government has incurred, that expenditure should be in accordance with relevant laws and regulations. No government authority should spend the money beyond the laws and regulations. That is the first thing which auditor should verify. Whatever expenditure which the government is making, whether it is as per financial rules and regulations or not, that we need to check. That's what, even if you could see here, statutory enactments, statutory laws and regulations, whatever has been set, expenditure has been incurred in accordance with laws and regulations. Audit of sanction. Sanction means nothing but approval. Every expenditure made by the government, that should contain some approval from concerned authority. When I say approval, depending upon the level of government, who will approve will change. If the central government is making expenditure, some ministry will approve. If the state government is making expenditure, some MLA will approve. If the local body is making some expenditure, that collector or public officials, public representatives will approve. So like that, whatever it is, whatever level it could be, whatever expenditure which the government is incurring, that should be approved by concerned authority. Checking whether approval is there or not, that we call it as audit of sanctions. Then comes the third item, audit against the provision of funds. We all know government functions by way of budgets. Every year, well in advance, budget will come. So in that budget only, in which area, how much amount will be allocated will be decided well in advance. So as an auditor, I need to make sure that whatever expenditure government has incurred, that should be within the budgeted amount. So provision of funds means nothing but budget. So what amount has been allocated for one project, whether the government has incurred the money for that project within that limit only. So checking that budgets, we call it as audit against the provision of funds. Then we have proprietary audit. Once again, as I have told, verification of wastage of the funds. In the case of government audit, not just checking the supporting documents alone will be enough. Not just checking the approvals will be enough. You need to check whatever money that government is spending. Out of each and every rupee spent, there should be some value addition. Not even a single rupee of the public funds should be wasted. So checking whether there is any wastage of funds, that we call it as proprietary audit. So financial proprietary, that means there should not be any wastage of the funds. That I need to specifically check in the case of government company. Why? Because if the money is wasted, that is not government's money, that is public money which is getting wasted. So I need to check each and every rupee spent by the government is spent without any wastage. Then last aspect of expenditure verification, which is performance audit. Performance audit means nothing but government will take care of big projects and schemes like dam construction, highway construction, all these things will happen. So whatever big projects and schemes are there, which are carried out by government, whether they are giving expected benefits, whether they are complying with the targeted objectives, whether those big projects and schemes are run economically, checking that we call it as performance audit. So like this, whatever expenditure has been incurred by the government, that we will verify from 5 perspective: audit against rules and orders, checking the compliance with financial rules and regulations; audit of sanctions, nothing but checking of approvals; audit against provision of funds, whether expenditure has been incurred within the budgeted amount; proprietary audit, checking there should be no wastage of the funds; performance audit, whether big schemes and projects are getting carried out in order to meet their expected objectives. Understood? Now talking about proprietary audit in detail. Sir, you told proprietary audit means finding out whether there is any wastefulness in the expenditure. Sir, but how to decide whether an expenditure is wasteful or not? How can we decide, sir? Can you give any precise rules? Like I'm giving some 10 conditions. If these 10 conditions are satisfied, no wastefulness. If even one of the condition is violated, there is a wastefulness in the expenditure. Like this, can we define any precise rules? No. We can't decide any precise rules regarding proprietary. We can't say exact set of rules and regulations to decide what is wasteful, what is not wasteful. It all depends on common sense and logic applied by the auditor. It all depends on facts and circumstances of each and every scenario. So we can't give precise rules what is wasteful, what is not wasteful. It depends on common sense and logic, but we can give some general principles, common principles. We can say out of our common sense, we can say some random points which will help us to find out whether expenditure is wasteful or not wasteful. So what are they? Some examples they are saying here. the expenditure should not be prima facie more than the occasion demands. So you should not incur even a single rupee more than what the situation is demanding. Your expenditure should be as per the demands of the situation. You should not, just because you are having excess funds, you should not waste it. Whatever money the situation is demanding, only that money you have to spend it. And every public officer is expected to have same level of carefulness when spending public money, like the way he will have a carefulness when he is spending his money from his own pocket. Every public officer, whoever is spending the government's money, should have same level of carefulness like the way he's spending the money from his own pocket. Such a level of carefulness should be there to avoid the wastage. And also, no authority should give approval for any expenditure from which he is getting benefited either directly or indirectly. For example, if the collector is giving approval for construction of a road in which there are his plots located, so directly or indirectly, he is getting benefited out of it. He is not doing it for the common public. Here also there is a wastage in the funds. And also, public money should not be utilized only for one person or one community. That is also getting wasteful. However, in some cases, in some exceptional scenarios, we can use money for one particular person or one particular community. In what circumstances we can use government money only for one person or one community? When the amount involved is very insignificant, very negligent amount is there, that amount of money you can spend. Similarly, if there is any claim which can be enforced in the court of law, like as a part of road extension, the government has collapsed one person's building. Now, government has to pay compensation. Can the government say now, no, it will be impropriety, it will be wasteful, we cannot spend the money for one person? Can they say it? No. Why? Because if you don't pay him the money, he will approach the court. That claim is enforced. That claim is enforceable in the court of law. Or that expenditure you are spending is a policy, is a part of recognized policy or custom. Like in India, we have some policies to help that tribal people, etc., to provide them some opportunities. If there is any such policy, yes, you can use it. And amounts of allowance should be like a helping hand. They should not become a source of profits for the recipients. A source of income, if the government is spending money for one particular community, it should be like a helping hand for that community. It should not become source of profits. Like government is giving pension for old age people. See, if they are giving some monthly 2000, 2500, fine. Now some government is having a lot of excess money. Now they decided that every month they will give 20,000 to the old age people. So now, instead of giving benefit, that is acting as a source of profits in that recipients. Government expenditure should not be wasted like that. So like this, whether a fund is wasted or not wasted, that we can decide using this some common principles. Once again, these are not conclusive list, just example sake they have given this. Clear? So keeping all these factors in mind, the auditor should decide whether the expenditure is wasted or it is spent without any wastage. Then performance audit, like performance audit, as I have told you, in the case of performance audit, we will check whatever big projects are carried out, any program, any project like dams construction, highway construction, whatever big projects and schemes are carried out, whether their financial and operational performance is satisfactory. Whatever big projects and schemes which the government has carried out, whether its performance is satisfactory, whether they are giving expected results, whether they are done properly, resources are consumed properly. So checking that, we call it as performance audit. And this performance audit will have 3 more subtopics under that. Performance audit once again contain 3 more components. All the 3 are part of performance audit only. So the 3 components of the performance audit are, as you could see here, efficiency audit, economy audit, and effectiveness audit. These 3 are all what? Parts of performance audit only. Now let us try to understand what is efficiency audit, what is economy audit, what is effectiveness audit. Out of these 3, first we will start with easier one, which is economy audit. What do you mean by economy? Economical means what? Economical means if you are able to procure something at lowest possible prices, that we call it as economical. Now economy audit means for the purpose of carrying out these big projects and schemes, government need various resources. They require human resources. They require capital resources. So whatever resources they required for the purpose of carrying out this big project or scheme, whether that resources are all procured at reasonable prices. The government should not unnecessarily waste their money on procuring resources. That is, they should not pay higher prices for inferior quality of the material. They should pay reasonable prices and should get best quality of the raw materials. So checking that, we call it as economy audit. Efficiency audit, as we all know, checking whether the project is getting completed within the time limit given. So every project will have some tentative due date. So whether that project is getting completed within that expected time limit or not, and also resources during the phase when the project is going on, whether resources are consumed properly or not without any wastage, checking that we call it as efficiency audit. Effectiveness audit, which will happen once that entire project has been completed. So government has constructed dam. Now there is an objective with which the dam is constructed. Assume some 50,000 acres of land should get irrigational facilities. Now after the completion of the project, I need to check with whatever objective this project has been started, whether that objectives are met or not. So that is what we call it as effectiveness audit. So economy audit is easier to understand. The difference between efficiency audit and effectiveness audit is, efficiency audit is something which will happen when the project is still going on, whereas effectiveness audit is something which will happen once the entire project is completed, once the entire project is over, checking whether the objectives are met or not, that is effectiveness audit. Whereas as and when the project is still going on, whether it is getting completed within time, whether the resources are consumed properly, checking that is a efficiency audit. So one is carried out during the course of project, other one is carried out after completion of the project. So this is what regarding performance audit. Now next, since we are done with audit of receipts, let us try to understand how to conduct, since we are done with audit of expenses, let us now try to understand how to verify government receipts. So what will be the receipts from for the government? As I have told, taxes, direct, indirect. So all these things will be incomes for the government. Now first thing, there should be proper mechanism from the government to make proper assessment and realization. Like so many people will file their returns, but not every return will be taken up for scrutiny. So the government should have proper set of rules and regulations to decide which case should be taken up for scrutiny, to which person notice has to be sent, where to go and conduct the right. So the government should have proper set of rules and regulations for making assessments and realizations. And also they should have strict rules and regulations. See, in India, less than 5% of the individuals pay the taxes. Now even that 5% are also paying because not because of love towards the country, because there are stringent laws and regulations. So if you expect the citizens of the country to pay their taxes, you should have strict laws and regulations. On the other hand, if you request, if in the Income Tax Act, government is requesting, dear citizen, please pay the taxes. If the government is so soft in the laws and regulation, even that 5% people also will not pay the taxes. So that 5% are also paying because they have fear. They have high income, they have fear, they might get caught. So if the government wants to have proper collection of income, they should make sure that they have strict rules and regulations. Not just strict rules and regulations. Today you need to have internal controls also. Income tax department has also come up with so many internal controls, like TDS mechanism, internal control. And earlier in the olden days, there used to be double refunds. When manual return processing has to happen, there used to be double refunds, forged refunds, etc. used to be there. But now all these things are ruled out. Why? Because today everything is a digital. So in this digital environment also, the government should come up with new internal controls to stop evasion. And just having rules and internal controls alone will not be enough. They should be implemented also. You just write down this rule, this is the rule, this is the internal control. If you write it down, that alone will not be enough. You need to actually implement the same. And finally, periodically, the departments should go through judicial decisions. Case laws they have to go through. In which case laws they have lost. In which case they have lost the money. Is it because of drafting mistake in the section? If yes, try to give an amendment and redraft the section. So like this, periodically judicial decisions like case laws and also has to be reviewed by the department and try to make sure that they have eliminated all the drafting mistakes in the law. So this is what auditor needs to check to ensure whether the government is properly having all the receipts accounted. Then talking about audit of stores and inventories, routine point here. Here we don't do specifically anything new. Whatever we do in other normal audits, the same thing we will do here. Like we will check whether there are proper regulations for purchase of inventory, receipt of inventory, issue of inventory. For everything, some set of rules and regulations should be there. And also, if you find any deficiencies in the quantities of stores, that means if you find any stock has become inferior or damaged, bring it to the notice of the government. Whatever inventory they are buying, check whether it is containing proper approval or not. And whatever prices they have paid for procuring that stock, whether they have paid reasonable prices, acceptable prices they have paid or not. And in case if you find any uneconomical purchases, that means wasteful expenses, if you have found out, bring it to the notice of the management. And also check the accounts, inventory accounts like receipts, issues, balances, check all the inventory accounts. If you find any idle or excess stock, some excess stock is there which is lying there for a long period of time, check whether that excess stock is really existing, or just like that government employees are trying to fool you around. And also carefully observe valuation of inventories, check whether the valuation has been done carefully or not, do the physical verification, check the stock as per the records and physical stock both are matching or not, then only check whether valuation has been done clearly. So nothing new or specific here, whatever we do in other audits, the same thing we do even in the audit of inventories of government also. Now talking about commercial things, will the government carry out commercial activities also? I'm not talking about politicians, I'm talking about government. Will the government also carry out commercial activities? Commercial activities means what? Carrying out activities for the purpose of profit. So will the government also carry out commercial activities? Yes. And for the purpose of carrying out commercial activities, government might take up three kinds of entities. They might create three structures of entities. So government can carry out commercial activities by incorporating departmental enterprises, or they can create a statutory body, or they can even create government companies. Departmental enterprises, if I have to give example, tourism department, commercial activity, it is making money. Similarly, mines department, it is also making money. So like that, for carrying out commercial activities, they can incorporate separate departments, or they can create statutory body. Statutory body means any entity incorporated under separate statute. LIC, statutory body created under separate law. SBI, statutory body created under separate law. Are these commercial entities? Obviously yes. LIC is the biggest profit making company. Next one, or even the government can create government companies for carrying out commercial activities like Indian Oil Corporation, Bharat Petroleum, all these kinds are examples of government companies. So for carrying out commercial activities, government can create three kinds of entities: departmental enterprises, statutory bodies, and government companies. Now how to conduct audits? When it comes to departmental enterprises, no change here. Like the way you conduct the audit of any other government department, in the same manner you will conduct audit of that particular department which is engaged in the commercial activity. No change at all. So it is to be undertaken in same manner like any other government department. When it comes to statutory body like LIC, we have to do the audit as per the law under which that body has been created. If you are doing audit of LIC, we have to do it as per LIC Act under which LIC is created. If you are doing audit of SBI, it has to be created as per SBI Act under which SBI is created. And how to conduct audit of government company? We have to do it as per the provisions of Companies Act 2013. Clear? Then. So now let us talk about C&AG related matters. As I have told, C&AG is an authority who will involve every time any issue regarding accounts and audit of government comes into picture. Now, who will appoint this C&AG, sir? C&AG is an officer. Who will appoint C&AG? C&AG will be appointed by President of India. And he can be removed only on proven misbehavior, not just allegation. If you are removing the C&AG, that should happen only after proven misbehavior or incapacity. And also, to remove the C&AG, majority of not less than 2/3 of the members of the parliament's voting will be required. He can be removed only if majority of not less than 2/3 members have voted in that favor. And also he will be given a salary which is equal to the salary of judge of the Supreme Court. That much salary will be even offered to him. Understood? So this is regarding his appointment and all. Now what are the powers of that C&AG? C&AG will have power to inspect any office of the accounts of union, state government or any other government department. He can go and verify any account. And also he can call any government officer to bring the books to his office, and he can ask questions also. He can see here, this point is to require any books, documents, nothing but this is right of access to books and documents. And not just accessing the books, he can put such questions to any employee, any government officer to fulfill his responsibility. Nothing but, if I have to put it in simple terms, right to inquiry. So number one is inspect any account. Number two, right of access to accounts. Number three, try to get information by doing inquiry. And also, if he feels like some area doesn't require detailed audit, he can dispense with the detailed audit and he can take a decision, I will perform only limited audit in this area. Some government department is there. If he feels that I don't want to do the detailed audit of this department, I will do only limited audit, that decision, that power has also been given to C&AG. So he can dispense with any part of the detailed audit and perform only limited checks in certain departments. So these are the powers of C&AG. Now coming to the duties, there are plenty of duties. like he has to compile the accounts and submit the accounts. He is required to prepare, he is responsible for preparation of financial statements of the state government and submit it to president of the country. State governments, union government will prepare and submit it to president. State governments will be submitted to governor. Union territory related financial statements will be given to administrator of the union territory. Not just compilation of accounts, he is required to look after audit related matters also. He will look after each and every expenditure happening from consolidated fund of India. He will audit and report all the transactions of the union and state government, and even he will audit and report on all trading, manufacturing and balance sheets of governments and government related departments. Not just that, if any authority is substantially financed from government, even that authority's books of accounts also he will verify. He will verify expenses and incomes of government. Not just that, if any entity is substantially financed by government, even that entity's receipts and expenditure also C&AG will verify. Second point says verification of receipts and expenditure of government. Third one is, if any entity is substantially financed by government, even that entity's receipts and expenditure also will be verified by C&AG. Now you will get a doubt, sir, when an entity will be called as substantially financed. So if they are getting a grant of not less than 25 lakh rupees, and also that assistance should be not less than 75% of the total expenditure. If any authority is getting support from government of not less than minimum 25 lakh rupees, and also that grant is covering minimum 75% of the total expenditure, then that entity we call it as substantially financed, and that entity's receipts and expenditure are required to be verified. And for what purposes the government is giving grants and loans, under what conditions they are giving it, that also will be verified by C&AG. He will verify receipts, like we have seen in the previous concept. He will verify the receipts of the government. He will even verify audit of stores and inventories. For that also we have seen separate concept. And even he will look after audit of government companies and statutory corporations also. Clear? So, and one more last question, what role will be played by C&AG in the audit of government companies? Whenever audit of government companies are happening, what role C&AG will play in that audit of government companies? One role we already know, the C&AG is going to make appointment of first auditor and subsequent auditor of a government company. He will not just appoint the auditor, even he will direct the manner in which audit of the government company has to be conducted. And once that statutory audit is completed, the statutory auditor will submit a copy of his audit report to the C&AG. C&AG will appoint statutory auditor of government company. And after completion of audit, the statutory auditor will submit the audit report to C&AG. Now, after receiving the audit report, C&AG will have two more powers. C&AG can even order for supplementary audit of a government company, or C&AG can even order for test audit also. When I say supplementary audit is not altogether separate audit. It is just an extension of the statutory audit. That means if the statutory auditor has completed his statutory audit, in that if some observations are there, C&AG can order for extra extension of that statutory audit, that C&AG can do. So C&AG, after receiving audit report, within 60 days from the date of receipt of statutory auditor's report, they can conduct something called supplementary audit, extension of the statutory audit. And from that supplementary auditor, the C&AG can ask any additional information from that supplementary auditor. And once the supplementary audit has been completed, for that supplementary audit also report will be there. That report will be given to C&AG. C&AG will give its comment on that report. Now that supplementary audit report along with the C&AG comments shall be sent to the company, and company will send every copy of that supplementary audit report to each and every member who is entitled to receive the copies of the financial statements. Understood? So once statutory audit will be over, after that, if the C&AG wants, they can order for supplementary audit. Within how many days they have to order? If they want to order, they have to order it within 60 days. Sometimes C&AG will get a doubt whether the statutory auditor did the work properly or not. Then they can order for test audit. Test audit means checking whether statutory auditor did the work properly or not. Supplementary audit means it is an extension of the statutory auditor. So C&AG has also been given the power to order for test audit. They can even order for test audit also. And how to do the test audit? Those rules are there in section 19A of the C&AG Act. As per that section, test audit has to be conducted, but test audit should be conducted only by C&AG. Whereas supplementary audit can be conducted either by C&AG, or C&AG can appoint another person to do the supplementary audit also. But test audit should always be conducted by whom? C&AG himself. Whereas supplementary audit can be done by C&AG himself, or he can authorize any other person also to do it. Clear? So these are the powers of C&AG. That's why we say in the case of government company, two levels of audit will happen. One is statutory audit conducted by chartered accountant in practice. Other one is by C&AG, either in the form of supplementary audit or test audit. So that's why we say there will be two levels of audit happening in the case of government companies. So this is what a brief about audit of government entities. Understood, everybody? So now we are left with two more chapters pending for revision, which are going to be number one, audit of items of financial statements, and the other one is audit of various entities. So these are the only two chapters which are pending to be revised, and now we will try to do one thorough revision of these two chapters. But before that, let me give you a caution once. See, these two chapters are of such a nature that these are very practical in nature, very much practical. Exclusively practicality will be there in these two chapters. And if you see it on the face, you will not be able to find any concept related questions. Like the way we have covered concepts in all the earlier chapters, in every chapter there is some sort of concept is there. But these two chapters are such a chapters that which does not have any conceptual discussion. These are all somewhat very practical oriented questions. So that's why we will not be able to do line by line revision of these two chapters. So what I will try to do is I will try to cover the key questions or key concepts from this particular chapters. So don't expect me to revise each and every line. Why? Because if we do that, that is going to be complete explanation of the chapter once again. So that is not worthy. So what we will do from these two chapters also, I will try to give a entire overview of the chapters. Some key questions we will cover in overall basis. We will try to understand it. Clear, everybody? So we will first just begin with audit of various entities. Audit of items of financial statements. This we will come back later. First, we will try to revise the key concepts from this particular chapter, audit of various entities. See, as the name itself says, and even the previous two concepts which we have revised. What are the last two concepts which we have revised? One is cooperative societies audit and the other one is government audit. These are the last two chapters which we have revised now. And practically speaking, even these two chapters are also part of audit of various entities only. Even the chapter, even if you have a look at the study material, you will be able to find cooperative societies audit and government audit both in this chapter, audit of various entities only. But for the sake of easy understanding and for the sake of easy flexibility in preparation, so we have divided this content of cooperative societies audit and government audit into two different chapters, and I have given that. But concept, if you have a look at the study material, everything will form part of single chapter. So as the name itself says, this particular chapter, audit of various entities, is going to talk about if we are conducting audit of different kinds of entities, what are the things which we will try to keep in mind. So even after your qualification, when you do audit assignments, you will do different kinds of audits. That could be on the basis of legal form, different kinds of legal forms you will do the audit, or the businesses which are engaged in the clients which are engaged in different businesses also will do the audit. So talking about legal form, we might be appointed as auditor of a sole proprietor. We might be appointed as auditor of a partnership firm. We might be appointed as auditor of LLP. Sometimes we get appointed as auditor of trust. We get appointed as auditor of company. So like that, different kinds of legal forms we might get appointed as an auditor. And when we look from the business perspective, we conduct audit of different kinds of businesses. Like we might conduct audit of educational institutions, we might conduct audit of hospitals, we might conduct audit of hotels, we might conduct audit of clubs, we might be doing audit of cinema halls. So like that, even if you take the legal form or you take businesses, we will be conducting various kinds of entities audit assignment. So now this particular chapter is about whenever you are doing these different kinds of audits, what key things you will try to keep in mind, or what special points we will try to verify in each of this kind of audit assignments. So as I've already mentioned earlier, I'm going to give you a quick overview of the entire chapter, not a line by line revision I'm going to do here. So first we will focus on legal form. Legal form, on the basis of legal form, what things we will try to keep in mind. So starting with sole proprietors audit. So as we know, generally the sole proprietors audit is a non-statutory audit. unless it is a tax audit required as per Income Tax Act or it is required as per GST Act. If these requirements are not there, basically sole proprietor's audit is a non-statutory audit. Since it is a case of non-statutory audit, what is the most important thing here is having a engagement letter. Why? Because in the case of non-statutory audit, there are more chances for misunderstanding. So that's why it is very much advisable for both client and the auditor to be clear about the terms and conditions. So that's why in the case of sole proprietor's audit, most important term is engagement letter. You have to get in writing what and all your responsibilities, what and all your duties to avoid conflicts in the future. Now, sir, even though there is no audit requirement, why sole proprietors will get their accounts audited? There could be numerous reasons. Might be they are going for a bank loan. That's why they might ask you for conducting the audit of their financial statements. Or they need some government license for conducting some business. That's why they might approach you and ask you for conducting the audit. And they might require to settle some insurance claims, etc. That might be the reason why they might come and get their accounts audited. So like this, they could have their own set of reasons why the sole traders will come and get their accounts audited. If they come and getting their accounts audited, you have to be specific about engagement letter. Get clear understanding of what you are supposed to do, and whatever sole proprietor expects you to do in the audit, that becomes your scope. There is no governing law here. Whatever sole trader says, that you have to come in that you have to do in the audit and come back. That's it. So this is what regarding sole proprietor's audit. Now talking about partnership firms audit. See, even partnership firms audit also, unless there is a requirement as per law or regulation like Income Tax Act or GST Act, partnership firms audit is also a non-statutory audit. Since it is a non-statutory audit, here also the most important thing is engagement letter. And here specifically what I need to do is, if I am conducting audit of partnership firm, first you need to get the copy of partnership deed. Give one basic reading of the partnership deed and find out various terms and conditions of this partnership firm, like how many number of partners are there, what is their capital contribution ratio, what is their profit sharing ratio, is any partner entitled for remuneration, is any partner entitled for interest on capital. So like that, try to get a copy of the partnership deed and understand all the terms and conditions related with the audit, and even try to find out, is the partnership firm is for any fixed duration, what kind of business they are supposed to do. So all these things I will check. Then I will verify, then I will check whether partnership firm is maintaining books of accounts as required by respective laws and regulations. And also I should verify the active partners should be carrying out business in such a manner that none of the partners' interest is getting affected. As we know, when I say partnership firm, there will be some active partners, there will be some dormant or inactive or sleeping partners also, you can say. So since I say dormant partners, inactive partners, they will not actively participate in the business. That can be taken as advantage by these active partners. So they will try to show the wrong position in the financial statements and try to pay less amount of share to this sleeping partner. So as an auditor, I need to check that partnership firm business is getting carried out without any effect of interest of any of the partners. And when we specifically see what are the advantages of conducting audit of partnership firm, all those advantages which are there for sole trader, they will be there even for advantages of partnership firm. But in addition to that, the main advantage of audit of partnership firm is it will ensure that it is settlement of accounts. It will make the settlement of accounts between the partner very smooth. Like when a new partner is getting admitted, how much capital he has to bring in for introduction into the audit firm. If any partner is retiring from the firm, how much amount should be paid to his share. If the partner has expired, how much amount has to be paid to the legal representatives. So especially in the case of partnership firm, in the settlement of accounts of the partner, the audited financial statements will be very, very helpful. Clear? So this is what regarding audit of a partnership firm. Now talking about another legal form, audit of LLP. So when it comes to audit of LLP, most of the points whatever we have seen for partnership, the same points will become applicable here. Why? Because the only difference between normal partnership firm and LLP is, in case of normal partnership firm, the joint liability will be there. That means unlimited liability will be there. But in the case of partnership firm, limited liability will be there. Apart from that, all the points will remain same. Here also I will check the partnership deed, and here also I will go through various documents, terms and conditions. All these things will remain common. And one more point of difference here, partnership firms are governed by register of firms. Whereas when it comes to LLP, here the governing authority will be registrar of companies. For LLPs, who is a regulatory authority? Registrar of companies is going to be the regulating authority. Registrar of companies, which is going to regulate the companies, the same ROC is even going to have control over LLP also. And when it comes to audit related matters will remain the same. But a few extra points will be there which we need to understand. So let me take you through that. Yeah. This one. Sir, is audit of each and every LLP mandatory? Actually, no. Why? Because under LLP Act, some kinds of LLPs are exempted. If an LLP fulfills some conditions, they will be exempted from audit. Let us try to understand what is that condition. So if I read this provision, the accounts of every LLP shall be audited. First, they have passed a general statement that every LLP should undergo audit. But however, subsequently they came up with the exemption. What is that exemption is? Provided that any LLP whose turnover does not exceed in any financial year 40 lakh rupees, or whose contribution in the sense capital contribution, whose capital contribution does not exceed 25 lakh rupees is not required to get its accounts audited. So if an LLP fulfills any one of these two conditions, see here carefully, they are saying or. Both the conditions are not required to be satisfied. If an LLP satisfies even one of the condition also, they become exempted. What are that two conditions? If the turnover does not exceeding 40 lakh rupees, that means if the turnover is less than or equal to 40 lakh rupees, or if the capital contribution is less than or equal to 25 lakh rupees, even if one of the condition is satisfied, then the audit of LLP will be exempted. This one condition we have to keep in mind, important for MCQs, so true or false statements. And one more thing here, as I have told, the regulating authority in case of LLPs will be ROC. Every LLP is required to file some mandatory documents with ROC. Every LLP is required to file two mandatory documents with the ROC. Let us try to have a look. What are those documents which are required to be filed with ROC and what are the time limits for filing it? So if we have a look here, every LLP would be required to file an annual return in form number 11 with ROC within 60 days of closure of the financial year. Within 60 days from the closure of the financial year, that is within 60 days from 31st of March, every LLP should file one form number 11. In that form 11, what details will be there? Annual return details will be there. So every LLP should file this annual return in form number 11 within 60 days from the closure of financial year. In addition to that, every LLP is also required to submit another document called Statement of Account and Solvency in form number 8, which shall be filed within a period of 30 days from the end of 6 months from the financial year. So what they are saying, another form number 8. And what is the time limit for that? 30 days from the end of 6 months of the financial year. That means if you take the financial year 21-22, the balance sheet date will be 31st of March 2022. From this within 6 months, that is 30th of September 2022. From this within 30 days. Understood? So form 8 should be filed within 30 days. From the end of 6 months of the financial year, you are required to submit this form 8. So every LLP should submit two documents, form number 11 and form number 8 with the ROC. Clear? So this is what specifically key points regarding that LLP. Now coming to trust and NGO. Trust NGO. See, they might give two different questions, but concept wise they are very similar. So if you are conducting audit of a trust or if you are conducting audit of NGO, first we need to understand what is their legal form, how that trust or NGO is created. Generally, the legal forms which they will take up is either they will take up the form of trust as per Indian Trust Act, or either they might be created as a Section 8 company, or even they could be created as a society under Societies Registration Act. Generally, they will take up these three kinds of form. So first it becomes necessary, in case if you are conducting audit of a trust or NGO, first we should know what is the legal form. Why? Because depending on the legal form, we will come to know which laws and regulations the client has to comply with. So first step should be the auditor should understand what is the legal form and try to get an understanding of with what objective the trust was created. What is their vision statement? What is their mission statement? That we need to understand. Second one, we need to understand who are the top level management in the organization. What are their functions? So we need to understand or get the details regarding management. So as I have told, mission and vision statement also we will verify. Apart from that, even we will try to go through the minutes of the meeting. Whatever minutes of the meetings are available, go through all the minutes of the meetings. Now when it comes to business related matters, first talking about revenues or incomes. Will the trust or NGOs have incomes? Yes. The main income will be donation income. The main income will be what? Donation income. Now how to verify donation income, sir? Now even in the donation also two things will be there. General donations will be there and specific donations will be there. When it comes to general donation, it will go to income and receipts and payments or income and expenditure account. When it comes to specific donation, they need to go to capital reserve. Sir, how can I find out, sir, whether the donation is a general donation or specific donation? Sanction, donor's letter will be there. What will be there? Donor's letter will be there. Go through that donor's letter. From that you will find out, is the donation given for specific purpose or is the donation given for general purpose. If the donation is given for general purpose, the trust can use it for any of the purposes. But if the donation given is specific donation, the trust should use that donation amount only for the purpose for which it has been given. So this is what will be the major income, donation income. Apart from that, there will be some regular members will be there. From them membership fees will be received. What will be received? Membership fees will be received. Now how to verify the membership fees? So simple, you will have something called register of members. Get that register of members. For each person, membership fees will be decided. Like for example, if 100 members are there, per year 10,000 rupees is the membership fees. If you multiply it, you will get the value of 10 lakh rupees. So now when you go through that income books of accounts, the total membership fees should have been received as 10 lakh rupees. Nothing but you are cross verifying, recomputation you are doing. So whether membership fees has been completely accounted for or not, like this you can know it. Get the register of members, multiply with per person what is the registry membership fees, you will get the resulting figure. That much amount of income should have been recognized. If you find any arrears, try to understand what is the reason for that arrear. And as a part of that analysis, if you found out that if that amount is irrecoverable, that needs to be written off. Sometimes membership fees will be received well in advance. If it is the case, you have to apportion it over that duration. Don't recognize all at once. And even in the membership fees also, two things will be there. One is entrance fees, other one will be regular membership fees. When it comes to entrance fees, that should be a capital receipt. When it comes to regular membership fees, that will go to our revenue income. Nothing but it will go to income and expenditure. So this is what the donation income, membership income, entrance fees. Apart from that, especially in the case of NGOs, they will have subscription income also. Subscription income means they will publish some magazines and that magazines will be subscribed by so many people. And that subscription to the magazines will not be free of cost. From that, they will even make subscription income also. Now, how to verify that subscription income? So, two things they will say. One is you once again get registrar of subscribers. In that register of subscribers, you will get to know how many subscribers are there. Per person, what is the subscription fees, find out. Multiply it, you will get how much amount of subscription income should have been received. Reconcile whether the same amount has been recorded in the books also or not. And one more way for checking the subscription income is, you can check how many copies of magazines are published and distributed. If 100 copies of magazines are published and distributed, that means there should have been 100 subscribers. You should have received money from 100 subscribers. So like that, even I can cross verify with number of copies of magazines which are published and distributed. So this is what regarding subscription income. Apart from that, sometimes government also will give grants and assistance. Try to verify that government grants and assistance. Sometimes government will give grant subject to conditions. Check whether the trust or NGO is able to comply with that conditions so that they need not repay back that grant. That you try to understand. Along with that, sometimes legacies also will be given. Legacies means nothing but wills will be written by the rich people in the name of trust or NGO. In case if any legacies are there, go through that registration documents, etc. And what else will be there? Apart from that, yeah, these are the major incomes. And one more thing, when it comes to trust, sometimes they might have even rental income also. Try to verify that rental income. Sometimes there will be hostels which are run by the trust. They will charge nominal amount of rent from the students, etc. So if such kind of miscellaneous incomes are there, try to even verify that miscellaneous income. And one more thing, sometimes trust will conduct special events for some specific purpose. Like so and so trust will conduct a music concert, and out of that whatever money has been received, that will be used exclusively for tsunami victims, flood victims, etc. So like that, if the trust is creating any special event or program for the purpose of some relief measures, check that whether income from that special event has been properly recorded. There should not be any hiding of income from that special event. So check whether income from that special event has been properly recognized or not. So these are all the various incomes. Now talking about expenses, the expenses will be whatever incomes which this trust or NGO is receiving, all that income should be used only for non-profit purposes. As I have told, every trust will have some mission or vision statement. Whatever money they are receiving, that should be used exclusively only for achieving their objectives. Clear? So none of the management or none of the employees should have benefited out of it. Apart from that, for running that trust or NGO, you will incur regular expenses like operating expenses will be there. If you take rental expenses will be there, try to verify with the rental agreement. Salaries will be there, try to verify with the salary agreements with the staff. If there is any plant and machinery, on that depreciation charges will be there, like buildings if etc. These kind of things are there. On that depreciation will be there, try to verify that depreciation income. And if at all they are having any inventory or stock, try to do physical verification of that inventory as on the balance sheet date. So these are some points which you need to keep in mind while conducting audit of trust or NGOs. Now coming to the next question, now we will talk about hospitals. If you are conducting audit of hospitals, what you need to verify? First of all, hospitals will have two kinds of income. One is consultancy charges, OP charges also we say. Other one is admission charges. If any patient is admitted, from them room rental charges, operation charges, all will be there. So first, when it comes to consultancy charges, how it can be verified? If you observe, every hospital will maintain register. If you go to hi-fi hospital, they will have all that record in the computer. If you go to normal small clinic, they will maintain one manual register. So get that register. From that, you will come to know per day how many patients have come, per person what is the fees. So if you multiply number of patients into fees, that much amount of income should have been recorded in the books of accounts. So try to understand that consultancy income has been properly recorded or not by getting the registers, etc. And also try to understand what policy is followed by the hospital when it comes to consultancy. Like some hospitals will have a policy that once you pay consultancy fees, for the coming 20 days, if you come for checkup once again, no need to pay consultancy fees once again. Some hospitals will have a policy that one consultancy fees will be suitable only for 10 days. So like this, try to understand what policy will be followed by your client hospital. Now when it comes to patient admission charges, there will be register of patients along with the date of admission, date of discharge, everything will be there. So you try to understand how many days a patient was admitted in the hospital and what kind of service he has availed, what kind of treatment he has availed. Why? Because if he is treated in the ICU, separate charge. If it is in a general ward, separate charge. If he is in a normal ward, separate charge. So like that, try to understand how many days a patient has stayed in the hospital, what kind of services he has received, what medicines were used on him. So all that things were added in the bill or not, that as an auditor, I need to check it. So these are the two major kinds of income. One is consultancy fees, other one is admission charges and operation charges. Apart from that, few other incomes if we talk about medicines. Now, when it comes to medical stores in the hospital, there will be two ways of running the medical stores. Number one is medical store run by the hospital management themselves. Other one is outsourcing. If the medical stores are run by the hospital themselves, we need to verify purchases and sales which are made by that hospital. In case if it is outsourced, I need to check whether that proportionate share of income has been received from that person to whom the medical store has been outsourced. Generally the agreements will be either a fixed sum of money or a percentage on the profits. Try to understand whether that income has been received or not. You need to check. Same with pathology also. You need to check even that pathology labs also are getting run by the hospital itself or they are getting outsourced. This also you need to check it once. Now apart from that, if trust based hospital is there, that trust based hospital will even receive donations also, and we have already covered in the previous question how to verify donations. Apart from that, this trust based hospitals will even get government grants also. Try to verify that government grants by verifying the government sanction letter for the grant, checking the entries in the bank statement. So by verifying all that, you try to find out whether government grants have been shown at the proper amounts or not. And if the hospital is a trust-based hospital, they will be exempted from income tax refunds. See, this income tax refunds point is applicable even for trust also. So generally hospitals, not the today's corporate hospitals, guys. If any trust-based hospitals are there, they will be exempted from income tax. So in case if your client hospital is exempted from income tax, but by mistake if someone has already deducted TDS on that hospital, so we need to check that this hospital has filed the income tax return and claimed the refund of TDS deducted on their name. Understood? And apart from that, now if we come to the expenses, the regular expenses will be like staff salaries will be there. We know how to verify it by checking the employee agreements. Rental expenses will be there. Try to verify with that rental agreements. And they will buy various kinds of inventory. What will form part of inventory of hospital? Inventory will form part of inventory will include medicines. It will include operation theater apparatus will include this scissors etc. That will get included. Linen, cotton, these kind of things all will get included in the inventory. Check whether there is proper mechanism for buying all this inventory, and whatever inventory that is lying there as on the balance sheet date, try to do the physical verification of that. Apart from that, fixed assets also will be there. Today the doctor's machinery come with a high cost, so that fixed assets have been properly depreciated or not, I need to check it, and even try to do physical verification of that fixed assets. Understood? So these are the various points which we need to keep in mind while conducting audit of hospitals. Now let us talk about educational institutions. What if I am doing audit of educational institutions like school, college, etc. Now if we talk about various kinds of incomes which educational institution will have, number one, admission fees will be there. Now how to verify admission fees? So that you have to cross verify with admission slips which are signed by the head of the institute. You should get how many admission slips were signed by the head of the institute, and per admission the admission fees will be fixed. So total number of applications per application, what is the admission fees? If you multiply, you will get that resulting figure. That much amount of admission fees should have been received. Now what is the accounting treatment of the admission fees? Here they have told that if the management has taken a decision, they will treat it as a revenue income, then they can treat it. If no decision has been taken by the management, then generally admission fees will be shown as a capital receipt. Which means, if I have to put it in simple terms, the accounting treatment of admission fees is something which has to be decided by the management of that educational institution. If they decided that they will treat it as revenue, they can treat it as a revenue income, take it to statement of P&L. If no such decision has been taken, then admission fees should be shown as a capital receipt. It should go to corpus. And apart from that, what else will be there? Class fees, admission fees, other one is tuition fees will be there. Now how to verify tuition fees? So what they will ask you to do is get the class registers. From that you will find out how many number of students will be there, multiply with per person what is the tuition fees, and verify whether that much amount has been recognized in the books of accounts or not. If any tuition fees is not yet recovered, check whether there is a proper accrual entries have been written or not. If any tuition fees becomes irrecoverable, check whether it has been written off or not. Sometimes some students will pay tuition fees of 2-3 terms well in advance. That should not be recognized all at once. That should be apportioned over the period of time. For whatever duration that tuition fees has been paid, over that duration we need to apportion it. And a few more things. If any student has been given some concession or free studentship, check whether that concession or free studentship has been given only after getting approval from head of the institute. And hostel fees will be there. We need to make sure that every student is paying the hostel fees before they leave the hostel. Apart from that, travel charges will be there, travel fees like bus fees etc. That you try to verify with number of students who are availing that services. Understood? Apart from that, what other incomes will be there? Once again, here if the school is a trust based school, they also will have grants given by the government, that we need to verify with the grant sanction letter, that we need to verify with the entries in the bank statement. And even sometimes legacies will be there. Some people leave behind legacies in the name of educational institution. Try to verify that legacies also with the help of that will copies etc. And if the educational institution is a trust based educational institution, they will be exempted from income tax. But if at all any TDS has been deducted in their name, check whether educational institution filed the income tax return and claim the refund of that TDS whatever has been deducted in their name. Understood? and if they have any excess funds, if they have invested somewhere else, check whether on that investment income has been received or not, like dividend income, interest income. And one more thing guys, this investment income will be there even for hospitals also, this investment income will be there for trust also, this investment income will be there for NGOs also. So write the same investment income point for all the institutions which we have covered, not just for educational institution, for hospitals also investment income could be there, for trust also investment income could be there, for NGOs also interest income could be there. So try to verify all, try to write this point of investment income for all these institutions. Now talking about expenses also here once again it will remain the same. So try to verify that rental expenses, staff salaries, etc. And here inventory will be in the form of books, uniforms, food items. So all this will be there in the form of inventory. Try to verify whether there is a proper mechanism for buying and storing this inventory, and try to do physical verification of the stock as on balance sheet date. Apart from that, check whatever fixed assets which the school is having, school or education institution is having, whether depreciation has been charged on all that assets, and if possible try to do physical verification of even that fixed assets also. So these are the points which are needed to be kept in mind while conducting audit of a educational institution. We will talk about few more questions. How to conduct audit of a club. So clubs are generally incorporated. Their legal form will be company limited by guarantee. How they will be incorporated? Generally they will be incorporated as companies limited by guarantee. So all the provisions of the Companies Act will become applicable. Now what will be the incomes of the club? So club will have incomes like membership fees will be there. We have already seen how to verify membership fees, like register of members, you have to get it. Along with that, entrance fees will be there. This also I have told how to verify the entrance fees. You can verify with number of applications received for applying for membership of the club. Along with that, even you can check the minutes of the minutes of the management to check how many approvals were given for new members. So you verify membership fees and entrance fees. Apart from that, apart from membership fees and entrance fees, what some clubs will do is they will charge extra for the customers, for their members, for extra services provided. Like inside the club there will be a restaurant. So membership fees will give you access only inside the club, but whatever food you consume in the restaurant, that restaurant income will be separately billed. Similarly, inside the club, if you are going and enjoying some recreational activities, like for example, you go there and enjoy the billiards table, you go and enjoy there some poker table, or you go and enjoy some indoor games there, for that separate charges will be collected. So in case if your client club is having such a policy, membership fees will just allow the person to enter inside the club, but after entering the club, whatever services that are getting used, for all that extra charge will be there. If such is the policy of your client, now from all these extra services, extra income also will be there. So check whether this income has also been accounted for or not. And one more thing, whatever food that is provided by the club, they should be billed by the custom. They should be billed to that member, not on cost to cost basis. Cost plus some margin should be added, then only they should be billed to that member. So this is one important point. And when it comes to expenses, once again, what will be the expenses? Staff salaries, rental expenses. Along with that, they buy the sports item very frequently. So that sports item also will be their expenses. And all the sports item, food items, everything will even form part of inventory. Try to do physical verification of the stock as on the balance sheet date. And whatever fixed assets are there, check whether depreciation has been properly calculated and do the physical verification of even that fixed assets also. So this is how we need to conduct. These are the main or key points regarding audit of a club. Now talking about cinema hall, how to conduct audit of a cinema hall. So now if we talk about incomes here, the main income will be sale of tickets. So how can you verify the sale of tickets? So very simple. Today the theaters are having a software for booking. So after the completion of each show, the software will generate a report. In that report, it will be clearly mentioned how many tickets are sold, which class tickets are sold, what income should have been received. So from that report, which is generated from the billing, from the booking software, we need to cross verify whether the same amount has been even recorded in the books of accounts or not. And we need to check proper internal controls are there in the theater. Like a entry inside the theater should be allowed only by showing the printed copy of the ticket, or at least today nowadays even you can show that message also. So whatever it is, proper mechanism should be there to allow the person only to enter inside the theater after showing some valid entry ticket. So that kind of internal controls should be kept. And whatever income that is getting generated from the sale of tickets, that should be deposited in the bank at regular intervals. If possible on the same day, if not possible either on the next day, the income from sale of tickets should be deposited with the banks at regular intervals. And apart from that, even you need to have, if there are any free passes given, if any free passes for the theater are given, we need to make sure that that free passes are given after getting approval from the concerned theater management. Only after getting approval, this free passes etc. should be given. Now talking about other incomes, one more major income will be advertisement income. So they before you go and watch the movie, there will be advertisements played. On that also advertisement income they will make. We need to check that advertisement income with the advertisement agreements entered with that vendor. So according to that agreement which the theater has entered with that concerned person, whether that advertisement income has been recognized or not, we need to check it. Then we will have canteen income. When it comes to canteen income, here also two modes of operation. One is outsourcing, other one is run by the theater itself. If the canteen is getting run by the theater management themselves, we need to verify all the purchases and sales made by that theater. If it is getting outsourced, then we need to check whether the share of income has been properly received or not. And one more thing, when it comes to sale of tickets, we can even cross verify with taxes collected, GST, entertainment tax. If these kind of taxes are there, from that also we can do the reverse calculation and find out whether sale of tickets income has been properly accounted for or not. Like if 2% is the GST and GST amount is 20,000, you can, from this you can do the reverse calculation and find out how much amount should have been received from the sale of tickets. So like this you can cross verify even with GST income. And whatever booking software which the theaters are using, they should use such a software that the tickets which are sold in online, they should not be sold once again at the theater. They should be blocked in the software. So such a kind of robust booking software, they have to make use of it. So these are all various incomes. Now talking about expenses, the major expenses will be movie hire charges. With the distributors, you have to take the movie on rent. So that movie hire charges we need to verify with the agreement. Apart from that, electricity charges will be their next biggest charges. Try to verify electricity expenses. Staff salaries, that you need to verify whether staff salaries are properly paid or not. And one more thing is depreciation. See, the thing here is in the depreciation, we use this furniture and projectors etc. And the rate at which we are charging depreciation, that rate will be generally higher than the rate which we charge for other businesses. Like a projector will be there in the office, a projector will be there in the movie theater also. But for same asset, we don't charge equal amount of depreciation. In the case of theater, we charge the depreciation at the higher rate. Why? Because wear and tear will be much higher. So check that on the assets of the theater where depreciation is charged at a higher rate than when compared with the other businesses. So these will be the major expenses which we need to verify. So this is how we need to conduct audit of cinema halls. We will try to end our revision of this chapter with one more last question. How to conduct audit of hotels, boarding and lodging hotels. Number one, room collections will be there. Room sale collections. So we need to verify whether the amount collected from renting out the rooms has been properly accounted or not. How you can cross verify, sir? You can cross verify with the guest register. So there will be a guest register. With that guest register, you need to cross verify how whether all this income from letting out the rooms has been properly recorded or not. And pilferage is the main problem in the case of hotel. Pilferage means petty theft. Small thefts could happen in the hotel. That is the major problem. So that's why there should be proper internal control system. Like whatever inventory they are having. Generally, what will form part of inventory of hotels? So hotels will have inventories like this toilet essentials like soaps etc. They will have some food items also. If they are having their own restaurant, they will have their food items also as a part of inventory. Apart from that, this linen will be there. Towels, curtains, these kind of things will be there. So all this will form part of inventory. All this inventory should be kept in safe custody. They should not be given out to anybody. They should be kept in safe custody. Key should be retained by the manager. And there should be some controls like if a person before letting out the person, before letting the room to the person, nowadays if you observe hotels, advance billing they will do. That means you have to pay money well in advance, not at the time when you are leaving. Why? Because sometimes what could happen is a guest will come and stay in the hotel and without any notice he will leave. So it will be a loss for the company. So that's why today hotels have come up with internal controls that before they let out the room well in advance, they will collect that room rental charges well in advance. So these kind of internal controls should be there. See, apart from the room selling income, that means letting out of the rooms, they will even have other incomes like banquet hall incomes. They will have banquet halls. They will be they will be let out for functions, seminars, or auditoriums, etc. So from that income also will be there. Try to verify that income from banquet halls also. And apart from that, what other incomes will be there? So apart from that, when we talk about other incomes, so I don't find any specific restaurant. If the hotel is running their own restaurant, from that they will even have sale of food income also. Try to verify that restaurant income also. And when it comes to expenses, major things which we need to verify here is painting, decoration, repairs and maintenance. These will be very frequent expenses in the case of hotel. We should try to make sure that none of these painting, repairs and maintenance expenses have been capitalized. Why? Because they are very common in the case of hotel. So these will be the main expenses: painting, decoration charges, etc. Electricity expenses also will be there. And apart from that, there will be agreement with the travel agents. So travel agents will get you some booking, but today there are no physical travel agents. We have this online aggregator platforms like Make My Trip, Oyo, all these kinds of things are there. So with them, we will have revenue sharing agreement. Try to check that travel agency agreement and verify whether their commission has been paid properly or not. And talking about other expenses, talking about inventory specifically, as I've already told you, all these things will be there in inventory. Check whether try to attend the physical verification whenever the management is doing it. So these are the points which we need to keep in mind while conducting audit of hotels. So with this, we have covered all the key questions, all the key concepts regarding how to conduct audit of various entities. Clear, everybody? So we can't go any deeper. Why? Because this much is only this much itself is, if you observe carefully, there is no concept here, but still I tried to give overview of the entire chapter. Hope this revision would have helped you.
So now we will be starting the revision of the next chapter, which is audit of items of the financial statements. So as I mentioned at so many places, the chapters audit of the last two chapters exactly, the audit of items of the financial statements and the audit of various entities. These two are very practical chapters. These are not the chapters which are meant for memorizing the content. The last two chapters are actually something which you need to think from the practical perspective and answer the questions in the examination. So now I will be quickly revising the content from the chapter audit of items of the financial statements. See, this chapter is very huge actually. There will be a lot of questions in this chapter. And if I have to say it frankly, this chapter is not at all fit for revision. We can't do 100% revision of this particular chapter. Why? Because as I continuously say, this chapter is something which is very practical in nature. Even if I have to do the revision of the chapter, I will be reading out the entire questions, whatever are there in the material. So I don't think that will serve any purpose if I read the entire content in the content from the material once again. So what I'm going to tell you is, from this chapter, audit of items of financial statements, I have identified the few important concepts which are going to be very important from the examination perspective and which have a high chances of getting tested in the examination. So a few topics I have identified, those topics from this chapter I'm going to quickly revise them. Okay, right. So here I have built one summary here. So from all the concepts, whatever are there in the material. So what I have done is a few concepts I have identified which are very important from the examination perspective. So that summary I have developed here. This notes also I will share it with you. This thing also I will upload it in the website. So from there you can download it. This summary of a few questions I have identified from this chapter and develop this summary, which will be a very value addition in the examination, which will help you for quick revision. So whatever I have listed down here, whatever summary I have prepared here for a few questions, that questions I will try to cover. Along with that, few more questions also I will try to cover from the material. So let me start with balance sheet items. See what basically this chapter talks about, what exactly we are going to discuss in this chapter. As the name itself says, if you are conducting audit of any entity, if you are conducting audit of items of the, if you are conducting audit of any financial statements of the entity. Now when I say financial statements, in the financial statements, different items will be there. There will be incomes also, there will be expenses also, there will be assets also, there will be liabilities also. Now what this chapter exactly tries to convey is, if you are conducting audit of financial statements of an entity, how do you verify each item of the financial statements? What things you will try to keep in mind while verifying the items of the financial statements? Like for example, if you want to verify fixed assets, what things you have to keep in mind? If you want to obtain evidence regarding inventory, what we have to keep in mind? If you want to obtain audit evidence regarding trade receivables, what you have to keep in mind? So like this, in this chapter, similarly, if you want to verify, if you want to obtain audit evidence regarding sales, what things you have to keep in mind? If you want to obtain evidence regarding employee benefit expenses like salaries and all, what things you will try to keep in mind? So this is what this entire chapter's scope is about. So this chapter is going to talk us what things we have to keep in mind while obtaining audit evidence regarding regarding each item of the financial statements. That's what completely the focus of the chapter is. So as we all know, see, long ago we have seen the meaning of the term assertion. Sir, what do you mean by assertion? Assertion means representations which are made by the management regarding account balances, class of transactions, and disclosures in the financial statements. Assertion means nothing but whatever representations which are made by the management, that we are going to call it as assertions. And as an auditor, if I'm conducting audit, I will try to obtain audit evidence regarding these assertions only. If I'm performing audit of the financial statements, I will try to obtain audit evidence regarding those assertions which are made by the management. Like for example, if I'm verifying assets, what assertions I will try to verify? I will try to obtain evidence regarding existence, whether assets are in existence or not. I will try to obtain evidence regarding completeness, whether all the assets are completely recorded or not. I will try to verify rights and obligations, whether the company is having rights against that assets or not. And I will try to obtain audit evidence regarding the assertion valuation, whether assets are properly valued or not. Similarly, when I try to verify sales, regarding the sales, what assertions I will try to verify? Here I will verify occurrence. Whatever sales amount that has been shown in the financial statements, that much amount of revenue has actually occurred during the year. Completeness, whether all the sales transactions are recorded in the financial statements, nothing has been excluded. Cutoff, that means whether whatever revenue which has been recorded in the current year that belongs to the current year, none of the future year's revenue, none of the past year's revenue has been recorded in the current financial year. And measurement, I will see whether the revenue has been measured properly, shown at proper amount. And also I will see classification, whether that has been properly classified, whether that has been properly presented. So like that, depending on the item of the financial statements, for assets and liabilities, we check these assertions. For incomes and expenses, we try to verify, we try to obtain audit evidence regarding these assertions which have shown here, like occurrence, completeness, cutoff, measurement, classification, presentation, etc. So here we will list out, we have given items under two categories. We have identified few important balance sheet items and what things you have to keep in mind to obtain audit evidence regarding those balance sheet items. And after certain balance sheet items, we have also identified few P&L items and how to obtain audit evidence regarding that few P&L items. So without any delay further, I will try to start my discussion with balance sheet items. What specific things? I have taken a few concepts here. Let us try to understand each and everything in a let us try to revise it in a quick manner. Number one, shares issued at a discount. So in case if your client company has issued any shares for discount, what things you are required to what things you are exactly supposed to verify? So generally this question is very important. It is very frequently tested in the examination also. So what things you will try to verify regarding shares issued at a discount? First of all, what does the Companies Act say regarding issue of shares at a discount? The Companies Act says that the company shall not issue shares at a discount except in the case of sweat equity shares. Other than sweat equity shares, the company shall not issue shares at a discount. That means the company can issue shares at a discount only in the case of sweat equity shares. In other cases, the company is not at all permitted to issue shares at a discount. So in case if the company has issued any shares at a discount, it will be void. That transaction will be completely void. That issue itself will not be valid at all. However, they have given one more permission. A company may issue shares at a discount to its creditors when the debt is converted into shares in pursuance of any statutory resolution plan or debt restructuring scheme. So if any restructuring of the entity is happening as a settlement to the debentures, as a settlement to the debts, as a settlement to debts. So for example, if a company is there, the company is going through very bad phase because of some restructuring plan, approved by the RBI and all, that company is going through restructuring phase. So in that restructuring phase, for the debtors, there are some debtors for this company. There are some debts for this company, not debtors actually. There are some debts. That means they have to pay they owe certain amount of money to other people. So as a settlement to their creditors, the company can issue shares at a discount. So that is also one more case where the issue of shares at discount is permitted. So the company may issue shares at a discount to its creditors when that debt is getting converted into shares in pursuance of any statutory resolution plan or restructuring scheme. Similarly, in case if the company has failed to comply with any of the above conditions, so if you observe the entire scenario here, in only two cases the company is permitted to issue the shares at discount. One is in the case of issue of sweat equity shares. The other one is in case of settlement to creditors. for settlement to creditors as a part of some resolution plans. In these two cases only, the company is permitted to issue the shares at a discount. In any other case, if the company is issuing a shares at a discount, that issue shall be void. That issue, it is not at all valid. And in case if the company fails to comply with the above provisions, if the company did not comply with the above provisions listed, then what will happen? Penalties and punishments will be there. What are that penalties and punishments? Number one, company and every officer who is in default, they shall be liable for a penalty which may extend to an amount equal to amount raised through the issue of shares at a discount or 5 lakh rupees, whichever is less. In case if the company has violated the above provisions, that means apart from these two cases, if they have issued shares at discount in any other case, then what will happen? Then the company and every officer who is in default, they're required to pay some penalty. How much amount of penalty? The amount which you have raised by way of issue of shares at a discount or 5 lakh rupees, whichever is less. For example, the company has raised 10 lakh rupees of money of shares at a discount by violating the above provisions. So what will be the minimum penalty on company and every officer who is in default? 10 lakh rupees or 5 lakh rupees, whichever is lower. Which one will be lower? 5 lakh. They have to pay a minimum penalty of 5 lakh rupees. And also, company shall be liable to refund all monies received with the interest at the rate of 12%. Not just paying the penalty, the company, whatever money they have raised from the public by issuing shares at a discount, that money also they have to give it back. Not just the money they have to give it back, they have to return that money along with the interest at the rate of 12% per annum. Clear? So these are the few things which we need to verify. So if you are conducting audit of any entity and in that entity you came to know that the company has issued shares at discount, these are the things you need to verify. Nothing but simply you have to verify the compliance with the provisions of Companies Act which are relating to shares issued at a discount. Now coming to the next one, this is also relating to share capital related matters. What things you will try to verify regarding sweat equity shares? In case if your client company has issued the sweat equity shares, what things you will try to verify regarding it? So I need to check a few things like whatever issue of sweat equity shares are there, that should be approved by special resolution. If the company wants to issue sweat equity shares, that should be approved by special resolution. So I will check whether there is a special resolution there or not. And in that resolution through which that approval, that special resolution has been given, in that resolution specifically, it has to state how many number of that sweat equity shares are getting issued, what is the current market price, if any consideration is getting received by issue of the sweat equity shares, and class or classes of directors or employees to whom such shares are issued. Nothing but how many shares you are giving, what is the current market price, what is the issue price at which you have given that sweat equity shares, and to which directors or employees you have awarded the sweat equity shares. And also, in case if the company is a listed company and if the listed company wants to issue sweat equity shares, they can do it only after complying with the regulations given by Securities Exchange Board, nothing but SEBI. So whatever regulations of SEBI are there, that they have to follow, then only the listed company can issue sweat equity shares. So these are the few things which you are supposed to verify in case if your client company has issued the sweat equity shares. Now let us come to borrowings. Now, when I say borrowings, they're talking about, for example, you are an auditor, you have been appointed as auditor of the client X Limited, your client has taken borrowings. Your client has borrowed the money from others. So if you are an auditor and if you want to obtain audit evidence regarding borrowings, they're talking about liabilities of your client company, what things you will try to verify, what exactly you will try to verify regarding borrowings. So here also, if you see here, since it is a balance sheet item, the assertions regarding which I will try to obtain evidence is existence, valuation, completeness. So let us see, how can I obtain audit evidence regarding existence of the borrowings? How can I obtain audit evidence regarding completeness of the borrowings? How can I obtain audit evidence regarding valuation of the borrowings? So talking about existence, how you will come to know? Existence means what? First of all, take for example, in the balance sheet of my client company, I am able to see that there are borrowings worth 100 lakh rupees. So what do you mean by existence? I want to obtain evidence whether really this 100 lakhs worth of borrowings are existing with the company as on balance sheet date. Nothing but the company is having liability of paying 100 lakh rupees as on the balance sheet date or not. So that existence we have to verify. How you can verify existence? As you could see, a few points I have given here. You can review the minutes of the meetings of the board of directors. So before approving the loan, before taking a loan, board of directors will generally conduct a board meeting. In that board meeting, they will give a approval. So you can come to know whether that approval is there. In order to know whether that loan is really existing or not, check the board approval. So go to the board of directors minutes and check there in the meeting approval has been given for that loan or not. And even you can cross verify with the loan agreement. So if the company has taken loan, then generally loan agreement also will be there. Go through that loan agreement. And even you can obtain balance confirmation. Whether the loan is really existing with the company or not, really is a liability there on the company as on the balance sheet date or not. You want to know what you can do. Directly get a confirmation from that third party, from whomever the client company has got the loan, from those party you can obtain external confirmation. Even like borrowings might arise out of hire purchase or lease contracts also. In case if the borrowing has arisen out of hire purchase or lease contracts, you have to go through that contracts or agreements to determine whether that liabilities are there or not. And even if it is a case of debenture, you can verify the trust deed, and by going through a trust deed you will come to know what is the redemption date, how many debentures are issued, what is the debenture value, debenture redemption value, is it at premium, is it at discount. If you want to know all that things, debentures also will form part of borrowings, and if you want to know these details regarding debentures, you have to verify that trust deed. And in case if at all debt is retired, that means if the debt is repaid, whatever asset that you have given it as security, whatever charge you have created on the security, that charge should be discharged. That means that charge should be released. Initially when you get the loan, by giving your asset as a security, you will, that we call it as charge. In case whatever loan you have taken, that if you have repaid, whatever charge that is created, that should be discharged. No, that means asset should be taken out of that security. No, so that is what you are supposed to verify. So these are the few things which you need to obtain evidence regarding existence. Sir, how can I verify completeness, whether all the borrowings without leaving out anything from the financial statements, whether all borrowings company has included in their financial statements or not? How can I get to know about it? Very simple. First, ask the management to give a schedule of short-term and long-term borrowings. Ask the management to give one schedule of long-term and short-term borrowings. When I say schedule, what do I mean by that is, schedule means borrower wise, it will contain what is the opening balance of the borrowing, what additional borrowings are taken, what repayments are made, what interest is accrued, and what is the total closing balance. Like this, for each debtor, for each category of borrowing, for both short-term borrowing, long-term borrowing, for each creditor wise, for each borrower, for each lender wise, you have to get this schedule. So opening balance, additions, repayments, interest accrued, closing balance. So ask the management to give a schedule of all that short term and long term borrowings, and whatever report they have given, whatever schedule they have given. So in order to know whether that balances are correct or not, try to cross verify that balances with the ledger balances. So that's what they say, trace the closing balances as per the schedules to general ledgers. And even here also what you can do, get the external confirmation procedure. Follow SA 505 and get the external confirmation procedure to obtain evidence regarding completeness. And valuation. Sir, what do you mean by valuation? What do you mean by obtaining evidence regarding valuation of the borrowings? Nothing but I want to know whether the borrowings, at whatever value the borrowings are shown in the financial statements, is that value correct or not? That I want to obtain audit evidence. Sir, what things you will try to verify in order to know whether borrowings are stated at the correct amount or not? How you can get to know it? Number one, you need to understand first what accounting policies the client is following for valuation of the borrowings. What kind of accounting policies they follow? First, you need to understand it. Then you can verify whether that loan balance has been correctly calculated or not as per loan agreement. Generally, in the loan agreement, repayment schedule will be there, interest rate will be there, all that details will be there. So you can cross verify whether that borrowing amount is correct or not by cross checking it with loan agreement. And if you know what is the amount of loan, what is the rate of interest, you can calculate the interest or discount or premium on your own, and you can cross verify with the management's calculations. And in case if your client has taken a foreign currency loan, if your client has taken loan in foreign currency, then you have to check that all that forex calculations are done as per AS 11. Generally, the loan will be stated as on the balance sheet date at the closing rate, and the differential component should be taken to the statement of the P&L. So in case if your client has taken foreign currency loan, check the compliance with the AS 11 and check proper accounting calculations, forex calculations. And in case if your client has taken loan from the related parties, check the compliances with AS 18 or Ind AS 24. Sorry. So these two compliances also you have to check, and you have to specifically check that, especially in the case of related party transactions, your company did not violate any of the provisions of the Companies Act. And in case if your client has accepted the borrowings, that also will form accepted deposits also will form part of borrowings. So where the entity has accepted deposits, examine whether directives issued by the RBI or other appropriate authority have been complied with. So in case if you want to accept the deposits, if any company wants to accept the deposits, RBI directives will be there, court directives will be there. We need to check whether all that directives has been complied with or not. This point we have already seen in Caro also, same point they will try to say, just it is a repetition here. So these are the few things which we need to verify with respect to the borrowings. Next, now we have one more important item, trade receivables. Sir, what things we will try to verify regarding trade receivables? When I say trade receivables, they are talking about the debtors of the entity. So what things we will try to verify regarding trade receivables? So this is an asset actually. Since it is an asset, what assertions will be there for the asset? Existence, completeness, valuation. Let us see what things we can verify in order to know about existence of the trade receivables, what things we can verify in order to know about the completeness of the trade receivables, what things we can verify in order to ascertain the valuation of the trade receivables. So first we will talk about existence, how you will come to know whatever trade receivables that are shown on the balance sheet, they are existing with the company as on the balance sheet date. How you can get to know it? Number one, first thing we need to check there are proper control systems are there followed by the organization. Controls, like those controls which are there in the organization, should make sure that invoices are not getting recorded more than once. If you have given one invoice, that invoice should be recorded only once. There should not be multiple entries from the same invoice. So organization should have proper internal controls to make sure that a single invoice is getting recorded only once. It should not be recorded more than once. So generally how these controls will be implemented by the companies is in their accounting software itself, they will put a restriction. They will when you want to enter a accounting sale, when you want to enter a sale entry in the accounting software, you have to enter the invoice number. If you try to enter the same invoice number for another entry, system itself will throw an error message. Against this invoice, there is already a sale entry. So like that, first thing I need to check, there are proper control system to make sure that invoices are not getting recorded more than once. An invoice should be recorded only once. And trace the balances as per aging report to the general ledger. Ask the management to give the aging report of the debtors. Aging report means what? On the basis of number of days they are outstanding. Ask the management to give that aging report, and whatever amount that is there in the aging report, try to match it with the general ledger balances. And in case if the client has paid bulk amount of money, for example, to one customer we made 4 sales. We have given 4 invoices to the customer. Invoice 1, invoice 5, invoice 9, invoice 10. 4 sales we have made. And this customer is making a bulk payment. This customer is making a bulk payment. For example, for invoice 1 is for 10 lakh rupees. Invoice 2 is for 5 lakh rupees. Invoice 3 is for 3 lakh rupees. Invoice 10 is for 2 lakh rupees. Now what this customer is doing is he's making a bulk payment of 20 lakh rupees. So if he's making a bulk payment, how we should adjust it? We have to adjust it invoice wise. Generally what will happen is when the customers make the bulk payment, they will let us know for against which invoice how much amount they are paying. In case if the customer did not say any invoice order, just he paid 20 lakh rupees of bulk amount, then how we have to adjust? Date wise we have to adjust. In a chronological order we have to adjust against the invoices. So that's what they're telling. In case if you have received the bulk payment, you have to verify that has been adjusted invoice wise or not. And if there is any large balance is due for a very long period of time, if you see that any trade receivable is due for a very long period of time, the auditor should ask for reasons and justification for the same. Why this debtor is overdue for a very long period of time, you should ask the reasons and see whether those reasons are justifiable or not. And even here also you can get external confirmation. You can send the external confirmation request to the debtor and get the responses. In case if it is a related party receivable, in case if you are having receivables from the related parties, verify particularly are they recoverable, and also check whether those debtors have incurred after proper authorization, and wherever suitable perform analytical procedures. Try to study the relationship with sales. Try to do the you can study the relationship between trade receivables and sales. You can study you can do this comparison with the current year and the previous year, or you can compare it with the competitors data. All these kind of comparisons also you can do. So whatever it is, perform the analytical procedures. So these are the things which we need to verify regarding existence. Now what about completeness? What do you mean by completeness? I have to make sure that the company has recorded all trade receivable balances. They did not miss out anything from the books of accounts. How can I get to know about it? Very simple. You have to perform here cutoff procedures. Sir, what do you mean by cutoff procedures? The organization should record in the current year only the expenses which are relating to current year only. For example, incomes and expenses. See, cutoff is something which is particularly suitable for incomes and expenses. So what does that mean is, what is the meaning of cutoff is, if the whatever income that has been shown in the financial statements, whatever expenses that have been shown in the financial statements, they all should belong only to the current year. None of the future year's expenses or incomes, none of the past year's incomes or expenses should be recognized in the current year. So since trade receivables are something which is arising out of sales, trade receivables is arising out of what? Sales. So I need to check that whatever sales that are recorded in the current year, they belong to current year only. None of the past year's sales, none of the future year's sales should be recognized in the current year. Nothing but if we go by AS9, whatever sales regarding which risk and reward got transferred in the current year, only those sales should be recognized in the current year. If the risk and reward did not get transferred, invoice is there, but the risk and reward did not get transferred, then it has to be recognized only when the risk and reward gets transferred. So I need to check that cutoff procedures, and even I have to test invoices listed in the receivable report. You will generally get the receivable report, debtors receivable report will be there. Randomly select one debtor, open his ledger account. In his ledger account, he will be debited with certain sale invoices. Check whether those sale invoices are genuine or not. Nothing but randomly pick some sale invoices from the trade receivables account. Check the genuinity of that sale transactions, and even match the invoices with the shipping or dispatch log. Generally, companies will maintain shipping or dispatch log. That is nothing but the date, the register which will record the date the date on which stocks go out of the company. For example, if I have given a sale invoice on 30th of March, but in the shipping log, I was able to see that in the shipping register, I was able to see that against this invoice, the stock moved out of the company on 2nd of April. So now we have to see whether risk and reward got transferred on the date of sale invoice, or risk and reward got transferred on the date of shipping, on the date mentioned in the shipping register. Why? Because whenever risk and reward got transferred, then only I have to record the entry. See, if in both sale invoice and the shipping log in date is same, then it is fine. But some cases, sale date on the sale invoice, date on the shipping or dispatch log will be different. Then I have to pay attention on which date risk and reward got transferred, and on that date only I have to record that sale entry. And even you have to verify receiving log to see if the company has recorded an inordinately large amount of sales returns after the audit period. So sometimes what clients will do is to overstate their revenue, they will play some cheap tricks. So take for example 23-24 financial year is there. The company wants to inflate the revenue of this current year. So what the management of this company has done is they have sent the goods to some customer. On 30th of March, they have sent the goods to some customer. Customer did not place any order. So just they have generated a sale invoice for 1 crore rupees and they have recorded entry, sale entry they have recorded, but this customer did not place any order. Anyhow, this stock will reach the customer on 2nd of April. What customer will do? Since he did not order for the goods, he will say, hey, I did not order for the goods. Why are you sending me the goods? He will send it back. Now, by the time the goods come back to the company, it will be somewhere around 4th of April. 4th of April. Now, what the client will do is, on 30th of March, already he has recorded 1 crore of entry. That means in the year 23-24, entry is already recorded. Sales are already inflated by 1 crore. In the next year, that is on 4th of April, what he will do? He will record the sales return entry. Able to understand? It is a cheap trick which is followed by the management to inflate their revenues. So that's why what they are telling is you verify receiving log. Generally, the company will maintain one register in which they will record all their sales returns data. So check that receiving log. Check immediately after the balance sheet date, within 5 or 10 days after the balance sheet date, whether any huge sales returns are there. Why? Because these are the cheap tricks played by the management. Without customers' order only, they will dispatch, they will inflate the revenue, but later they will get it back. To know whether these kind of cheap tricks are played, as an auditor, you try to verify the receiving log of the organization as well. And also review the process of giving discount. If at all any discounts are given, if at all any sales incentives are given, try to understand what is the process of giving that discounts and incentives. And also try to verify credit memos on a sampling basis issued during the audit period. Credit memos means nothing but sales returns. For the sales returns, we give the credit memos. Even check that sales returns related credit memos also. Next one, valuation. How you will try to verify the valuation assertion? Nothing but whatever amount at which the trade receivables are shown in the financial statements, whether that value is correct or not. How you can get to know about it? Very simple. First, we need to understand what process the company is following for determining allowances for bad and doubtful debts. Nothing but how the company is creating that provision, on what basis they are creating, what process they are following. I need to understand that. And you have to obtain aging report. Aging report means nothing but on the basis of number of days a debtor is overdue, you have to get that aging report. Like for example, it will be something like particulars. Aging report will look something like this. Let me give you one example. It will contain name of the debtor or particulars, debtors which are not overdue currently, debtors which are overdue for 0 to 30 days, debtors which are overdue for 30 to 90 days, 90 to 180 days, more than 180 days. So like this, you will get some aging report. So ask the management to give the aging report. Obtain the debtors under litigation under current year and compare it with the previous year. How many debtors are there in litigation in the current year? How many debtors are there under litigation in the previous year? If any significant changes has happened, what is the outcome of that litigation? That also you have to record it. And scrutinize the analysis and identify those debtors which appear doubtful. If you find any debtor as doubtful, try to investigate that further. He should check that provisions are made at appropriate rates. You have to check all the provisions are made at appropriate rates. And if at all any debtor has been written off, if at all some debtor is non-recoverable and it has been written off, check that whether that written off has been approved. The organization can write off debtor only after getting approval from the concerned top level management in the organization. So these are the few things which you need to check regarding trade receivables. Understood? Clear and comfortable, everybody? So we have covered trade receivables as well. So coming to the next concepts, since we are done with the trade receivables, let us come to the next concept. So now we have next concept relating to how do we verify property, plant and equipment. What things we need to verify regarding property, plant and equipment. See, when I say property, plant and equipment, all kind of fixed assets, work in progress, everything will get covered here. So let us see, if you are conducting audit of any financial statements of the entity, significant portion of their financial statements, especially the significant portion of the balance sheet, will be in the form of property, plant and equipment. So what things you will try to verify regarding property, plant and equipment? Let us see. So since property, plant and equipment is also a balance sheet item, here we try to obtain evidence regarding existence assertion, valuation assertion, rights and obligations, and also completeness. Let us see how we can obtain audit evidence regarding each of this assertion. First, I will talk about existence. Nothing but whatever PPE which has been shown in the financial statements, whether all that assets are existing with the company as on the balance sheet date. How you can get to know about existence assertion? Number one, first you need to understand what plan management is following for verification of physical verification of the PPE. Generally, as we all know, every management will try to do physical verification of their PPE at least once in every 3 years. So we need to understand what is your client's plan for physically verifying their PPE. And also, evidence of appropriate supervision of those performing physical verification of PPE should be examined. That means whenever that physical verification is happening, that physical verification is happening under proper supervision or not. That also we have to pay attention. And obtain PPE physical verification report backed by the working sheets. Now finally, what is the outcome of that physical verification done by the management? Get that PPE verification report along with supporting documents. And assess if all items of the PPE are properly tagged and carry identification marks. Generally, in the organization, hundreds of assets will be there. Every asset will have a number in the register. For example, PM asset number 1, asset number 2. So like that, in the books of accounts, numbering will be there. But how to identify which asset is which numbering? Like for example, in my fixed asset register, there is one asset number 75. One plant and machinery is there. I want to know in the premises which plant and machinery is 75. How I can get to know? If there is some identification mark on that plant and machinery. So generally on the plant and machinery, in case of the organizations, wherever so many number of assets will be there, on the assets they will have some identification mark, like they will attach some numbering, or in some big organizations they will even attach a barcode also. So there should be some sort of identification mark, and you have to see that in case on that physical verification, if any discrepancies are noted, if any differences are noted between the assets which are there as per the registers and the assets which are lying there physically, if you find any differences, we need to check that whether those differences are properly accounted for in the books of accounts. The same point we have seen, this point also we have seen it under CARO 2020 also. So these are the few things which we can do in order to obtain evidence regarding existence of PPE. Now, how can I get to know about completeness? How can I get to know about completeness? What do you mean by completeness? Whether the organization has recorded all the property, plant and equipment, they should not have missed out any PPE from the books of accounts. So how will I get to know whether the management has completely recorded all the PPE? So what I should do? First, you should get the movement in the PPE schedule. What you should do? Movement in the PPE schedule you have to get. Sir, what do you mean by movement in the PPE schedule? Nothing but you have to get that list. Sir, what list is a like for example, for every PPE you have to get the statement like how many opening quantity of PPE are there. For example, if plant and machineries are there, how many opening number of plant and machinery are there, how many new plant and machinery were added, how many plant and machinery were disposed, what is the closing number of plant and machinery. Similarly, how many furnitures are there as on the opening date, how many new were bought, how many were disposed, how many closing number of furnitures are there. So like that, as an auditor, you need to ask the management to give this movement in the PPE schedule, to give this PPE schedule actually. And also you have to check arithmetical accuracy. So you have to focus even on arithmetical accuracy. All the additions and deletions, all the calculations are done properly or not. If you find any additions in that PPE schedule, if you find any additions, check that all that additions are meeting the criteria for capitalization as per AS 10. We need to capitalize an asset only when it fulfills the capitalization criteria as given under AS 10. So we have to check whether that recognition criteria has been met or not. And also in some cases, spare parts, standby equipment and servicing equipments also will be capitalized when they are expected to increase the value of that life and all. life of the asset. So you might have read all this in AS10. In some cases, spares and equipments also will be capitalized. Check whether the organization has bought any such spares which need to be capitalized. And in case of all the purchases, we need to verify invoices, installation certificates, or other similar documentation. And if at all, if the company wants to delete their assets, if the company has sold any of their property, plant, and equipment, we need to understand the reason and logic why that asset has been deleted. Is it no longer useful, or you have got some advanced machinery? So you need to understand what is the logic behind that deletion of that PPE, and also in what manner it has been disposed, and also what is, for that deletion of that asset, for that disposal of that fixed asset, is there management approval or not, and what process has been followed for sale or discarding. Generally, organizations will follow process like if they want to sell their PPE, they call for tenders, they call for auctions. So you need to understand even what kind of process has been followed. So these are the few things which you need to do in order to obtain evidence regarding completeness. Now let us talk about rights and obligations. Rights and obligations means whatever PPE that has been shown in the balance sheet, whether your client company is a true owner. What do you mean by verifying rights? Verifying rights means whatever PPE that has been shown on the balance sheet, whether your client company is the owner of all that assets. How you will come to know? See, if the asset is in the form of immovable property, what you can do is you can verify the sale deeds or conveyance deeds. In case if the asset is an immovable property like land or building, you can come to know whether your client is a true owner of that land or building or not by verifying that sale deed will be there. Sir, what about other assets? There will be some other assets like vehicles and all. Vehicles also we can verify whether our client is a true owner or not. Why? Because we'll have registration certificate. Sir, what about other assets? Plant and machinery. How you will come to know whether your client is a true owner or not? In that cases, we have only one option. We have to see the purchase invoices. We have to check whether the purchase invoices are in the name of the company or not. If it is immobile property, we can verify sale deed. Apart from that, for all other assets, we need to verify invoices and original title deeds. In case of immobile properties, your client should be having the original title deeds. But in some cases, original title deeds might not be there with your client. Original title deeds might be given to the banker when they have given it as a mortgage. In those cases, you have to get external confirmation from the banker whether the banker is really holding that original title deeds or not. You have to get that confirmation from the banker. And finally, valuation. Valuation means whatever PPE value that has been shown on the balance sheet date, whether that has been shown on the balance sheet, whether that value is correct or not, that also you have to obtain audit evidence. How can I obtain audit evidence regarding that valuation? Verify that entity has charged depreciation on all items of PPE. So depreciation should be charged on all PPE except land. And what kind of depreciation policy they are using. And we need to make sure that whatever depreciation method they are using, either SLM or WDV, that should reflect the actual consumption pattern. What that should reflect? That should reflect the actual consumption pattern. And what in case if your client has done the impairment, we have to check that the impairment has been done as per the requirements of AS28. Here I have given AS2, guys. Sorry, it should be AS28. You have to check that impairment has been done as per the requirements of AS28 or not. So these are the few things which we need to verify regarding PPE. Next, cash and cash equivalents. So one more significant item in the balance sheet will be cash and cash equivalents. So if you are conducting audit of some entity, in that balance sheet, if you find cash and cash equivalents balances, what things you will try to verify regarding cash and cash equivalents? A few points I have written here. Let us try to revise this also quickly. First and most important thing, when it comes to cash in hand, you have to do surprise checking. You have to do surprise verification of the cash. And you should not do the verification of cash only on the last day of the year, but you should also check it during your audit without giving prior intimation. Multiple times you have to do cash verification, not just once. And if there is more than one cash balance, like for example, there is a main cashier, there is a petty cashier, there is some cash lying with the employees. If the entity is maintaining more cash balance at more than one place, you have to verify all the cash balances simultaneously. Everything all at once you have to verify. And whenever you are counting the cash, ask the cashier to be present. Cashier should be present while the cash is being counted, and he should be made to sign that statement of cash verification. And finally, he has to, in case if there is any rough cash book, that you have to cross verify with the main cash book. And also, auditor should perform cash sensitivity analysis. Sir, what do you mean by cash sensitivity analysis? Nothing but cash sensitivity analysis will look like you will determine in one particular month what are the total cash payments, what are the total cash receipts. You will divide both. You will get some ratio. For example, you got to know that it is 0.8. When you divided total cash receipts by total cash payments, you get to know that the ratio is 0.8. Like that, every month I will calculate this ratio. So in 1 month I got 0.8, in 1 month I got 0.9, in 1 month I got 0.75. If it is in a reasonable range, well and good. But if you find any huge deviation, like for example, in 1 month sensitivity ratio is 0.8, in 1 month it was 2, in 1 month it was 5. If you find any huge deviation in this ratio, you have to investigate that further. So even you have to perform this cash sensitivity analysis as well. And finally, when I say cash and cash equivalents, in that bank balances also will get included. The most important thing which you have to do for bank balances is you need to get the bank reconciliation statement for all the bank accounts. And you get the bank reconciliation statement only if it is signed by authorized personnel. You take the BRS from the management only when it is signed. Unsigned BRS, you don't take it. And also, whatever bank balances are there, to know whether those bank balances are correct or not, even you can get external confirmations as well from the concerned bankers. And in case if you find any discrepancies between the bank balances as per the bank statement and bank balances as per cash book, try to investigate that differences. In case if you are not getting any reply, you have sent the confirmation request to the bank, but in case if the banker is not giving reply, you need to perform some additional testing. And in case if your client is holding a bank accounts in the foreign currency, check that those amounts are restated as on the balance sheet date as per the closing exchange rate. Nothing but requirement of AS11 have been complied with or not, we need to check it. Understood? So one more last balance sheet item I will discuss. After that I will talk about few P&L items and I will wind up. So let us see. One more balance sheet item is there, provisions and contingent liabilities. See, contingent liability actually will form part of notes to accounts, but still it is also one significant item. So what things you will try to verify regarding provisions and contingent liabilities? So number one, as you could see a few points here, you have to obtain a list of all the provisions and compare them with the balances in the ledger. Ask the management to give a list of all the provisions, try to compare that with the ledger balances. And also underlying agreements, try to understand the agreements on the basis of which provision is created. For example, sometimes a provision will be created for warranty. Try to get the warranty agreements to know whether this provision is required and whether this provision is calculated correct amount. So you need to verify that, you need to cross verify that provision amounts with the underlying agreements. And also ask the management to share the working, what is the calculation on the basis of which provision has been derived. Ask the management to share that working, and wherever required obtain the expert's report. And particularly when it comes to provision, the expert whose help we will take is actuary. So in case of this provisions and all, we might not have all the expertise, we might be required to take the help of expert. And who will be the concerned expert who could help us out in case of provisions? Actuary might help us out, so you can take the help of that expert. And generally while using the work of expert, if at all you want to make use of the expert, you have to make sure that that expert is competent enough, that he is capable enough, and he is objective, he is independent, he is not under any bias. And also you have to get an overall understanding of the work of that expert. Try to get a brief understanding of what work that expert is doing, and also evaluate appropriateness of his work, whether did he do the work appropriately or not. That also you try to evaluate. And one more thing, you should even try to obtain external confirmation from the management that it has made all the provisions and they have informed to you about all provisions and they did not hide anything from you. Try to even get written representation from the management as well. So these are the few things which we will try to verify regarding provisions and contingent liabilities. Now, so many balance sheet items we have covered. Now we will try to talk about a few P&L items also. How we can obtain audit evidence regarding a few P&L items, that also will try to cover it quickly. First, we will try to focus on sale of products and services. What things you will try to verify regarding sales? So when I say sales, since it is a P&L item, here the assertions will be occurrence, completeness will be there, and also measurement will be there. So let us see how can I obtain evidence regarding occurrence, how can I obtain evidence regarding completeness, and how can I obtain evidence regarding measurement. First, I will talk about occurrence. Sir, what do you mean by occurrence assertion? Occurrence means nothing but in the statement of P&L, how much amount of sale has been shown, whether really the sales worth of that much amount has taken place during the year. Whether really that much amount of sale transactions have occurred during the year. I want to know how can I obtain audit evidence. So first I need to make sure that no revenue has been overstated. Whatever revenue that has genuinely taken place, that only should have been accounted. There should not be overstatement of revenue. So how can I check that there is no overstatement of revenue? I have to check that a single sale invoice is recorded only once. It should not be recorded multiple times. Take a few invoices and check with the relating supporting documents and obtain confirmation from few customers. Even you can get confirmation from the few customers. Check whether any fictitious customers, fake sales and fake customers have been recorded. Check that whether any shipments are done without the consent. Specifically, we need to see that no shipments are done without any consent. You have to make the sale only after getting consent from the concerned customer. And also you have to check that no unearned revenue has been recorded. Only earned revenue should have been recorded. If any unearned revenue is there, that should not be recorded. And also you have to make sure that if any revenue is getting recognized, that can be recognized only when there is no substantial uncertainty. If there is any substantial uncertainty regarding its ultimate collection, you have to postpone that revenue recognition. Next, you have to check that all the sales invoices are in a sequence, proper numbering has to be followed, and verify journal entries to find out whether any unusual transactions are there. In the sales, if there are any unusual transactions, try to verify that journal entries, try to do a close examination of the journal entries. And also they're asking you to do one more thing, calculate the ratio of sales returns. Divide the total sales returns with total sales value, you will get one percentage. Try to calculate that percentage for the current year, try to calculate the percentage for the previous year, try to investigate the differences in case if you find any. For example, last year the sales returns are 7%, but in the current year the sales returns are 20%. So why that huge difference is there? Try to investigate that further. So these are the few things which I will try to verify regarding occurrence. Now, how do you verify completeness? So what do you mean by completeness? First of all, completeness means whatever revenue that has been recognized in the current. So the company should not have missed out any revenue from the books of accounts. All the sale entries of the current year should have been recorded. So how the auditor can obtain audit evidence regarding it? Number one, you have to perform cutoff procedure. Nothing but whatever revenue that has been recognized in the current year that belongs only to the current year. None of the future year's revenue, none of the past year's revenue should have been recognized in the current year. So perform that cutoff procedures. And also auditor should verify credit notes issued after the accounting period. This point just now I have covered in the trade receivables also. You have to verify immediately after the balance sheet date whether there are any huge sales returns. That also you have to verify. And you have to even verify shipping documents. Nothing but try to cross verify with the shipping log. This also I covered in trade receivables. And even you verify the GST returns also. Try to match what is the turnover as per the GST returns and what is the turnover as per statement of P&L. Both should match. There should not be discrepancies. And then finally measurement, nothing but at whatever value the revenue has been shown, whether that is correct or not. That also I need to obtain audit evidence. How I can do it? Trace a few transactions from inception to the completion. Nothing but you have to do a examination, in-depth examination you have to do. And if you came to know that in case if the client is engaged in export sales, if they're doing the exports, you need to check the compliance with AS 11. Forex differences you have to properly account for. An auditor, as an auditor, you must understand what kind of business your client is doing and what are their generally accepted accounting principle related issues. And also try to understand at what rate the sales are getting affected with related parties. In case if the sales are made to related parties, at what price the sale is happening. And also you have to check whether all that related party sales are approved and whether they are collectible or not. Next one. So this is what regarding a brief of how to verify sales. Similarly, I have added one more question. How do you verify employee benefit expenses? When I say employee benefit expenses, all the expenses incurred for the employees, like it could be salary, PF, bonus, gratuity, staff welfare. So what things you will try to verify regarding employee benefit expenses? So first of all, they're telling you have to obtain understanding of entire process of capturing employee attendance, how the employee attendance is getting captured. Why? Because every organization have some leave policies. Some organizations will have 2 paid leaves, some organization will have 3 paid leaves. So you need proper attendance capturance. How many days an employee was present, how many leaves he has taken, out of that how many are paid leave, how many are unpaid leave. So what system the organization is following for capturing attendance, you have to understand it. And auditor may select a sample of employees and ask the payroll department to share their bank details or identity proofs. From the entire payroll data, you can select a sample of employees and ask the management to share these employees proof of details. And you can obtain a list of employees at the period end along with monthly movement slip. Sir, what is this monthly movement slip? Nothing but month on month what movement has happened in the employees. When compared with the last month, how many employees have left the organization, how many are replaced, how many new recruits are there. So like that you can get monthly movement slip. And you can take a sample of new hires out of newly recruited staff from the current year. You can take a small sample and you can verify the terms and conditions in their appointment letter. Similarly, whoever employees have resigned during the year, from that also you can take a sample and check that whether for them full and final settlement has taken or not. And even you can verify the salary register for all the 12 months also. Next one. Apart from that, you need to check whatever benefits which employees are entitled to, like for example bonus, leave encashment. This amount will not be paid now, or even you take gratuity. So gratuity, leave encashment, these are actually post-retirement benefits. These will be paid to the employees after their retirement. Can the company recognize also at that point of time only? No. These bonus, gratuity and leave encashment, they might be paid at a later date, but the company has to create a provision from day one itself. And in case if the organization is covered by PF and ESI laws, I need to check that whether they have calculated the PF amount and ESI amount at appropriate rates. And I need to check that whatever share of PF and ESI which has been deducted from the employee's salary, that can the employer enjoy with it? No, he has to go and deposit that amount with the authorities. And finally, wherever you find relationships, wherever you find predictability, try to perform analytical procedures also. Clear? So this is how you can verify employee benefit expenses. Apart from that, they have given all other expenses. So they have spoken about sales, they have spoken about employee benefit expenses, but they have various other expenses also. They are trying to cover all other expenses. See, for all other expenses, there are some general points, there are some common points which we check for all expenses. There will be some common points which we will check for all expenses. So what are the common points which we have to check for every kind of expense? Like we need to check whether expenditure belongs to current year or not, whether expenditure is qualifying as a revenue expenditure, not as a capital expenditure. Wherever expenditure is there should be a valid supporting document. It should be properly classified under correct expense head. You have to recognize it under correct account. And we have to check that all the expenditure has been authorized, approved by the concerned person, and expenditure was not personal in nature. Expenditure should be related to business. So these are some general points which we see for every expense. Now they talk about each specific expense, what special points we have to keep in mind. Like for example, rental expense. So how you can verify rental expense? You have to obtain month-wise expense schedule. Month on month, what is the rental expense? You get that schedule. And you have to check that rental expense has been recorded for all 12 months, especially for March month. March month rent you will pay it in April, but you have to recognize it in the month of March only. And also whether the rent amount is as per rental agreement. You have to cross verify whatever rent the organization is paying, whether that is as per rental agreement or not. And in case if there is any escalation clause in the rent agreement, escalation clause will be there. After 1 year, after 2 years, rent will be increased by this much percentage. Pay specific attention to that escalation clause. And you have to check that rental agreement should be in the name of the company, and rental agreement in the name of the company alone will not be enough. That premises should be related to running the business. Whatever premises you have taken on rent, that premises should be used for the business. And also rent agreement should be in the name of the company. When both these conditions are satisfied, then only you can recognize that rental expense in the company's books of accounts. Similarly, what things you will try to verify regarding power and fuel expenses? So here also we can get month-wise expense schedule. Month on month, what is the power and fuel expenses? You can get that schedule. And power and fuel expenses also should be recognized for all the 12 months. And month-wise summary of power units consumed and applicable rate. If you know how many units of power has been consumed and what is electricity rate per unit, even you can also cross verify that, even also calculate that power expenses. So like that you can cross verify if you know how many power units are consumed and what is the applicable rate. And even they are asking you to perform analytical procedures. You can link that power units consumed with finished goods production. If more power units are consumed, that means more production should have taken place. So if there is any significant expenditure in the power and fuel expenses, you can cross verify whether that increase is justified or not. When that increase will be justified, there is an increase in the power and fuel expenses, then there should be increase in the production activity as well. So these kind of analytical procedures also you can perform. Apart from that, insurance expenses. What things you will try to verify regarding insurance expenses? You have to get a summary of all the insurance policies which your client is having along with their validity period. And generally insurance premium will be paid for more than 1 year. In that cases, only current year expense should be recognized in the current year and balance should be shown as prepaid expenses. This one specific thing you have to check for insurance expenditure. Then when it comes to legal and professional expenses, what things you will try to verify regarding legal charges? Number one, obtain month-wise, consultant-wise. If the company has appointed more than one lawyer, for every month, for every lawyer, what amount they are paying, you have to get that list. Sometimes the companies will enter into retainership agreements. That means fixed agreement. Whether case is there or not, they will pay certain amount of fixed charges to lawyer. So in case if there is any monthly retainership agreement, check that expense should be there for all the 12 months. In case non-recurring expenses are there, like for example, case fighting charges. Case fighting charges will be there only when the case is filed. So in case of non-recurring expenses, you need to take a sample of that non-recurring expenses and watch for general attributes. Nothing but check for these things for non-recurring expenses. And finally, as an auditor, when you are verifying legal expenses, you have to be very careful. Why? Because you will get to know about litigations which you are not previously aware of. If you pay more attention while verifying legal expenses, you can get to know extra information regarding the litigations which your client might be going through, which you are not previously aware of. So this is how you need to verify all other expenses also. Clear and comfortable, everybody? Apart from that, I also want to talk about one more thing. There will be one question talking about disclosure requirements. There will be one specific question talking about disclosure requirements regarding certain items of the financial statements. That is very, very important. They have asked these questions multiple times in the examination. So that one question I will cover. Yes, this one. So what should be the disclosure requirements in the financial items regarding 5 items they have given? So what things the company is required to disclose in their financial statements regarding CSR expenditure? What things company is required to disclose regarding Binami properties in their financial statements? What things company is required to disclose in their financial statements regarding relationship with stock of companies? Similarly, what ratios they have to disclose, and what the things the company has to disclose regarding cryptocurrency or virtual currency. So these are actually disclosure requirements, nothing but in the notes to accounts, the company is required to give some disclosure. And they have identified certain matters regarding the CSR expenditure. What company has to give disclosure in the notes to accounts? Similarly, in case if there is any Binami properties, regarding that, what disclosures the client is required to give. If you have, what ratios the client is required to disclose. If your client has done any cryptocurrency or virtual currency transactions, regarding that, what disclosures they have to give. So these are all the disclosure requirements as per Schedule 3 and Companies Act. So this is very, very important from the examination perspective. Like for example, regarding corporate social responsibility, what disclosure management has to give, what disclosure company has to give. Like where the company has been covered under section 135 of the Companies Act, the following should be disclosed with regard to CSR activities. What is the amount which you are required to spend? Out of that, how much amount you have actually spent? What is the shortfall? And what is the shortfall of the previous year? What is the reason for the shortfall? Why you are unable to spend it? What kind of nature of activities you have done? For what kind of CSR activities you have spent it? And in case if you have spent a CSR activities through related parties, generally some big companies, what they will do is they will create a trust, and through the trust they will do CSR expenditure. So like that, if you have transferred any money of CSR expenditure to the trust created by you, so that is what details of related parties. So that also you need to verify. And in case where a provision is made with respect to liability incurred by entering into contractual obligation, the movement in the provisions, nothing but if you have entered into any obligation that you will spend it on the corporate social responsibility, you have entered into any contract for spending of CSR expenditure, even that details also you have to show it separately. So these are the things which the organization is required to disclose regarding CSR. Similarly, if any case has been filed against the company, or if any case has been pending against the company regarding Binami transactions, the company is required to give certain disclosures regarding Binami transactions in their notes to accounts. So what disclosure the organization is required to give regarding Binami properties, regarding proceedings initiated against the company for holding Binami properties. So in those cases, the company should disclose what is the details of such property, what is the year of acquisition, what is the total amount, details of beneficiaries, who are the ultimate beneficiary. You are holding Binami property, but who is the ultimate beneficiary? Next one, if property is in the books, then refer to them in the balance sheet. If property is not in the books, then the fact shall be stated with reasons. Similarly, when there are proceedings against the company under this law as an abettor or as an transferor, the details should be provided. If any case is pending against you, even that details are also required to be provided, and what nature of proceedings are happening, what is the status of that proceeding, and what is the company's view. What is your view? Will you win the case? Will you lose the case? So that your view is also required to be included. And in case if your client company is having a relationship with any struck off company from the registrar, so certain things you have to disclose regarding relationship with the struck off companies also, like what is the name of the struck off company, what kind of relationship you are having with the struck off company, did you invest in their securities, did you have receivable, did you have payable, and are you holding any shares or any other outstanding balances, and what is the total balance outstanding, and what kind of relationship with the struck off company you are having, like is it your subsidiary, associate, joint venture. So these things the company is required to disclose in their notes to accounts regarding stock of companies. And finally, some ratios also they have to disclose. The list of ratios they have given here, this I can't go through it, so just ratios are there. So all these ratios also you are required to disclose. And cryptocurrency or virtual currency, in case if your client has dealt in virtual currency or cryptocurrency, then management in their financial statements they have to give some disclosure, like whether the company has traded or invested in cryptocurrency or virtual currency during the financial year. Then the following should be disclosed. What are they? profit or loss that occurred on this cryptocurrency or virtual currency transactions, and also amount of currency that was held on reporting date. Nothing but as on the balance sheet date, how much cryptocurrency you are holding, that you have to disclose. And also deposits are advances from any person for the purpose of trading or investing in crypto or virtual currencies. Did you receive any deposit? Did you receive any advance? Or did you give any deposit? Did you give any advance to others for doing the cryptocurrency transactions on your behalf? Even these details are also required to be reported. So the most important thing here is these are all the disclosures which management is required to give in their financial statements. These are not the disclosures required to be given by the auditor. These are all the disclosures required to be given by the management where in the notes to accounts of the financial statements. So these are the things which I thought of covering. One more thing I want to share with you. One more important thing which I would like to share with you. Guys, in my website, I have actually compiled all the test your knowledge sources. Whatever test your knowledge questions that are given in the ICA material, that have all compiled it, and I have uploaded it in my website also. You can download, I have website link and all have been given in the description and all. So from the website, you can download my test your knowledge question bank. Whatever test your knowledge questions are there in the study material, questions along with answers. In the material, you will find only references. In the ICA study material, you will find only you'll find only references. You will not find the exact answer. So what I have done is I have compiled all the questions. I have even given the answers also. So my humble suggestion is go through this material, go through this test your knowledge question bank before you go for the examination. You can download it from our website free of cost, no charges. And my humble request, especially for audit of items of financial statements and audit of various entities, 100% you have to go through the question bank. You have to definitely go through this test your knowledge question bank, especially for this chapter, audit of items of financial statements. Don't go for the examination without referring this question bank of this particular chapter. So my humble request, whatever questions which are given here in this particular chapter in the test your knowledge category, for which answers also have added in my question in my test your knowledge booklet, compulsorily go through the test your knowledge questions of this particular chapter. Clear? So this is what I have to cover regarding audit of items of financial statements. So I hope this marathon would have been very much helpful for you. This marathon would have been a lot of value addition in your preparation. That's what my expectations are there regarding this. So all the very best, guys. And in case if you find this marathon informative, if you have learned something from this marathon, please do have a word with your friends. Please do share it with your friends, and also help your friends to get through the examination. Okay, so that's all from my side. Thank you so much for your patience listening. Bye everybody, take care.